Good day, Real Vision viewers. This is Tony Greer of TG Macro. This is an exciting day for me today. I get to add a brilliant addition to my roster of interviews. Today, I get to interview my favorite chicken. I'm very serious about that. I want to introduce you all to my good friend Doomberg. Doomberg runs Doomberg at Substack.com, and he is one of the most authentically passionate, talented content creators that I have met since joining this business. And I'm looking to introduce you to him and all of the expertise that comes with him and his background. So without further ado, Mr. Doomberg, how are you doing this morning?
Tony Greer, it's an unbelievable honor to be on Real Vision with you. I'm a huge fan, as you know, a longtime subscriber to TG Macro, and I start every morning with the Morning Navigator. I haven't missed an edition since finding you many years ago. It's really, can't tell you how great it is to be on the show with you.
Oh, this is so exciting, man. Well, we have a mutual respect then, and I can't wait to crack open into, four really right in your wheelhouse topics today. Okay. And now I just want to go over the outline so that people know where we're going here. We're going to talk about U.S. energy policy. We're going to talk about the potential energy crisis in Europe. And we're going to talk about the uranium trade. And then we're going to talk about prepping. But first, I want to go and introduce you to Doomberg his way. I'd love for you, Doomberg, to go ahead and introduce yourself to the Real Vision community and tell us what you're about.
Sure. The Doomberg at Substack.com is sort of a team effort. In real life, we run a bespoke consulting firm. The partners in our firm all come from heavy industry, and combined we have several decades of experience in what people would call the commodity sector. We write about markets. We observe markets. We're not traders, and we don't give investment advice. But we come at the markets from a technology, science, and managerial experience background in the real world. And so we think that's a pretty interesting and unique vantage point to comment on markets. And that's what we do. We try to put out 10 pieces a month. It's been an incredible experiment. We launched Doomberg 7 months ago, and it's been successful beyond our wildest imagination, and in part inspired by people like you and Kevin Muir and some of our friends in the content creation business. We thought it would be fun to jump in the pool, and we created the Doomberg brand and the green chicken, and we've been writing under that name ever since.
Well, with that type of background, I can't begin to tell you what a comfort and a real asset that is to a commodity trader like me. Just from the perspective of speaking to you, speaking to a green chicken with a calm voice and a very soothing demeanor, it sort of takes a lot of emotion out of the trades for me. And I want to go right into one of the trades that has been driving me crazy, that you finally sort of let the air out of that by saying, yeah, U.S. energy policy. I mean, we're shooting ourselves in the foot. It's a very simple way of looking at it. And we started that sort of idea of shooting ourselves in the foot about policy when we cut off the transcontinental pipeline to Canada, and we are, totally clamping down on fossil fuel investment. And I would just love to hear your perspective of how you set up the U.S. energy policy that we've been following here since the Biden administration took over, and what the risks that you see out there in the market are.
Yeah, absolutely. We rewrote a piece called "America's Energy Strategy is Bonkers." Because as somebody with some experience in the industry, it just makes your head want to explode when you see the self-inflicted wounds that we're doing here. And we come at this from a perspective that there are tangible technology solutions to alleviate humankind's footprint on the environment, and specifically CO2 emissions. We do believe, however, that energy is life, and that we begin our analysis from a human first perspective. There's a billion people on the planet that don't have access to a sufficient amount of energy to enjoy a reasonable life. And we're talking about restricting energy supply to impact CO2 emissions. And at the same time, we're doing things that make that transition incredibly hard. And at the core of our thesis, if I could describe it in 3 words, better is better. So, for example, replacing coal-fired electricity plants with natural gas is better for the environment. It burns cleaner. You produce more electricity for the same amount of CO2 emissions. far less toxic byproducts. America has an abundant excess of natural gas that it can tap into. So, when you oppose blanket fossil fuels, you take away a key tactic that can actually help us get there on the journey. So we call that sort of the path function. The path from today to a better world matters, and how you go about doing it can have serious consequences and unexpected consequences for the world. Another big policy objective for us would be to see a proliferation of nuclear energy. Nuclear energy is very demonized by the very same people who proclaim to care about the planet and abating CO2 emissions, that there is no cleaner, safer, more economic way to produce the electricity that we Americans enjoy and the world enjoys than through nuclear power. And yet, we are setting about the process of not only not building out nuclear energy here, but letting existing nuclear energy facilities go offline. Closing them down is especially true in Germany, which we'll talk about later in the European side of the crisis. But even here in California, where they're having amazing problems with their grid and rolling blackouts, there's a major nuclear energy plant that's set to close. And only now, after all of this sort of spike in energy prices, are local politicians doing a little bit of a step back and saying to themselves, hey, maybe that's not such a great idea. But the real motivation for that piece, which we put out several months ago, was watching the Biden administration, as you say, cancel the Keystone Pipeline, which was always a political football. But at the same time, seeing that prices were going up at the pump, begging OPEC to produce more. And if you just take the logical, extension of that strategy to its natural end, we are going to cede the control over our energy policies, and energy is life. So we're going to concede control over our lives to people who don't like us. And that's bonkers. And we're already seeing the Biden administration backtrack on it. And we could have saved them the round trip if they would just stop and think about it and say, hey, maybe we should think about putting more nuclear capacity online, and we should think about using our excess natural gas to replace coal. And we should maybe think about having a friendly supplier of energy from the north, Canada, be, it's not like that pipeline would have been what Biden's doing to Europe. We have great relationships with Canada. We have mutual trade. There's always some disputes. Right. But nobody would say that Canada isn't a reliable energy partner. And yet we slapped them in the face and we turned it off. And so it just doesn't make sense. And we're all for, continuing the development of renewable energy. We're all for massive investment in grid storage. There's some really innovative companies in the space, but coming at it from an industrial perspective, it just makes your head explode sometimes.
Exactly. So what we've done, let's look at the price of gasoline, which is obviously backed off the highs, but dramatically higher since these policies have been implemented. And I want to go to sort of, I like I've listened to every one of the podcasts that you've done, especially with Grant Williams and with George Gammon. And I like the idea that, you call it energy is imposing order on your local environment, right? Energy is civilization. Energy is the ability to, use nature's resources to benefit the living human beings on the planet. And I think we need to continue to go that way. But what I see as gas prices go higher, natural gas prices go higher, we pivot toward the food sector because now ammonia prices are going much higher, fertilizer prices are going higher, which means grain prices are going higher. And I think that we get toward that higher food costs as the point where the rubber meets the road politically. Would you agree with that? That while, the energy cost being 30% of, food and grain costs, we are going to run into a problem with the rising cost of food in this country.
Yeah, and it's at some point markets get so broken it's not even about the cost; it's about availability of supply. And we wrote a pretty provocative piece called "Starvation Diet," where we predicted much of what we are now seeing unfold in the fertilizer market. When we connected the dots. So one of the advantages of spending decades in industry brings is we can see how various markets are interconnected. And, many companies are not integrated. One company's output is another company's feedstock. And fertilizer is sort of ammonia plus phosphate. And on the one hand, we're watching natural gas prices double in the U.S. and go up, 3, 4, 5x in Europe. We happen to know that fertilizer production occurs in these areas. The ammonia side of the equation is basically the input is natural gas, and then you need phosphates to make many of the fertilizers, not all of them. But then separately, we noticed that China, responding to its energy crisis echo from Europe, decided to ban the exports of phosphates. And you put two and two together, and you realize that hey, that factory that makes fertilizer now is getting a left jab and then a right hook, and they're just not going to be able to make fertilizer for any reasonable price. They might be locked into supply contracts at fixed prices based on lagging market indicators, and they're just going to declare force majeure and not produce. And then you take the next step down the road and say, if you're an American farmer who paid $200 for your fertilizer last spring, and you budgeted $300, and the bill comes in at $12.50, maybe you're not going to buy fertilizer. Maybe you're going to plant less crop. For sure, your margins are going to get squeezed, or food prices have to go up. And one of the things that is extraordinarily frustrating to see is we don't learn anything from history. Food is, well, energy is life, and food is energy for humans, literally. And the people will revolt. Now, Tony Greer is still going to eat, and the Doomberg team is still going to eat. It's going to cost us more. But there are hundreds of millions of people right on the edge for whom price inflation is death. And when you have a critical input, so people don't really realize, many do, I'm sure many of your listeners do, that the fossil fuel industry, the energy and gas sector, as you would call it, is also the key input into virtually everything that we see and use in our daily lives. And we wrote a piece called Where Stuff Comes From, just to show people that, if you snap a whip on natural gas in Europe, that's going to snap through very delicate supply chains, and it's going to make a big sound when it hits the floor. And that sound that you're hearing now as the whip hits the floor is fertilizer. It's all manner of packaging. Food packaging has gotten more expensive. You mix in supply chain crises, which are a natural consequence of all of this. There's a story out of China where, manganese exports were being cut off to Europe, and that was imperiling aluminum production, and aluminum production imperils car production. These things are interconnected. Our just-in-time inventory supply chains are really messed up, and huge spikes in inputs like natural gas only make that much worse.
Right. So while we're on that natural gas topic, let's go into a little bit what's going on in Europe, which is just worth following along. As you say, it could be a preview for what we see over here. So what's gone on is Europe has let their natural gas stocks diminish greatly. They're depending on Vladimir Putin in Russia to send gas over through the Nord Stream 2 pipeline. And there are some, regulatory difficulties getting that deal done. So now it leaves them with tremendous Mother Nature risk, right? If they have a colder than normal winter in Europe, they're going to be in for a really difficult time. Now, how do you think that possibly plays out?
So if you think about the genesis of the energy crisis in Europe, it was all very predictable. I was listening to podcasts in the summer where people were pointing out that they were heading into the fall with the least amount of storage they've ever had, that this was going to be a huge crisis, and if Vladimir Putin didn't come through, then they would be in big trouble. How did this crisis begin? It began by an underproduction in natural gas locally, as Europe was mandating the phase out of fossil fuels. This is again where phasing out natural gas makes no sense in this environment because we're not yet ready to do it. They replaced the nameplate capacity with intermittent power producing technologies like wind and solar, which is great, except they're very poor baseload power. They're not baseload power, they're intermittent power because the wind doesn't always blow and the sun doesn't always shine. And natural gas and nuclear and coal are baseload powers. And the successful operation of a electricity grid is one of those modern marvels that nobody ever thinks about, but is incredibly difficult to do. And we're finding that out in Europe now. And so in the spring, the price for natural gas was elevated and they held off buying, waiting for prices to come down. Or They assumed that they could make up the difference via pipeline from Russia and LNG imports, liquefied natural gas. We did a whole piece on the LNG market. What happened is the echo of the European energy crisis showed up in China. China has an energy crisis now, and China, Chairman Xi, President Xi decided that he was going to pay any price for the incremental supply of LNG. There's only so many major LNG exporters in the world, and the three top ones being Australia, Qatar, and the U.S. And China said we're going to hit every ask. So whatever the price is, whatever Europe is bidding, we're going to top it. And if you chart the JKM natural gas for Asia versus the Dutch TTF, you could see Asia's paying slightly more in the incremental supply of LNG, ironically, from the U.S., which is kind of becoming the swing exporter of natural gas. Is the boats are sailing east, and Europe is left to fend for itself. And as you say, roll the dice on the weather. And the weather forecast looks pretty ominous. So they entered this peak heating season with something like 78% of the storage capacity full.
Yep.
And what we're really seeing is exactly what I referred to earlier. If your energy policy in the U.S. is we're going to restrict supply here, but we're going to beg OPEC to produce more, then you are ceding the power over life of your people to people that don't like you. Well, Europe is now sitting on the edge of a pipeline waiting for Vladimir to come through. Well, as we wrote in another piece, Putin's fools rush in. The geopolitics has never been so easy for the man. I mean,
Right.
so you said, the Nord Stream 2 project is caught up in a bureaucratic malaise. No, that's Germany still thinking it has cards to play. They're sitting at the poker table with a 7-deuce offsuit. Putin is sitting there with pocket aces, and they go all in.
Right.
He's going to call your bluff. So,
Yeah.
and you can either hope that it gets warm, or you're going to have serious consequences. And it's not just the easy things that you can see, like people not being able to heat their homes, or the electricity going out and having rolling blackouts. There's an entire manufacturing infrastructure in Western Europe that relies on natural gas as an input. And all of that infrastructure now is at a huge cost disadvantage. Ask BASF in Germany, what's it like to be sitting there with $30 per million BTU natural gas?
And trying to be a chemical producer, right?
Yeah, and then, all the people that need those chemicals.
Yeah.
And it's same things happening in China. So what has happened as a consequence of Europe's energy crisis is LNG spiked, as we just described, which means China has a energy crisis because it relies on imports of LNG to meet its needs. So you're seeing two things. You're seeing a lot more coal burning, which is counter to global warming, but also things like the price of polysilicon have spiked. So, solar grade polysilicon is, up 4x over last year, which means a lot of solar projects are going to get a little more expensive, a little tougher to do. And so, these things are interconnected. There's an intelligent way to go about this. And there's a cocktail party way to go about it. And the cocktail party way to go about it is big, broad strokes, superficial, unserious policy choices like we're just going to restrict all fossil fuels because all fossil fuels are bad. And
Government by platitude, right?
Government by platitude. And ultimately, as you say, the rubber's going to meet the road when food prices in the emerging economies explode.
So the overlay for me with the food issue is sort of coming back out of where we are as a society coming out of the lockdowns, right? There have been so many businesses that have been damaged. There have been so many personal balance sheets that have changed. The vaccination requirement mandate is sort of morphing around the U.S. But what I fear is that, if we have we're having a trucker issue right now, right? We can lose many millions of truckers due to the vaccine mandate that the Biden administration is trying to put down. We can also lose a large number of food processing inspectors, health inspectors that go around to the food processing plants and sort of okay everything. And when I do the overlay of what will happen, when natural gas prices rise higher, food and grain prices are higher, and we have less distribution infrastructure to get food distributed, I see the risk at those food processors in addition to the whole economies built around them. Can you touch on that a little bit, Doom, as far as sort of drilling down a little bit further into economically and financially, like what this could mean? Because I really believe, and I want to get to the sort of end game of this, my sort of argument is that ESG is eventually going to run into, the political pendulum swinging right back in their face. So I kind of want to be prepared for this and make sure that as a trader, we're out ahead of it, prepared for food prices to rise, energy prices to rise. Talk to me about the intersection of that sort of economic storm, if you can.
Yeah, we've written a lot about the just-in-time supply chain crisis, and we do think that major corporations, many have said it before, it's almost a cliche now, but from just-in-time to just-in-case does give an inflationary pulse as businesses rethink how much working capital they need to, safely operate their facilities and avoid a stock out. There is an incredible shortage of labor in the United States today. I should say there is not a shortage of natural gas in the United States. We are well supplied heading into the season. You're seeing, natural gas here with a 430 bid this morning as I'm looking at my Bloomberg, where it's still $30 a million BTU overseas, and that just shows you the issue with supply chains is if when things sell for radically different prices in different places, it tells you there's an arbitrage opportunity and that there's a logistics plug somewhere. And that's what we have going on with natural gas. And then broader in the supply chain, we do a lot of thinking about this and go back and forth. The original lockdown triggered a huge deflationary air pocket in the economy. Then our response to the opening of, the combination of fiscal monetary response and then the reopening of the economy and the speed with which that happened created an inflationary pulse. There's a huge debate, as you know, in the inflation deflation camp. We come from industry and our phone is lit up with executives telling us they can't get supply, they can't get labor, prices have to go up. On the flip side, if we re-enter lockdowns, that's sort of a deflationary countermeasure to that inflationary spike, which I suppose only puts it off until we come out again. And so nobody would say that, the most recent noise around variants are, some kind of master plan to deflate the economy and to abate the inflation spike with Jerome Powell coming out and saying we need to retire the word transitory. But it is an interesting coincidence that this variant showed up at the same time that central bankers really began to worry about the impact of the monetary and fiscal policies that we were seeing when combined with the supply chain snafus that are manifested post-reopening. And so it's a very interesting time. Like you say, oil is off the high, and who knows by the time this publishes what OPEC's going to have done. But there's a lot of moving parts. There's a lot of flow. For sure, supply chain is really messed up. Even still, I know the Biden administration is talking about easing at the ports, but in reality, I think they're just moving ships around, which you can easily watch with a cheap subscription to marine traffic. And so, it's kind of rough up there. Our contacts in industry tell us that the supply chain crisis is not getting better. And then one last thing I do want to say in the North American supply chain crisis, watch what's going on in Vancouver closely. We had the mudslide and the floods. They have this ongoing series of drenching rain. These storms just seem to keep pouring in from the Pacific. Canadian National is having a lot of trouble getting the railroad rebuilt. And people in the U.S. might think that that's not a big deal, but Vancouver is a very important critical infrastructure port. A lot of the world's coking coal, seaborne coking coal comes there, which feeds steel plants. Supply chains are tough. I saw there were more than a dozen coal ships out at sea waiting to be filled. That crisis at the port of Vancouver is being a little bit downplayed in the media right now. We've kept a close eye on it. We've written about it, and that's something to watch too.
Very good. It's really interesting that how you say that the market is sending signals, right? Like there are real signals now to entrepreneurs, in the commodity space regarding these price differences that are happening in the arbitrage opportunities. I want to go a little bit into, back to nuclear and the uranium play, because I loved in the Grant Williams interview that you did, you mentioned that this is a really crisp market signal, right? Like we are going to be needing more electronic vehicles. There is a message to utility companies like, put the shovels in the ground here and start figuring out how to deliver this kind of energy. So let's use that as our pivot into the nuclear discussion, because tell us about sort of how the signal that the market is sending first and what kind of response we're seeing from the world, including the Sprott Physical Trust, which is the story that I want to kind of wind up at.
Sure. Uranium is a really fascinating market. After the Fukushima disaster, uranium was left for dead.
Yeah.
And Germany announced it was going to take off all of its uranium facilities. Um, and Japan obviously put a bunch of things on hold. Uranium mines all around the world closed, and there was excess supply. And as our mutual friend Cuppy described in one of his great pieces, the utilities have become pretty comfortable with an oversupplied input. Uranium is a pretty small part of the cost of operating a nuclear facility. So you have this amazing case where you can draw the supply curve for uranium miners, the cost curve, sorry, for each increment of supply. And at the time, 2, 3 months ago, when Cuppy first made this call, and others obviously on uranium Twitter as well, uranium was selling for about $30 a pound, but the marginal cost of production to bring new facilities online was $65 or $70 a pound. And then, as you indicated, we have this really amazing vehicle come online, the Sprott Physical Uranium Trust. Their stated intent is to buy and sequester uranium from the spot market and to tighten up the uranium market. And they've been busily doing so, chewing up supply. The price of uranium sort of jumped at the peak of the excitement from, let's say, $30 to, in the low 50s. It's since backed off to the 40s. It's one of these trades where everybody understands the thesis. The thesis seems very clear, but everybody knows the thesis, and so is there still a trade there? And that's where guys like you come in, because we could look at the fundamentals and get excited about it, but if Sprott keeps chewing up supply and taking supply offline, converge that with nuclear having a renaissance. And then finally, one of the challenges with the Sprott Physical Uranium Trust is it trades in Canada. It only trades OTC here in the U.S. And they're applying for a New York Stock Exchange listing, which of course will get them a lot more, access to potential funds to continue to chew up this supply. But if there's a supply deficit that emerges just as nuclear facilities come back online and new builds get announced, China announced some crazy build-out plan of like 150 nuclear facilities over the next decade. You could get to a point where demand exceeds supply, and in these types of commodities, the inelastic demand, as we're seeing with natural gas in Europe, you could see some crazy prices. The only thing that makes me a little uncomfortable about the trade is everybody understands it.
Yeah, no, for sure. But I like this trade because it is extremely forward looking. I mean, this is like a Bored Ape trade for the physical commodity markets, if you ask me. This is really forward looking because, and I'm going to take from your outline that you provided, is that utilities consume around 180 million pounds of uranium a year. Mines make up about 125 million pounds with their production, which leaves a 55 million pound shortfall, roughly, of excess inventory that is sourced from the markets, right? And the inventory, like you said, is not going to be there forever. You've got the option of sourcing it from only 6 countries, really: Kazakhstan, Canada, Australia, Namibia, Niger, and Russia. But what Sprott is doing now is sort of bringing uranium into the mainstream by creating, at least for me and for you, a price point. Right now, we've got price discovery, whereas if you would have asked me where uranium is trading, I would have had to get, I don't know, the Wikipedia page, the newspaper. I wouldn't even have known where to look. So talk to me about how we can maybe get to the point where this becomes more mainstream. That's what I'm kind of looking to the code to crack. Like, how do we cut through the nation's fear of nuclear, and will it ever be practical? That I think is the biggest question to this whole trade, because it should become an obvious alternative energy source given the attack on fossil fuels. Tell me your thoughts on that, dude.
Yeah, lots to unpack there. I would start with Sprott and their activity in the market. Your numbers are roughly correct: 180 million pounds and maybe 125 of production, and the cost to get new production online is, like we say, in that 60 to 70. $70 a pound. Sprott, I just pulling them up on Twitter as you were talking, they have sequestered an incredible 88 million pounds of uranium just since they started buying. And just to fill people in case they don't know, Sprott is doing an at-the-market offering, and as long as the price of the Sprott Physical Uranium Trust is selling for a premium, they're issuing new shares, which is then used to buy and bid up uranium. And so it's a bit of a delicate dance. If they issue too many shares and then the Sprott Physical Uranium Trust sells for a discount, they can't issue more. But if they bid up uranium, then the Sprott Physical Uranium Trust could sell for a discount. So this is a long-term play. I think the quick, fast, easy money of the early excitement of the Sprott first billion-dollar ATM has made its way through the market. Prices have consolidated around the mid to upper 40s, but they're just going to keep churning away, buying and sequestering pounds. And at some point, something has to give, you would think.
The market might very well come to them. I mean, I got a feeling that that's their plan, right?
Yeah, and to your point, this is the precise objective of Sprott, and God bless them, that they are trying to make the uranium market more efficient so that speculators can transmit market signals to producers and consumers in the same way that there's far more notional natural gas traded than there is delivered, because people want to be able to express an opinion about where the price of natural gas should be. And to your point, prior to Sprott coming on the scene, there was very few liquid, accessible opportunities for pension funds, hedge funds, money managers to express that view. And to the extent that Sprott is providing that service to the market, more power to them. One of the countermeasures of that, though, is broadly speaking, when commodity markets become more efficient to trade, the long-term trend is the price of those commodities goes down as people are able to hedge, as people are able to prepare for seasonality and pre-buy and things like that. The efficient market hypothesis, basically, which is as at least as applied in this context, is that in the long run, Sprott will make uranium cheaper than it would have been otherwise. Doesn't mean that it's going to be cheaper than it is today.
I want to just talk a little bit about how we get over the fear, the danger, this is a bit exploratory and not necessarily a direct trade. But to me, if we're going to, Sprott's going to be right, we're going to have to break through the fear of Chernobyl and 3 Mile Island and Fukushima and get rid of all that stigma. Is it even possible? What are your thoughts on that? Like, can we, how would we go about that? What does that process look like?
Yeah. So first of all, that is a great question. And it is very relevant to the trade, because as a trader, if you can see those signals materialize, you say, hey, these are the 4 milestones I'll need to see, and I know it's a go, and then you could get comfortable with the asymmetry of the trade and position sizing and things like that. So I don't think it's an exploratory question at all. I think it's a very relevant one. So you could look for milestones. Illinois recently decided to extend the life of a couple of nuclear power plants as part of a budget process. One to watch would be this nuclear facility in California. If they go through with closing it down, gee, that tells you something. By the way, Germany is facing the same decisions. China is going to be building out, so there's lots of flow here. But to your question, how do we get over the stigma? Ultimately, there's 3 sort of verticals you need to consider as you ponder the relative acceptance of nuclear. 1 is technology, 2 is politics, and 3 is financial. There are no technical challenges to safely expanding the nuclear power fleet. For all of the fear mongering that organizations like Greenpeace bathe themselves in, there is no safer, long-term, grid healthy, baseload power generating technology than nuclear power. And people always reply in our comments, well, what about the waste? Handling nuclear waste is a solved technical problem. It can be done. It's not a challenge. It's political. You don't want to do it in Yucca Mountain. Well, you could do it in Yucca Mountain, but Harry Reid was a senator from Nevada, and he put that project on ice. But don't tell me it's a technical problem. So if you're inventing technical solutions to global warming that require the coupling of 3 or 4 miracles, when you have a solution sitting on the bench like nuclear, don't tell me it's a technical challenge. It's a political challenge. And so you'll see the political tides turning. So in Europe today, there's a move to label nuclear as green. And even in some cases now, natural gas as green, because they're seeing the hard way that when you short the country of natural gas and you got a big giant pile of coal right there, and your choice is, I'm going to heat my house and kick out a few more molecules of CO2, or I'm going to freeze, the choice is easy. And so the nuclear production, uranium supply, nuclear waste, these are all solved technical problems. The solutions exist. And there's even more innovation, of course, with pebble-based reactors, and the newest generation of nuclear power that we would build out would be even safer than the ones we have, because the 3 Mile Island accident, which by the way didn't injure anybody, that accident really spooked the industry, and they went into overdrive on new safe designs and all this other stuff. And so this is a political will issue. So you have to watch the politics. A key sign for the politics include the California plant and whether Europe labels green nuclear energy as green.
Very good. Well, that clears it up. That's a big. That was really eye-opening idea there, where when you can say to them, don't tell me it's technical because we've got that solved, right? That to me is the essence of it. So that gives me hope, right? That gives me hope that eventually the political veil is going to have to somehow get taken down from the nuclear option, given everything that we're doing against fossil fuels. So Mike, let's talk about what's going on in the markets right now, because it has become very political, it seems to me. 1 week into the Biden reappointment of Powell, he comes out and he's talking about, that transitory is dead, and we're talking about altering the taper and potentially tightening. Markets have taken that as a signal as the punch bowl is being taken away. Commodity markets have backed off. Crude oil has come back off hard, about 15-20% off the highs. This to me is the back and forth of the trade, right? It is the commodity markets bubbling underneath with natural demand and decreasing inventories, tightening spreads, backwardation, etc., versus the political side that says, hey, this stuff that we're doing might be causing this, it might not, but we got to figure out how to stop the commodity markets from going up in our face. How do you think, can you speak to that a little bit? Like, that to me is the back and forth of the commodity trade, right? We're all cheering at the highs. The politicians are ready to knock the price down. They've done that. What's our next move? For me as a trader, I'm looking to buy it because I think the commodity story reasserts itself. What do you think as a scientist and somebody that's just sort of navigating the space in a different angle?
Yeah, I think you have to look at the fundamental drivers. So first of all, if we take a step back, yeah, oil is off from the highs. We're the $115 off the lows from March of last year. As artificial as those lows might have been, the move in oil and gas has been substantial. Nothing goes up in a straight line. I keep coming back to, where's it going to come from? So if you look at the capital expenditures of the majors, they might be up slightly over last year, but they're nowhere near where they were in the go-go days. Josh from Bison Research, his last name is escaping me. He's put out some pretty fascinating pieces questioning whether OPEC's excess supply does even exists. I just looked him up. His name is Josh Young. I want to make sure I got his plug out for him, because he does some really great work at Bison Research, and he was early on this, saying this excess supply that OPEC claims to have might not be so real. If you just drill down into Russia, they're not doing near enough exploration to replace the reserves. Neither are the majors. And so if you're cutting capital, here's the thing about commodities, which makes them fun and makes them frustrating. It makes them exciting. It makes them volatile. The supply and demand doesn't just get turned on with a switch. These are actually asset intense, low return on capital projects that require huge engineering and technology prowess to even pull off. If you mix in the slightest of economic uncertainty, capital freezes up. So I would point you to an interesting situation that's developing that maybe some of the viewers aren't following so closely, but what's going on in Peru? With the copper mines, left-wing government coming in, sort of seems to be embarking on all of the classic steps of nationalization. Then you have to study whether such a government could survive, and will the leadership be impeached? But commodity investors and companies that specialize in the space, they abhor uncertainty. So if you don't know what the 20-year outlook for your billion-dollar investment is going to be, maybe you take your time and do a bit more study before you move from engineering to construction. Because you spend $1 billion, you dig a deep hole, you get the mine operating, and then suddenly the rules change, and the royalty share to the government goes up, or the taxes go up, or your license to operate gets pulled, or protesters show up at the gates and burn down your workers' housing complex, which is what if you go into Peru, you are going to see, I believe, if things don't resolve there quickly, substantial pressure on copper supplies, just at the point where we hope to be at the sort of beginning of the exponential curve for electric vehicle adoption. And so those types of constraints is another thing we think about. We've already talked about arbitrage. We love arbitrage. We're going to be putting out a piece after this interview. The working title, we love titles here, but the working title is Herbie Spoiled the Party. And there's a really great book written in the early 1980s called The Goal. And it's a novel, but it's really sort of the Bible for running a business in heavy industry. You have to manage to your constraints. And, if you're talking about huge billion-dollar projects and suddenly you can't get copper, that throws a wrench in the whole supply chain. And so we look for arbitrage situations, and we look for situations where growth and or supply shocks create new constraints that the market doesn't quite see. And then we try to highlight those and feed them to traders like you so that you can have that as an input into your sizing and your speculative process.
Yeah, no, that's perfect, and I love that. I love that you highlighted the copper markets and the sort of tenuous nature of the copper production from South America. Copper to me has been one of the most difficult parts of the commodity trade post lockdown because copper got right out ahead of everything, got through 10K. It was a lot of sort of went along with the pushing the electronic vehicle narrative. The whole world knows we're going into this, big EV, power curve, as you say, with limited copper supplies. And I think to me, that's why copper has been sort of hanging in here, not far from 10K, near the all-time highs, as other commodities pull back. Because as you say, if the supply is going to be limited looking forward, and we're really going to push into the ESG movement, well, then we're walking into the copper hardware store, and there's not a lot on the shelves, right? So do you think that the cost of input slows down the ESG movement? Or do you think that it's like, no, it's government money, it's taxpayer money, they're going to keep plowing away as hard as they can to get this on the tape? What do you think about that?
Yeah, so maybe let me reverse and give you a quick signal to look for. So one of the things we try to provide our readers is what are the milestones that we talked about earlier? What could you look for? One of the companies we follow a lot is a Canadian mining operation called Teck Resources.
Yeah.
And the symbol on the New York Stock Exchange is TECK. We have no position, just full disclosure. But they have a huge new copper mine they're trying to bring online in Chile. It's called QB2, stands for Quebrada Blanca Phase 2. It's in the process of coming online. They're sort of past the apex of maximum spend. If they start to see local challenges to QB2 coming online, and they start to slow down the turnkey of production, that's going to be a huge signal that that things could get tight in the future, and something as a trader, which we're not, I would be keeping a close eye on. So one of the things we like to do for our readers is to point to unique and interesting situations that might not be on the radar for signals and inputs into how they think about a market. To your broader question about the boomerang potential of ESG, I think a lot of it depends on how cold it gets in Europe this year and whether the supply chain whips that we worry about potentially materializing because of the high price of natural gas, whether those begin to show up on the shelves in the U.S. As well as we approach holiday shopping season. It's, again, one of the things I try to explain to my friends in the ESG space is we agree on the desired destination. We're just arguing about the path function. What's the trail look like? Are we going to take the smooth trail with very little, height gains and small hills? Or are we going to take the trail where we have to do a walk across a rope bridge over a fast-moving river and hope we don't slip? Right now, the ESG movement is hanging on to that rope, hoping it doesn't slip, hoping that it gets warm in Europe, hoping that they don't see rolling blackouts, hoping that this fertilizer crisis somehow, through some miracle, does not manifest itself in higher food prices in the emerging economies. And in fact, I think if you had a cold enough winter, we said this in one of our pieces, the future of the EU could be in jeopardy. There's some real serious sort of, if you do a Monte Carlo simulation of potential outcomes with probability inputs, there's a few scary outcomes on the board that nobody's thinking about, including the dissolution of the EU, as every country says, forget this, we're going at this for ourselves. Which is what China did when it limited phosphate exports and really put a wrench in the fertilizer market. And so we're seeing this nationalistic movement in the commodity space. That's always been that way. As long as there have been copper mines, there's been people protesting the copper mines. Let's not kid ourselves. There's nothing new about this. If the combination of factors that we see evolving in Europe manifests in a true calamity over there, there could be some pretty, fat tail risk, 5, 6, 7 sigma event type outcomes that would surprise people coming off that board. But in the U.S., we're still largely okay because we have such a rich abundance of natural gas. But we do import a lot of critical goods, and they're sitting offshore in these boats today. So we'll see. It's a complex situation.
Yeah, it is a very complex situation, but it's amazing to me how, as a commodity trader, you see them forcing the ESG trade on the tape. And, you see the commodity markets go and take off in response. And then you see the political wheel go in motion and say, hey, we've got to stop these commodity prices from, and it's just like, it's like they're trying to be the cause and the effect of the problem. So for the trader, for me, that's the hardest signal to sort of, the noise to kind of weed out and figure out what the commodity markets are really saying.
So here's a fundamental axiom that you can use as a trader. All American politicians in particular, but most politicians in the world and all American politicians manage to the optics, not to the outcomes.
Right.
And so you can go broke betting on the competence of American politics these days. Our political system is really broken, ineffective, can be counted on to do the stupidest thing possible at every turn. And I say that in with all due respect. But for example, with Europe starving of energy, literally, we have senators from the sort of progressive ESG crowd talking about shutting down LNG exports from the U.S. because the price of natural gas in the U.S. is up 100% over last year. Yeah, it's up 100% over last year. It went from $2.25 to $5. Okay, how would you like to be paying $30 a million BTU natural gas? Now that is a very important signal. Imagine if that did happen here, what our government response would be. It would be pretty collectivist. It would be straight, price controls, all of the worst decisions that everybody makes. Already we're seeing jawboning from the same administration that began office by limiting fossil fuel production. You're seeing them talking about, greedy corporations and profits and, as though they had nothing to do with the situation we find ourselves in. So exactly. You, as a trader, need to always assume that politicians will manage to the optics.
I love it. And I love it because, they took that, they sort of never let the crisis of the Omicron variant go to waste. If you look at it, what just happened, right? It was like, Omicron variant came around. Let's jump on that deflationary bandwagon, right? And let's push that as far as we can because it's working for us here in the commodity space. Right. And then you send Jerome Powell out to say that we're going to tackle inflation. And it looks like, they're back in, they're back on the control again. Right. Oil's falling. They're saying, hey, you know what? We might do more of an SPR release. Right. So it's really this whole trade for me. And that's why I love your approach, June, so much is the trade to me is managing the back and forth between how the politicians manage the optics, because we know damn well that if natural gas gets out of the headlines or gasoline gets out of the headlines for 2 or 3 weeks, we're going to be back to selling electronic vehicles again, right?
Yeah, and these things, in the end, it's fascinating, it's frustrating, it's interesting, it makes you laugh, it makes you shake your head, and ultimately, all politics is kind of local, and that's why you have U.S. senators talking about halting U.S. LNG exports. If you just think about what do you think the price of Dutch TTF goes to if the U.S. can't supply LNG to the world these days?
$100.
Oh, easy overnight, and then you're going to talk about a true catastrophe. So there's two ways to get to the right answer: the easy way and the hard way. And we can point out what the easy way is or what it could look like. Obviously, we're not so arrogant to assume we know everything. But there's some broad strokes where you can say a policy of natural gas replacing coal, supporting nuclear energy, while you're building out wind and solar with the appropriate amount of grid storage so that you don't destabilize things, is probably a smarter way to go about it than what we're doing. And so better is better. We close the piece with better isn't better when zero is the only answer. You can go to zero fossil fuels overnight. There's just going to be a lot of dead people.
Yeah.
And we start with a human first mindset where our philosophy is how do we provide the most equitable. By the way, the conservatives listening, we think that there's many issues with the way in which we distribute that energy today. It's totally unfair. Income inequality is destabilizing. There shouldn't be a billion people in the world that don't have food, water, or housing. We could solve that problem today. There are no technical challenges. It's just political, just like with nuclear. We choose not to. We wrote a piece about what if electricity were free, and one of our sad conclusions were a lot of poor people wouldn't benefit from it because water's free today, and a lot of poor people don't have water. So it's not like we're just right-wing conservative drill baby drill type people. We're all for removing coal with natural gas. We're all for nuclear. We're all for renewable. We're for grid storage. Even in the car space that you just talked about, we think plug-in hybrids are a better transition technology because it uses less batteries, which means you rely less on nickel, copper, lithium, and all the green metals as they're trying to relabel themselves for full battery electric vehicles. So, there's thoughtful, smart bridging approaches, but it seems like we're hell bent on doing it the hard way.
Yeah, exactly. But the real, I guess, to come full circle with this is that we're going to have to keep, watching the ebb and flow of, the commodity markets bubbling up underneath with tight supplies and real demand. The political side continuing to be pushed to the ESG trade more and more, and it's going to be managing that. But my most important thought about this whole thing that you gave me a lot of confidence in with this conversation is that the commodity market right now is still a bubbling, sort of smoking volcano and has not started erupting yet. And I'm very much of the mindset that we will probably see a cold snap in Europe that is going to make the volcano explode. And we are probably going to see sort of, $6 or $7 gas here in the United States. And that is going to be another sign of the volcano exploding. Like, people don't realize what happens when natural gas goes. They see what just happened when natural gas went from 2 to 5, but have they seen 2 to 10? Right. And so I'm trying to get my clients, my listeners and readers prepared for, be very careful because the volcano is still only smoking. I don't think that it has erupted yet. What would you think about that?
Here's the analogy I would make and maybe help you build a framework around it. You need to view sort of the lockdown politics in the same way that we view central bank policy for normal equities. And so absent this new variant, I don't think we would have seen the oil pullback that we've seen, because that's truly the only deflationary countermeasure that is effective for derailing what otherwise was a pretty strong commodity train. And so you got to look at Fauci the way you look at Powell. And same thing in Europe. Like, you can look at natural gas producers, but in reality, Putin's going to determine what the price of natural gas in Europe is for now. And so Putin is the Fed chair for natural gas prices in Europe and Asia.
He's a hegemon, right?
Exactly. And so, the commodities trade, it might be temporarily derailed by the deflationary shock of another partial lockdown, assuming they're successful. There's a risk of that, which we observe, which is that societies are kind of getting fed up with the whole lockdown concept. And so if you start to see governments getting toppled as populations protest the lockdowns, and maybe you start to see like what we saw in Chicago, where the police union seems to have prevailed over the mayor in their little vaccine standoff, mandate standoff. We've written about that. That's another political win you have to pay close attention to, regardless of your beliefs about it, regardless of your personal choices. You have to be acutely aware of the lockdown intentions, effectiveness, supply chain issues that causes. But I think that only postpones it, Tony, because what we'll see is when we reopen again, it's going to be even worse.
Exactly. So we still have, it's like we're still being held back from going into a wide open economy, free air travel, full economy, et cetera, et cetera. And if you want to believe, like, I guess I want to believe that we're going to go back to that, I still see a massive inflationary leg to this trade. And so that's why I'm not willing to say, oh, okay, there's another variant. I'll just give up on the inflation trade because this is going to stop it dead in its tracks. As we all know, commodity markets don't work like that.
It might just affect your timing, your position size, your hedging, all the things that we have no expertise in. But for us, the model on commodities is lockdowns are the central banks. And because it's a straight toggle, Tony. If you lock down, you get a deflationary pocket. Then governments overreact and they give money to the people, and then by the time they open up, they have all this extra cash on the sidelines, and boom,
and here we go again.
you get another go of it. And like all of these crises, I saw somebody on Twitter make the analogy of after 9/11, each terrorist attack gave us a smaller dip and a quicker recovery, and eventually, when a bomb goes off in a country post 9/11, it didn't really affect the markets. As this virus plays out and we get, hopefully, more and more contagious variants that are less and less severe, and this sort of becomes an endemic as opposed to a pandemic, we're going to see less and less market reaction to whatever Fauci is saying on ABC News tonight, and more looking through that news and getting ahead to what markets are supposed to do, which is price the future. But right now it's still, as proven by the latest reaction to this Omicron variant or whatever they call it, it's still a big input. You can't ignore it, and we sort of until that changes, Fauci's driving the bus on commodities.
That sounds like the case. I think that we can accept that. I'm going to continue to watch the spreads and watch the commodity tightness underneath the markets and see if that shows its face again. If there's anything that this whole conversation around inflation, around supply chain kinks, around energy is life and making your environment work for you, you have turned me into a more serious from a very casual prepper. And I want to sort of change and pivot into that now. While we're still fresh. And, there was a time when I had mostly sports equipment, guitar cases, and maybe a couple of bottles of liquor down in the basement. And now there is a very serious set of shelves, with several weeks or months supply of the things that we go through in our home. And that is largely due to your advice of sort of, expanding the working capital of your inventory of your house and expanding your inventory. So what has, tell me, number one, there's two ways I want to go with this. Number one, just give your spin on why you do it and how you do it. And number two, I want to sort of, anybody that does it hasn't prepared for a situation where they're going to go a long time without supplies. I think the world right now should convince you that you should probably start thinking a little bit more about that. So how do we get never preppers to sort of say, you know what, maybe a couple $100 worth of stuff in the basement isn't a bad idea. So let's go ahead and riff on that.
Yeah, I have a distinct memory of talking to you in the early stages of the lockdowns from last year, and you were heading into Costco, and I was screaming at my phone at you to hammer the bid. I said buy. I said buy indiscriminately.
Yeah, you were like, get 6 carts and go back to the car 5 times.
Yeah, and we had a good laugh about it. But in reality, we wrote a piece called "One Flew Over the Prepper's Nest," and where we confess that the Doomberg team are semi-serious preppers. So I don't want listeners to think that we are. We've built some underground bunker and we've got 10 million rounds of ammunition and 50 years worth of food. We come at this from a very practical perspective. And in that piece, we described how we view our homes as factories. And the main product of our factories are the health and well-being of our families. And there's 4 inputs into your home. There's electricity, water, heating, fuel, and products and services. Amazon shows up a lot at my place. And the 2 outputs are sewage and garbage. And you need to be mindful that those 6 variables could get turned off. And so our reaction to just-in-time inventory is as follows. If the retail outlets and online facilities from which we procure are only going to stock 3, 4, 5 days worth of inventory, and the 3, 4, 5 sigma event could knock that off for more than that time, then we need to move the working capital from their shelves to ours. And we have a lot of philosophies, which is eat what you store what you eat. Comfort matters. Don't go too crazy. We kind of plan for 30 or 45 days of excess supply. The simplest thing you can do is double the size of your working pantry in your kitchen. In a way, it serves as both insurance and a free hedge against inflation, because all the stuff you bought last year is more expensive now. And so one of the analogies we use when we say it to people that makes sense, which is I pay insurance on my home every year. I've paid insurance on my home every year I've had one. So have you. At the end of the year, when my house hasn't burned down, I don't bemoan the fact that I paid that insurance bill.
Right.
And so why wouldn't I happily pay my insurance? Well, the home is a physical entity. It's an important asset on my balance sheet, but so too is the health and well-being of my family. In fact, the health and well-being of my family is way more important than the home that I'm paying. Pick your favorite number, $100, $150 a month to insure. So if you're willing to insure your home, why aren't you willing to insure your family? And so we're not talking about buckets full of rice in Mylar bags, although I do have those. We're talking about doubling or tripling the working capital of your fridge, buying stuff you normally eat, but having twice as much of it around, thinking about all the consumables in your home like a factory manager. So, I take pride in how well organized our home is and how happy the home is and how well run it is. We encourage our friends and now our readers through this piece to think about doing the same. It's not about preparing for the apocalypse. It's about shaving off edge cases from your risk management profile, just like a trader would do.
Right, exactly, and that's why I like sort of bringing it into the mainstream a little more, because I don't think that there's anything radical about it, and I think that people will thank you, most profusely if you run into that 2 Sigma event or 3 or 4 Sigma event, and you were able to say, probably want to stock up the basement with some more, cleaning goods, plastics, medicines, more food, et cetera, et cetera. And now when everybody's out there in a panic, you don't have to be.
Exactly. And that's one that's really important. And if it's the only thing that people do that are listening, if you have serious prescription drugs that you need to maintain a healthy life, have some working capital invested there. The pharmacies might close. Right? What are you going to do in that case? So everybody's medical situation is unique, but I ran into this in my personal life through a family member that we had to help because the shutdowns, closed a certain border, and that screwed up some health plans that they had. It's a serious issue. The supply could go away. Have a little bit of extra. It's a little bit pricey up front. The consultants will tell you you want to run a lean operation. That's fine for a widget factory. That's not fine for my family, at least mine.
Yep. No, I like it. And it just shows a tremendous amount of care. And, it just shows that you're paying attention to what's going on, both, within your biggest and most important asset, and as it relates to everything that's going on in the commodity markets in the world. I think that we've probably covered the 4 topics that I wanted to cover really, really well here. And I want to just do a rundown, just a recap. So, we've still got Biden energy policy continuing to clamp down on fossil fuel supplies. We've got the second dynamic of the same administration trying to help use the Omicron variant to be the deflationary force, that helps them in the energy price side. We've got a bubbling situation across the pond because they're basically made Vladimir Putin the price maker of natural gas because they haven't supplied it themselves. And now, full circle, the whole world, because of this, has got to take a look at this uranium trade. And so I feel like we're leading people in the right direction. I'm not going to say it with 100% confidence yet, but I think that if you and I have a conversation in 3 to 6 months, that a lot of the things that we spoke about will be even more relevant. So I look forward to a follow-up as much as I do,
Sure.
as much as I did this conversation, because my favorite thing is the revisit, right? Let's look back on what we said. Let's look back on to see if we gave good advice. But I'm going to let you close up in a second. But my line of thinking, broadly speaking, is still, due to this situation, the volcano of goods shortages, inflations, and supply chain issues is still smoking, and really ahead of us has the potential to erupt. And I want to be really prepared for that. How would you close up today's convo, dude?
I would close up by saying the very best way to get an edge on that follow-up conversation is to head over to doomberg.substack.com, sign up for free with your email. Then head over to tgmacro.com and get the best market analysis from a fantastic trader in the business. And if you have Doomberg and you have TG Macro in your reading routine, you're going to be very well informed for whatever happens in the next few months.
Man, I'm really honored by that endorsement. I really am, because I think we're a pretty good team. I can tell you that you have helped my trading operation massively. I can tell you that I try to read the Doomberg Substacks as they come out, as they hit my mailbox, because there's so much relevant information in there that is so liberating for a trader. And that's the important thing here for me. And I really have to really hang on that point, because as a trader, you've got all of these prices flying around in your face. You've got positions getting away from you. You've got positions that are crushing you. And you've got to be able to lean on what you know to be true as the sort of backbone of your thesis. Now, the trading positions are going to, we're going to go in and out of trades, but being armed with this knowledge has been, among the best things that I've done over the course of this year. And I'm grateful to you for supplying it all in such a brilliant form, the way you present your content. And I am looking forward to reading every Doomberg Substack that you put out in the future. Thank you so much for being with me here today in this conversation, Doomberg. This was fantastic.
Thank you. And thanks to the Real Vision team for letting us do it.
The Real Vision team is the bomb. You're the absolute best. Lastly, just give us your last credentials, where we can find you on Substack and on Twitter before we depart.
Yeah, doomberg.substack.com. Sign up with your email. It's free. And on Twitter, you can find us at Doomberg T. Just add a T to the end of Doomberg. The T stands for terminal. Doomberg is Chicken Little Gets a Terminal. That's our sort of brand moniker. And love being here. I'm happy to come back anytime, and hand in glove with each other, brother.
That's right, my man. I don't know what else we can do for our clients. That is the place to subscribe. That's where to follow the Doomberg Chicken. And we're going to come back in 3 or 4 months and see how we did on some of these conversations.
You bet.
Thank you very much.
Hi there, visionaries. If you want to get more of these kind of insights, join our community over at realvision.com. There you'll get unbiased insights and exclusive access to the very best, brightest and biggest names in finance. Be a part of our community of lifelong learners. See you there.
For me, the best part of my Real Vision journey has been the chance to refine my own investment framework through a series of conversations with brilliant investors in every corner of the globe. In this series, I want to try and continue my education by digging deeper into the lives and careers of my guests to try and learn how they think. I want to understand the experiences that have shaped them, the failures they've bounced back from, and the lessons that those failures have taught them. And I want to break down their success to find out what sets them apart. I'm not looking for trade ideas or guesses about an unknowable future, but rather knowledge accumulated over the course of careers to try and make me a better investor. And I want to share those conversations with you. Several years ago, I was introduced to my guest today by mutual friends who'd entrusted a significant portion of their savings to him. This man, they told me, invests in a way which is not only unlike the methods employed by 99% of money managers today, but also with an integrity and a methodology which is a throwback to a time which has sadly almost vanished. In the intervening period, as I've gotten to know my guest better, I've spent a considerable amount of time trying to persuade him to sit down with me and share both his experience and his investment philosophy with the Real Vision audience. Sadly, each of my invitations has been met with a very polite but very firm no thank you. This was no surprise to me. My guest has never before been interviewed, either in writing or on camera, and for good reason. He's a private man who prefers to spend his time reading and thinking, and who invests far from the spotlight and with no care for either mainstream opinion or consensus strategies. A year ago, I finally got to meet my guest, and I spent an evening I will never forget, listening to him talk about how he sees the world and how he thinks about the discipline of investing. That meeting made me more determined than ever to try and persuade him to break his silence and give others the chance to learn from him as I'd done. Now, 3 years after I first approached him, he's very graciously agreed to talk to me in front of the Real Vision cameras, and so I'm excited to be travelling to the Swiss Alps to discover how his framework has evolved over the years and see how he looks at the process of investing that which he considers permanent, irreplaceable capital. So please join me for a conversation with Tony Deeden. There are going to be people that watch this who know you, and they're probably sitting there thinking, why the hell is Tony Deeden doing here? And then there are going to be people that don't know you who after this conversation are going to go, why the hell do I not know Tony Deeden? So I know this is the first time you've done one of these, and I really appreciate the fact that you've agreed to do it, because there's so many things I want to talk to you about. As I love to do, particularly given the lack of visibility that you have, is to give people a sense of your background, because it's an interesting one, it's a varied one, and it's taken you all over the world. So perhaps we could start just by talking a little bit about you and your life and your background.
How much time do you have?
We have all the time in the world. So you left Greece at an early age.
I left, yes, when I was a young boy, and I lived in America for nearly 30 years. First in California, and then for many years in Houston. And I think I became as American as one could possibly ever become. Even though for all these years I never really felt quite at home there. Not that I feel at home anywhere else, frankly.
Right.
But then I was married there, I had a family, and I had a wonderful time in the United States. I've met some of the greatest people I've ever known in America. And I learned a great deal. And many years ago, I moved back here to Europe, and I live in Switzerland now for many years. So I have traveled a lot, mostly to learn and to observe. But I have not traveled as much as you have, for example.
Well, I wouldn't wish that on you anyway. I think you've got the balance about right.
There's nothing extraordinary about my background. I found myself in this work quite by accident. Back in 1985, when I was asked to help a family with their investment affairs, the passing of a husband or other situations, and one family became two and then three, and etc. So I found myself being an investment counselor without having the preparation or the background, or I've never worked for a financial institution, a bank. I had to learn a great deal by the sheer desire to do the right thing. So my background is not as extraordinary as you make it sound. I think you perhaps flattered me a bit with your introduction, but when you are an investment counselor to a family, and in essence you are asked to provide guidance for the entire wherewithal this family has, you come to the inevitable observation to start with that this is all the wealth this family possesses, and no one is ever going to give them any more.
Yeah.
And there's a sense of irreplaceability to this capital. So you have to start respecting it, respect the fact that it is really irreplaceable. It represents a lifetime's worth of savings, or that is that you must avoid the kind of error that would put this family out of business. And you also learn fairly early on something that takes men far longer to do. That is, it's easier to actually make money than to keep it. Not merely on account of external issues such as inflation, taxation, but also internal things, error, imprudence, and other such factors. It is a kind of different world than a fund manager has, where a fund manager, in essence, has an undefined, unlimited amount of capital at his disposal. And if he loses part of that, he can get others by changing his policy and his investment objectives to something more desirable at the time. I find fascinating the fact that the idea of family offices has grown so much in the last 20 years. When I was younger, yes, truly there were some very wealthy families that managed their own affairs, but it was very rare. And I often thought about the reasons that contributed to this, and I cannot help but say that perhaps one of the reasons is that the investment management industry and the banking industry have failed in their obligation and ability and to protect and preserve the savings of those who have accumulated some.
So what was it about you back then that led this first family to come to you and say, please help us manage this wealth?
Well, there was a fellow who is past, he's long gone now, who was sort of like a mentor to me. At the time I must have been 30, say, or something like that, and he was in his 70s, and he liked the way I thought. I was on the board of a finance company, and I was very curious about matters of money, but I was always more interested in what can go wrong than what can go right.
Right.
And I always thought that what could go wrong was not necessarily of a quantitative nature, like the stock market or the bond market, but the kind of decisions that one makes and the impact of those decisions, both in the long and short term, on the whole. So he's the one who originally made introductions to one or two families, and he's the one who sort of pushed me to pursue this.
How did you begin to form the framework that helped you invest? Because I know that's changed and morphed over the years, but how did you begin to think of investing? What was your first perspective on it?
Well, initially I did not know much. I erred on the side of inaction. But then I made some friends, particularly with some large firms that I knew at the time, and I learned about this idea of prevalent among investment management firms about seeking to understand the investment objectives of their client and risk parameters, so to speak, and designing some kind of portfolio that is suitable to their needs. At the time, this sounded really wonderful to me because it was very structured and it made a lot of sense. I've since figured out that it's nonsense.
Right.
I had one or two friends in among a Swiss bank in New York, and I went to them for help. I figured out how securities trade and how to do this, how banks settle securities, and delivery against payment and this sort of thing. And then I came across this idea of value investing, the Graham Dodd and Warren Buffett type of things that every American with, comes across from time to time. I really was not aware of anything other than, and I began reading some of these great investors and others. I was fascinated with the idea of value as defined by such value practitioners, only because it made sense. Theoretically, but it was a different world. And then came the crash of 1987, you remember, which did not really affect me a great deal because I had no exposure to the equities market. But then it created opportunities to invest, to deploy capital in 1988, and then you had these great opportunities. I had a great opportunity to meet firms at their genesis, what later became the technology issue. But the problem is that I always knew I was operating in a vacuum of sorts, without really guidance as to the fundamentals of things. I always wondered what was the nature of money. We measured our wealth in terms of money, but I couldn't figure out what money was in itself. I had questions about really fundamental things about the nature of interest rates. And then I discovered economics in the Austrian tradition, in the classical liberal tradition, and I began reading. And it changed my perspective a great deal, not in that economics makes you a better investor, but it gives you a light with which to see the furniture in the middle of a room in the dark.
Right.
That's more or less.
Right.
I borrowed this from James Grant. So I became concerned with the the nature of risk, the nature of value for what it was. I became aware that the quantification that was largely embedded in the financial sector was not really necessary. And I felt that the only way to protect this capital, and I had this kind of portfolios that were standard back those days. They used to call them a balanced portfolio, if you remember. And I had defined their work around this idea of capital preservation back those days when capital preservation meant the austerity of a bank trust department. You are fiduciary and you do things from fear of failure rather than cognizance that it's the right thing to do. But the idea of owning bonds and recapitalizing the income and having a first-class collection of equities, for example, and then taking parts of this, what remains, and making some meaningful speculations in things that mattered, overall gave you a tremendous advantage. And so the results were wonderful, but I didn't really understand quite why. But I felt also that this idea of organizing an investment portfolio around the so-called unique special needs of each individual family was intellectually not quite consistent with reality. Because in essence, there's no need to shape an investment portfolio around a particular person's idea of risk, because people's idea of risk is not necessarily real. Risk to most people is the uncertainty of the unknown, or prices are going to go down or something like that. To me, risk was the idea of losing your capital permanently with no ability to ever recover it.
Yeah.
So I went to the 10, 12 families I had at the time, and I said, I've changed my view about investment management, and henceforth, I'm going to have one investment policy that I think is appropriate to all, and that is protecting and enhancing and deploying this capital permanently, with the only issue is that time preference. You have to have a horizon, you have to have a purpose to this capital long term. And they all said, okay, so we scrapped the old investment management agreements and set up new ones. I think there was a necessary growth and a change, because as you learn more things, you become able to acquire understanding about what it is you have, what it is you face, better than you had before.
What did that change in strategy do to your portfolios? Did you find it completely changed the composition of them, or did you kind of tinker around the edges, but realistically just kind of gradually evolved over time? Was there a sudden, okay, now we've changed the mandate, the portfolio has to change considerably?
Well, starting at about 1996, 97 or so, I never saw this as a portfolio in the sense that the word is used today. I saw this as a collection of assets in the form of securities having a purpose, each of the components having a sub-purpose of its own. When you start seeing it this way, you become completely uninterested in what others think about matters. The idea of having X% in industrials and Y% here and overweighting this and underweighting that is just complete madness. It doesn't make any sense. And any more than a car manufacturer thinks that he has to have X% of an automobile in glass, Y% in steel, and etc. It makes no sense. So every component has a purpose. It did change things somewhat, because it allowed me to focus on what I thought was value in the sense of irreplaceability. So you take irreplaceable capital and deploy it to irreplaceable assets. But bonds remain still the hardcore of the thing. The thing with bonds is that I had two kinds of bonds I invested in, governments and junk.
Right.
I never quite bought in the corporate world. Junk in the sense that it was not rated.
Yeah.
Back those days, in order to rate a bond, you had to pay money to the rating agency, and many small issuers didn't want to do that. So oftentimes you found issues that had 200-300 million in outstanding debt, unrated. And because of that, it sold, oftentimes it changed hands at incredibly good yields. Real yields, in fact. We had real yields back then.
Yes, I remember those days.
I think our children will never know what that is.
Yes, maybe so.
But then came this the period of 1995, 96, 97, where monetary policy has always played a role in financial matters. But all of a sudden, the monetary policy became the driver, and industrial activity took a back seat to financial activity. That was the beginning, I think. Maybe others would disagree on that about the timing, but prices of securities were going up independent of economic results or economic activity. And that's mostly in the United States, but the rest of the world followed along the American policy. And at some point, prices became untethered from the reality of the situation. And I saw this in possibly 1998. And I became certain that there must be an error. And the error must be either outside or it could be mine. I couldn't see the fact that the world had changed. And I went through a period of soul searching because I thought perhaps I was too old-fashioned. I had too many rigid ideas, and the world was changing. Remember, those were the days of Mr. Greenspan, who advocated a complete revolution in productivity and other such factors. And I asked myself, perhaps I'm wrong. Perhaps what I believe is wrong, and perhaps everyone else is right. And now it seems insignificant, but back then it was an enormous burden on me, because if I were wrong, that means my actions or inactions would have an effect on other people's savings. So I had to do something about it. What you do in these cases is it's sort of like when you get lost on the road and you don't know where you are. You may have a map, but the map doesn't help you unless you know where you are.
Right.
So you have to retrace your steps in some way and go back to the very basics and try to rethink the basic assumptions of what is real and what is not. Most of us, when we're younger, we want to believe the authorities. We want to believe the rating agencies. We want to trust government statistics or authorities of all sorts. And it happens as you grow older, particularly in a setting like this, where you become convinced that they all lie. And everything is phony and everything is false. And I mean everything.
Yeah.
Everything. So you go back and retrace your steps. And I did that. And I did that with some friends. And I rediscovered the fact that I was right. The whole economic system, financial system, rather, not economic, as we knew it was fault. That gave me a great deal of courage to acquire the kinds of things at the time that no one wanted, and sell off, realize a lot of gains that were gained in the previous 15 years.
Yeah.
And what people didn't want at the time was oil. It was copper, coal, gold, silver, and German government bonds.
Right. Yes.
So by the time the system came to a crashing halt in 2001, 2, 3, whatever it was, it became obvious that my sentiment about the relative value of these financial assets was correct. But then started a new era where we reinflated the system somehow.
Yeah.
And so all I'm saying to you is that we have gone in my own brief lifetime so far, 30 years of practice, we have gone from booms to busts to booms to busts. Now, if you are merely in front of a Bloomberg machine and you think that you can anticipate these matters and you can anticipate interest rates and foreign exchange rates, you're deluding yourself, because no one really knows when the next boom or bust will take place or where. But the problem comes in not trying to impress your customer, but trying to protect what he has spent years accumulating. How do you do that? That has always been difficult throughout the ages, but it has become phenomenally more difficult, nearly impossible, if you practice within the framework that you have been used to all these years. Think about it.
No, I agree. And you know, when you went through the soul searching period back in the late 90s, and you went away and you sat down for a weekend and you really went through every assumption that you made and stress tested it. First of all, to come out of that sure that you're right and everybody else is wrong.
Oh.
But it's that takes a lot of character, a lot of self-confidence, and a lot of real belief, like real belief. And you came out knowing that, and you acted accordingly. You essentially sold everything in your portfolios. I mean, that's taking action after a lot of soul searching, and few people would have the courage to do that. Your investors, your customers, obviously, they put their trust in you, and here you are coming back to them saying, okay, everything I've been doing has to change.
Yeah.
How do they react to that? And is that reaction, you've built up a very strong bond relationship with these people by doing the right thing over so many years. Do you find that making such a drastic change causes some of them to say, Tony's lost the plot? Or do people, having seen your track record, seen your performance, say, wow, this is serious?
Well, first of all, it is their capital and they have a right to find someone else to help them with. I have no monopoly on ideas. I think one or two perhaps did. But I think I have always been eager to communicate the framework, the foundation, the principles of the framework that motivates actions. In 1999, I worked very hard to make a speech to our clients at the time, and I wanted to show that the seeming prosperity that existed, because if you go back and look at everything seemed to be so extraordinary at the time, it was an illusion. And this is very difficult to see because so I wrote my speech and I borrowed from James Grant's, the title of his book, The Trouble with Prosperity, which he makes the same point. You have this apparent prosperity, but unless you examine its causes, you don't know to what extent it is real or it's an illusion. If you gave me your American Express card, I can go out on a buying spree and I can acquire all kinds of goods, and everyone can see how wealthy I am because I'm wearing wonderful clothes, I'm driving a great car. In fact, I'm adding to the GDP.
Right.
But no one quite knows that the money has been borrowed from your credit card.
Right.
And to the extent I don't have to pay it back, then it's real.
Words like integrity are thrown around like confetti these days, but I was captivated by Tony's framework and the clarity and the simplicity of his thinking. Tony is a deep-thinking, principled man trying to assemble a collection of assets which can not only endure, but also withstand the pressures exerted upon them by time and turbulence. And it struck me that perhaps this second definition of integrity, the notion of a soundly constructed, durable and unimpaired portfolio, has been lost in a world where monthly performance has become the holy grail, and investors' time horizons have been compressed, in many cases to the point of becoming a hindrance to effective money management. Tony's ideas around endurance and permanence of both capital and the assets selected to represent it fascinated me, and I wanted to dig deeper into how his framework evolved and how he thought about building such a collection of assets. You have this way of investing in permanence and endurance and things that have been there and will be there for a long time. So just, if you can, describe how you think about that and how you go about identifying companies and people that you would invest in.
In the beginning of the QE period, the global QE period, I became convinced that the system was going to destroy the nature of money in itself. Became convinced that the rules of the game had changed completely. When the rules change, the basic framework with which you make decision needs to change. You cannot, and no one really, I mean, remember back those days, post 2008, 2009, 10, 11. Back in those days, virtually every financial agent, not economic, wished that things would go back to normal. They thought that pre-2008 was normal, which is not too near the truth. But when the rules of the game change, the process with which you make decisions, the process with which you act, the value of information, the value of inputs must change with it. And I think that two things change. Not only the rules of the game change, but the expectations of people were not commensurate to the reality that existed. So I felt, as perhaps others did, that the time had come for me to hang my wings, so to speak, and leave the game. I would not want to participate in an environment in which I had to do things because they were expected, rather than I thought was the right thing to do. But the second most important thing that happened to me is that as a result of that, I began thinking about, if the rules of the game have changed enough, I cannot trust anything. If you don't trust financial accounts, if you don't trust ratings reports, if you don't trust the government, if you don't trust the press, if everyone lies to you, literally. It's sort of like going to a restaurant where everything on the menu is poisoned, but you're hungry. Right? You have to do something. And what you can do is exit the system. Just exit completely. But the second thing that mattered to me, if I am involved in a situation where honestly I don't know what is real from what is not, I have to start re-examining what is real, what is really real versus what is not. People talk about outstanding companies. The word is used often by value investors. But the question is, what is an outstanding company? People talk about good management. What is a good management? No one can really define that. People judge others and make value decisions with respect to so-called equities on the basis of the success of the stock price. Well, I began thinking about what is it that is important. And one of the things that I felt really, even though I lived in Europe at the time and I had left, in America, there's something extraordinary that takes place, and that is we in America, and I say we, are quite keen to like what is faster and what is bigger and what is better. So often growth for the sake of growth overwhelms our motivation and our actions. We think of growth stocks, we think of growth industries. We even use the word to grow earnings, which is to grow the company, etc. But what if these measurements were wrong? What if really what mattered is something other than bigger and better? The second monumental observation I made was that what really mattered was not that, but the idea of endurance, the idea of durability. I began looking at investments we owned that had a history of 100, 150, 200 years. And you ask yourself, how could they have survived that long? What were the ingredients that have contributed to their such permanence? Permanence is an illusion. It's not really a fixed word. There's no such thing as permanence in our world, but it's something we perhaps strive to. And I think endurance is a better word to describe what I'm saying. And all my life up until that point, I've been examining the idea of failure. Failure had been the failure on the part of others had been the principal textbook from which I learned what not to do, or how not to think, or what to examine or not. I began thinking of those who have survived the test of time. Again, as a way of a textbook, thinking of those ingredients that have allowed them to adapt to changes, survive wars, inflations, etc., the people issues, etc., generations, etc., and try to recognize those ingredients that allows a few to survive and endure. Because if I'm going to protect earnings or savings that have been earned in prior years for the future, whether it's for future consumption or a future generation, I have to deploy them in a manner that is consistent with such enduring characteristics. And so I began, that was a monumental revelation to me, that some people have survived and have adapted and have grown, and I have, but many of these companies are of course privately held, and they would never wish to be listed on the stock exchange. But others are listed, but only nominally, in the sense that they once had an offering some 50, 60, 100 years ago, and they still have a few shares owned by non-family members. And I discovered that I owned a few of these things for reasons that they were not purposeful.
Yeah.
So I began focusing on what endures and what is real, independent of the financial world, completely independent.
And so what did you find? Because we do live in a financialized world, and finance for finance's sake and investing has become all about making money, not necessarily capital preservation, not necessarily income. It's become, okay, which stock is going to go up the most in the next 6 months to a year, or whatever my time frame is. What did you find when you had this monumental moment and you started looking into these companies? What was it that you found?
The first principle I operate from is the idea of exclusion. I exclude whole swaths of things from my universe of things that I think that in the whole world there are probably 150, 200 listed companies that I would even consider owning a piece of. So it's a completely different way of looking at the world. Well, they were all in my universe already. Yeah. I think that when you start examining what it is you own, what happens if you own a ship and it's going down, and you're in your cabin and you have 5 minutes to get out, to get up to the deck you look at your possessions that are sitting in your cabin and you say, what's worth taking with me?
Right.
Not many things, is it? And this is what I did, in essence. Now, the thing is that if you do this with respect to your own savings, it's one thing. But if you do this in an institutional setting where other people involved, that's a little bit more difficult, because you not only must you deal with the idea of what is right with respect to the capital you are been entrusted, but you have to be concerned also with the expectations of other people, or the expectations of others. And this is quite significant, because I think that one of the things that is missing, and one of the things that I have discovered, is that there is a substantial distinction between people who are investors and people who are owners in businesses. An owner in a business is far more interested in its survival in the first instance than its necessary monetary value. No owner of a business wakes up every morning asking himself what he's worth.
Right.
He doesn't know what he's worth. He's concerned with his products. He's concerned with his employees. He's concerned with his suppliers. He's concerned with his customers. To do that, you have to have a time preference that is different from other people. If if you only own things that are quoted, you look at the quotation machine as to give you confidence in the fact that, hey, I made a great decision yesterday, this thing went up.
Right.
Okay. You have a falsity in your understanding. You're an investor. You rent something for hoping that it will go up. You are making decisions based on expectations of what you think other people's expectations are likely to be, based on their framework. And, an investor is really one who generally will acquire something hoping he will sell it at a higher price.
Mm-hmm.
And so all of the calculations and all of the pseudo-intellectual activity that goes along with it is based on this idea of price. Is this price high or low, relevant to what other people are going to think of it next year? What is it likely to be next year and why, etc. And owners don't do this. They're interested in building substance. They're interested in building the productive base of the company, recapitalizing the earnings or whatever. So the focus on wealth creation is different from that of an investor as an owner. But to be an owner, I mean, it's difficult for an investor to be an owner because you cannot have immediate liquidity. If you and I own a big farm with grow carrots, we can sell part of it tomorrow because we want to finance a trip
Right.
around the world.
Right.
And also there is another element that is of significance here, and that is that there's a very large gap in perception and temperament between an American and perhaps an English-speaking view of the world from, say, a continental European temperament and view of the world. I'm not familiar with the Asian world at all. I've stayed out of it. I can't do everything. The idea of leveraging a balance sheet to buy back your shares so your earnings per share can go up is completely foreign where we are, for example. It just doesn't,
Mm-hmm.
it doesn't happen. Yet it is a financial tool in America. The idea of having having a fragile balance sheet for the sake of a higher gold price doesn't lend itself to the idea of ownership. An owner is really very concerned with his balance sheet.
Yeah.
In fact, the balance sheet is perhaps more important than his income statement. His ability to endure and survive is based on the strength of his balance sheet and the nature of the assets on the balance sheet. It's not just assets, but the nature of the assets. And so, on account of the convenience of the English language, we speak in general terms about financial matters and equities, etc. But the framework with which different people in different countries make different decisions in general, on a generalized basis, is very, very different. For us, it's even more difficult because we have shareholders from some 30 countries around the world. All have perhaps a different cultural, a different business expectations, a framework. But the important thing is that they all are largely like-minded to what we aim to achieve. As I said to someone recently, it's akin to the idea of if you are a captain of a ship, it's nice to know that all of the passengers on board your ship are going to the same destination. Well, that's where they wish to go.
Right.
And that's where you started out going. And so they will judge you eventually by having gotten there rather than perhaps how long it took because you avoided certain weather or other
Right.
such things. By the same token, this like-mindedness, I have come to conclude that it is a necessary ingredient even in the deployment of capital. And that is, if I am interested in acquiring a 5 or 10% of your enterprise as a participation, I want to be absolutely certain that the motivation that you have as an owner and manager is similar to that of mine. I have an interest in you making the kind of decisions that will have an impact on the company 20, 30 years from now, rather than next quarter or next year. So if your objectives and if your motivation is different than of mine and the capital that I deploy, then at some point I'm going to be disappointed. So like-mindedness, whether it is in a marriage, in a business, or in any enterprise, is a principal and important factor in doing the right thing in the right way.
Leonardo da Vinci once said that simplicity is the ultimate sophistication. And as I listened to Tony talk about the carefully laid foundations of his investment framework and what he looks for in terms of both assets in which he may want to take an ownership stake and the families that he, as the captain, allows to board his metaphorical ship, I realised that at the end of the day, the simplicity of how Tony invests affords him the luxury of being able to do so in a way that few professional managers today can.
I do what you would do with your own
Yes.
capital as an owner of that capital.
Yes.
The only thing I have is that I have purposefully extracted myself and our team and our organization from the financial world. That's all I've done. So when you extract yourself from it, your vocabulary changes, your practice changes, your philosophy changes, everything changes.
Yeah.
You know the fellow Nicholas Taleb,
Yep.
who wrote this famous... He's written this, in my opinion, one of the most extraordinary books I've ever read, called Anti-Fragile.
Yes.
In it, I mean, to many people it will be a rambling thing, but it is the most extraordinary analysis of those factors that lead to this kind of issues that we talked about, the ability to survive, this ability to robustness, or the ability to actually gain strength from a difficult environment in which you are, this anti-fragility sort of thing. Anyway, these ideas have always existed in life, have always existed in the course of events, have always existed in industry, in people who do things. Where they don't exist is in the financial world. So in order to understand them and appreciate them and embed them in your own thinking, you have to exit the financial world.
Yeah.
Completely.
Yeah. That ability to own something, really own it for the long term, has been taken away by monthly liquidity and by how many basis points did you miss the benchmark by, well, I'm going to redeem. That has really made most people doing what you do as stewards of other people's savings, it's taken away the ability you have to own things. Because
It's true.
Yeah, you can't own something for a month.
This is really true.
That is called renting.
But earlier I talked to you about the idea of like-mindedness, for example. And so I'm serious about this in the sense that I want to own a participation. I don't call it a stock or equity. I want to own a business participation in a business that is run by owners whose motivation is the same as mine, who are responsible to their family and to their community and to the capital that they employ as much as I would have been if I owned the same enterprise. So instead of owning 100%, I own 2, 3, 4, 5, 10%.
Sure.
But
the missing 78, 89, 90% is owned by
one or two families.
Yeah.
Who've owned it for 50, 100, 150, 200 years. I can sleep very well at night, which I think is more important than eating well.
Right. Yes.
You can go without food, but you can't go without sleep. It also adds to the idea of what I said I consider important is the enduring value of something. So when you think of value simply in financial terms, a price to earnings ratio, a price to book ratio, all of these are accounting terms. They also reflect what happened in the past.
So, but traditional EBITDA and price earnings ratios and all the things that people fixate on and guidance, you and I have spoken previously about guidance and what happens when a company misses a guess they made about what might happen at some point in the future.
Right.
How do you look on that sort of stuff?
Well, EBITDA is not traditional.
No,
it didn't
EBITDA
exist when I was a young
Right,
man.
sure.
And the only reason EBITDA is around is on account of the ability to finance acquisitions through credit.
Yep.
Were it not for credit creation, there wouldn't be EBITDA. Okay. Second, real owners do not think of the value of business as a multiple of the cash they generate before everything. It's just earnings before everything. It's a BBA.
Right.
Second, the idea of earnings, if you really quite think about it, is very important. Earnings is a very important idea. A company must be profitable, and equally as much, it has to generate cash. So profitability cannot be related only to accounting entries. But even though this is the case, the idea of profitability on any one period to another is really a function of the oftentimes temporal events. And so a price to earnings ratio is actually quite meaningful, somewhat, but it's not really so essential in terms of value. So we don't really pay much of any attention to that. I do want to see a recapitalization of earnings. So I think to us, perhaps earnings before interest and tax is a larger, is perhaps more important in the sense that it incorporates balance sheet components, but also the compounding of that earnings to the book value per share is a far more important indicator of a company's ability to compound it, because that's really what wealth is. Wealth is the compounding of earnings. And you acquire machinery and equipment to allow you greater freedom in adding to that pile. So you take from existing earnings and add to that. This is really the nature of capitalism, the ability to satisfy the needs of a customer and create an enduring enterprise that adds value to you. This is self-interest is the foundation of all.
Yes, right.
So also today, largely in the United States, but this is increasingly more common here in this continent. The emphasis is placed on the income statement, often to the complete exclusion of the balance sheet. And I said to you earlier, I think the balance sheet is probably more primary engaging this idea of endurance, but not on its own alone. The components that are there must be examined, the nature of the assets and their economic value in the process. So I think that most owners of businesses do exactly the same thing we're doing. I don't think there's any difference.
No, but that's you. To your earlier point, you're aligned with the businesses in your motivation. That's crucial.
Now you asked me about this nonsense about earnings estimates and forecasts and what do they call them? The
forward guidance. I
forward
think
guidance. I think bollocks. I mean, I think that every CEO that I know personally would tell you in person that they have no clue. And first of all, even if they did have a clue, why would they give you forward guidance?
There's nothing in it for them. You're right.
No, there is something for them if there are options involved.
Well, exactly right. We're talking business owners here, not CEOs.
I mean, what is the purpose for having forward guidance? The only purpose is the price of the stock. And then, therefore, the price of the stock becomes the product. So then it becomes a game. So the focus is not on making something. The focus is on how do we make money. So the idea behind the business is money is made as a result of doing something well. I mean, that's the principal foundational aspect of this. You do well financially as an individual because you contribute something worth someone else is willing to pay what you contribute. So to the extent that the only objective is to make money, or to acquire something for the purpose of reselling it or what have you, you lose track of those essential components of this idea of independence and endurance that I spoke to you about, and it becomes a game. I have a very different view of other people have towards the idea of diversification. You screen because you have certain Well, now computers, I mean, when I was a young man, we didn't have computers and you couldn't do any of this stuff. You had Value Line in America and other such things in Europe. In fact, I invested in companies in Europe who did not even want to give you their balance sheet and accounts.
Right.
We own 28 participations. Some of them, they all have a purpose. Some of them are more core and more permanent than others. Others are opportunistic or temporal or whatever. The idea of going out to try to find more, why would I want to do that? First of all, I once wrote a paper and I called it my great broom theory. And what I did is I went on the Bloomberg machine and I said, give me all the companies in the world that are listed, the principal listing. And the computer says 78,522, for argument's sake. I say, okay. Now I said, I really don't know about anything about Africa, the Middle East, and say South America and some places in. So I just want you to reduce it to companies that are in North America, Western Europe, and perhaps Australia, New Zealand, and computers. Okay, now you got 48,226. Okay, that's good. And then you say, okay, now give me companies that are financially solvent. That means they have a current ratio, at least on a current ratio basis, of at least 1. Computer says 22,500 something. Okay, great. Now I said to myself, I will invest in nearly anything except for businesses that are finance related.
Yep.
Banks, insurance companies, mortgage companies. I'm not interested.
Yeah.
Take out all those companies. Okay, now you've got 10,500 and something. All right, now I said to myself, I really want to own something in a firm that is manageable or it's owned by, so take anything away over 10 billion of market cap.
Okay.
And anything under, say, 100 million in market cap. Just give me some 8,500. Okay, now I said, give me companies who are, this is true, you can do that today, or some variation thereof, that pay a dividend of more than 1 penny per share. At least 1 penny. I want some dividend back. Another thing. Give me companies that have, I don't know, a debt to equity ratio of no more than X. Another thing. Ends up that you end up with maybe 250, 300 out of all those. And that's in all industries.
Yeah, sure.
Now, the possibility of finding anything worthwhile in there, it's really remote. I mean, at any one point in time, right?
Yeah.
But what you do is you learn about business, not about stocks, but about business. You learn the food business, the fertilizer business, engineering. You learn about specific endeavors, and you acquire an understanding. A businessman who grows, say, carrots, I'm using this example.
Yeah.
He's completely uninterested in spending time learning about semiconductors.
Sure.
Yeah. Because no matter how much he knows, he will never know what can go wrong.
Yeah.
He knows carrots. He knows what can go wrong in the carrot business. He knows the components that contribute to a successful carrot business. So you can never tell me that there's a young man, 25 years old, however many degrees he may have from Harvard, who can sit in New York and know what can go wrong in some biotech business in Japan or some machinery business in Spain. He sees things superficially on financial information, on superficial look at what it looks like or what it has looked like.
Sure.
When you buy for the purpose of selling, you don't really need to understand what can go wrong.
No, that's
you
very
see
true.
everything in terms of price.
That's very true.
So we have a relatively important stake in the business of salmon farming, for example, for argument's sake. Well, not just myself perhaps, but we have a team that knows more or less everything there is to know about salmon farming, literally everywhere in the world. We know what can go wrong. We know where the strengths are. We know where where the abilities, where the skill is. We know, and not just merely from what will happen in the price of, say, salmon today or tomorrow, the demand or supply of it, but in terms of those ingredients that contribute to the long-term viability of a business. But we also paid to understand what can go wrong. What can go wrong is really more important than what can go right, because over time, even a marginally good business will profit, will do well. So you really need to understand. You don't know what anything is worth until you know what can go wrong, because we value things differently, because we weigh components differently. There's no such thing as valuation metrics based on some standardized formula unless you see it in connection with other issues.
Yeah.
So when you extract yourself from the financial world and you say, what is this salmon company worth? What if you were private? Well, you don't have metrics there, or you can use listed company metrics. But what do I pay for this? And what do I pay in a genuine economy, not in a distorted economy that we have today, where the cost of money is zero? So today, valuations of businesses have been distorted on account, again, of these distortions in money. And so this is a very difficult time to have. This is why it's so important to have your own your own subjective way of measuring and assessing value.
Yeah.
And part of this method includes the value that is imputed by elements of risk that are unique to a particular business, a particular geographic location, a comparative advantage, and on. So it's simple, but it isn't easy.
As Tony so beautifully put it, when you buy for the purpose of selling, you don't really need to understand what can go wrong. You see everything in terms of price. Having a clear understanding of the kind of business you want to have an ownership in is fast becoming a lost art. Today, the focus is almost exclusively on price and the ability to make a profit on a specific position, rather than finding an enterprise that offers a robust, sustainable revenue stream to an investor. Finding such businesses requires the diligence and discipline to look in places that most mainstream investors shy away from. But it's the very fact that the types of business which meet Tony's criteria are so rare that creates the value opportunity.
So let's talk about scarcity. Let's get back to that, the point of scarcity and why it's so important.
Well, I should tell you that in 2002, we formed an investment fund, which largely over the course of the next 4 or 5 years, I abandoned the private being an investment counselor and just focused on this one fund. And in 2010, we changed the character of this to being more akin to a holding company. But the issue is that it became quite important when you are dealing with, you're no longer dealing with families, where every decision you made had an impact of them directly because you knew who they were. But you were dealing with a pool of capital belonging to the very same people you had. And whether it was an error or not, I had made this sentiment, I've given the sentiment out that we will look after your savings, whatever you put into this investment company, as if it was the only money in the world you had. This brought about, this was a wonderful thing, because it not only focused our views on doing the right thing for the whole, but it allowed a number of people to really keep into this investment company the vast bulk, in some cases all, of their financial savings or wealth. But this kind of policy does not lend itself to popularity, because people want to put you in a box and they want to put a label on you. And investment practice does not, an honest investment practice does not lend itself to labels, because and they want to label you according to some predefined idea of what you are. You are a value investor or this or the other. And so it became really important in 2010, 11 or so, I don't remember the year, to create some, not a slogan, but a defining characteristic of the practice that would allow someone to focus on the essentials of it. And we used, we defined it by the word scarcity, and in that, scarcity is the most important law in economics, in that no one can have all that they want. Scarcity is a natural law. It's just part of life. There's scarcity in material goods, in resources, in everywhere you look at this scarcity in real savings in terms of money, other than perhaps credit that is being created. But there's not just scarcity only in visible, tangible resources. There's also scarcity in skill sets. There's also scarcity among the kind of characteristics in character in men that you and I would consider to be attractive. So scarcity in all of its permutations is an important ingredient in any action that deploys capital for the future. What makes a Van Gogh painting valuable is not the canvas or the paint, but the fact that there's only one. By the same token, there's a second component which we call permanence. I sometimes think we should have called it endurance, but nonetheless, it's the idea of creating a framework not only within your collection of investments, but by extension, within each investment, the nature of the investment itself and the people, the participation that it represents, in the kind of policies and the kind of practice and the kind of purposeful behavior that is designed to endure, rather than merely grow. You can grow but become fragile and then die. That's not interesting to me. So if my mandate is to protect capital from both inflation, taxation, and bad decisions, then the idea of seeking to find endurance is very important. It's really important. And the third part was the idea of independence. And so it was scarcity, permanence. And independence is even of significant value as well, in the sense that much of what we see today in the world is, our world is interdependent today. We depend on so many external factors. We depend on suppliers. We depend on the light coming on when we turn on the switch. We take it for granted that the light will come on. We depend on the water company to, but more so in a business sense, we depend on perhaps key suppliers that often perhaps the situation is not as strong as we think it is. We depend on competitive, we have competitive pressures that have come as a result of competition that would not have been there had there not been credit. So credit creation, the debasement of money, has created an environment in which there is falsity within the competitive arena in which companies operate. And in order to survive, they have to more or less adapt to the conditions. And so there's dependence on government for subsidies or for tax abatements or other such things. Sometimes there's dependence on one customer. So dependence makes the system fragile. So the more independent an organism is from external weaknesses, the more likely it is to add to its endurance or to its strength. So independence is very valuable and is actually costly.
Yeah.
It is an element of freedom. Freedom doesn't come for free. You have to work at it. The threats to your freedom and to your liberty and to your independence are many. And they change from time to time and from epoch to epoch. But a successful practice in which seeks to protect, preserve, and enhance the patrimony over many years is one that must be concerned with these three components.
Yeah.
We think with words, and the ancient Greeks said that the revisiting of definitions is the beginning of wisdom. So today we use words oftentimes without really thinking about their significance. And oftentimes words we use today have a different modern meaning than the word had been used in an earlier era. So we have to be careful about words. I actually don't use the word wealth much at all. I use the word savings. And by that, I have a very precise meaning for savings, which is that which is left over from production after consumption, and the accumulated results of that savings over time. I think that people make the error of considering anything with a bid to have value, where frankly many of the things they have a bid on they may have financial value, but they have no economic value. So distinguishing that which has economic value from that which is just a claim or a loan or a promise is just merely a beginning, because even that which has real economic value, oftentimes its value is fleeting or is temporal. This is why I think that more than any other aspect of life, in investment practice, you and I have to be incredibly discriminating to a point of absurdity, actually.
Mm-hmm.
Because there are very few things that would fit in this very narrow and very constrained view of the sanctity of savings that I think it's important.
You appear to be an outlier in the modern way that people think of managing money, but the truth is, you go back to an age before the noise, before this cacophonous din that surrounded money management. You're a throwback. You're a throwback to real money management as it used to be, when people didn't have 70,000 stocks to choose from. They had to invest their capital, they had to invest their savings in a way that was restricted by the universe they were presented with. All you've done is go back to those first principles you talked about earlier on. But to people watching this, you'll seem like some strange beast doing things in a strange way.
Well, I think there are others, but there are very few.
Yeah.
And in fact, I think the reason we're few is because this kind of practice is not really what is wanted. There's no demand on the part of man, the man with money in his pocket, for this sort of practice. Largely on account of the fact, but not only that, man's time preference has changed over the years. It's hardly anyone works to provide for another generation. People want to consume what they have. They see their investments as an extension of the current account. This isn't always true, but this debasement of money has changed. It has had a moral impact on man's view of his savings or his the world. So there's really no demand for this at all. Very, very nominal and minimal. And I say this from experience.
Sure. But what that does is it enables you to create a practice, create an investor base of, to your point, like-minded people, because they are so few, and guys like you nowadays are so few, that eventually you find each other, and that creates itself a very robust practice that gives you that time preference, that permanence of capital that enables you to do what you do.
Yeah, but the only way we would ever get permanence of capital, as other holding companies have, is by listing our shares on a stock exchange and making shareholder liquidity subject to exchange trading. That allows us to fix our capital base and not capital. Now, of course, we shareholders can trade their shares with other shareholders, or a company buys back a few from time to time. But capital changes. I mean, they're insignificant. I mean, we have maybe 1% a year change in our capital. Right. It's by modern standards, it's tiny. I think you're looking at the wrong thing by saying I'm strange, but in that there have been many families and others in the past, particularly in Europe. Americans, if you ask them about investment, great investors, for example, they can name Warren Buffett, for example, which is here on this continent. There are many, and most of them are completely unknown, have no interest in promoting themselves, and they have extraordinary records over generations in creating wealth. Um, in the form of a family or a listed holding company. When you start thinking about enriching yourself from the assets of those who are participants in your scheme, then you're no longer an owner, you become really, that becomes a business in itself. If, for example, our capital base is about 330 million. If it was double, I would not make any money. I would not see myself or any one of our team. This is completely different from the world in which funds and others operate, where the size of their capital pool is directly proportional to their income. And very little of it has to do with long-term results, because people do come and go. No one sees annualized rates of return over 20, 25 years, because no one hangs around for 25 years. But for each family alone, on a personal basis, the results over 20, 25 years matter a lot.
Yeah.
Finance gives you the tools with which to deceive oneself, to make it seemingly complicated, so you can razzle-dazzle people and make them think somehow you know more than they do. Or on the average man who worked very hard for what he owns probably knows more than most investment advisors.
Yeah.
No, it's true.
Yeah. Well, this idea of industry first, finance second, has been turned on its head. We think of industries in financial terms now, rather than thinking of the industries themselves. What is the business? Who are the customers?
Mm-hmm.
That's been turned completely on its head. We now look, what are the earnings per share? What are the forecasts for the next 12 months?
But this is really truly an American observation. I mean, there's you cannot generalize this around the world. In America, it is generally true. You won't find it among privately held firms, who are some extraordinary companies in America, privately held. But in the United States, generally, a listed company, and I'm being unfair perhaps by generalizing too much, but even with this disclaimer, a listed company's principal business is their stock.
Yes.
Nothing else. What they do is an unnecessary complication to the idea of the stock going up. And so, because this is what the customers want. If there were owners in these firms, there would not be any disputes about compensation.
Right.
Because an owner of a business knows very much well how to compensate. An owner in a business doesn't take options on its common stock. He owns it.
Yeah. Yeah.
This idea of sustainability. Think about the increasing use of the word sustainability. The more unsustainable the system becomes, the more we talk about it. The idea of corporate responsibility. It's become a very big business. Owners don't need to be reminded to be responsible. It is not uncommon for someone to be given somewhat of a tip of some kind, perhaps watching CNBC or something, and say, well, this must be a great idea. I will put, say, 5,000, 10,000 in this and hope it works. And they're likely to part with the 5 or 10,000 or 15 on the basis of a very, very flimsy suggestion by someone, or just a hunch or a hint. The story is a real story about this man who often did this sort of thing, but one day he came to me, he says, I need your help. He says, there's going to be a dry cleaning store in our neighborhood, and I have a chance to invest money in it. And I said, well, that's wonderful. He says, well, but I've got to do some research. So he says, I went around, found out that the nearest dry cleaners is only 2.5 miles, and they're very busy, so there's likely to be demand for this cleaning shop. I also went to industry to find out what the operating margins are for dry cleaning stores, and what is the nominal labor component versus the amortization on equipment, and on and on. And so this man was a dentist, actually. He was an educated man by nominal standards. the moment he had an opportunity to invest in something that was not quoted, and he didn't really know what he's likely to do, he became fascinated with the idea of being an owner in a dry cleaners. But he saw the necessity of understanding those ingredients that would otherwise contribute to the success or failure of this investment. Whereas, on the other hand, because an investment, throwing money on a tip, is the kind of thing that allows you, well, the next day to sell it or buy more, etc. That liquidity gives you an excuse not to want to know anything, not to understand anything. I think this, for me, was an incredibly interesting example of a microcosm of a larger world.
Yeah.
But this, again, I think when you look through history and people bought into the South Sea company in London, they bought in the Mississippi Bubble Company in Paris some years ago. Man has always sought to become rich without work. I'm not interested in that. See, I'm not interested in the man who's already rich, who's already earned something, and he wants to keep it. These are different people. Their needs are different. The world is different. So if you have some money in your pocket, some ability, and somebody wants to become rich, there are a million places where you can go gamble, from Las Vegas to everywhere, to Wall Street, to ETFs, and there's just an umpteen number of ways. Bitcoins, Zitcoins, there's just everything. But for someone who has already acquired, has the fruit of past labors at hand, the tools with which you protect wealth are different from the tools that are needed to create it to start with. And so the tools are different, the framework is different, the objectives are different, the methods are different, the language is different. I have a habit of revisiting decisions, good or bad, over the years, and I go back and I ask myself, what is it that I should have seen that I didn't?
Yeah.
What was possible to see that one overlooks? I also ask myself, what could I have seen that I didn't? What did I see, and how did I focus on this that others perhaps didn't? The idea behind this is to be able to separate an element of luck and happenstance from skill. Now, of course, since then, now I'm making a lot fewer decisions than I ever did in the past. You know, I think back those days I would make 20 or 30 decisions, investment decisions a year. Today I'll make one, maybe two on a very busy year.
Right.
The ability, or the necessity, to go back and examine decisions is necessary because it hones your skills in understanding. Because what you see is, I've come to the conclusion that, and perhaps we can talk about this at some point, that the unseen and the unmeasurable are more important than the other kind. And that has come from such observations over the years. Things that kill you are oftentimes things that you cannot measure or you cannot see. Generally with respect to people, perhaps.
Yeah.
Understanding not just the notion of risk itself, but the nature of and the possible places from which the kinds of risks that threaten a given investment may emerge is crucial, and frankly, something which is given far too little thought by the average investor today. In modern times, we distill risk down to a number and we call it volatility because that's easier for most people to quantify. But in doing so, we're ignoring the very nature of risk itself. But as Tony and I walked in the snow, our conversation turned towards something he feels is a vital component of any investment: time preference.
This date farmer I met is Arab, and he had inherited an orchard, right? It's called an orchard, of roughly about 1,000 trees. And he showed me around, and he showed me that something like 100 trees that were recently planted. And I said to him, out of curiosity, I have this curiosity about, I said, how long will it take for this to bear fruit? And he says, well, this particular variety, he says, it will bear fruit in about 20 years. but that's not good enough for the market. It may be about 40 years before we can actually sell it.
Yeah.
I've never heard this. I did not know this. Now, there are other date trees that could produce faster. But anyway, so I said, so all of a sudden, I became odd because I looked at all these trees that were being harvested, and you realize that he couldn't have possibly planted them.
Yes.
He said, oh, yeah, it was my grandfather and my father, great-grandfather. It was fascinating. Why would a man do something today for which he will receive no reward in his lifetime? And the only reason he would do this if his time preference is so low that he's concerned about his family's wealth a generation or two from now. Because he receives no reward by planting a tree. They will have no, you know, in your world they will call it an economic loss, a loss of opportunity, or God knows what they will call it. But he saw the world differently. I'm in a supermarket and I see dates. I think about this story now. And I'm sure there are other similar kind of situations. Everyone has heard me tell the story about Antoine Fievet, the chairman of Bell, Fromagerie Bell. And the first time I met him, something happened in the company that was notable. Anyway, he said, so I said, I want to congratulate you for something. I don't remember what it was. And he says, oh, Tony, you don't need to congratulate me. I found myself in this family that several generations built this wall, and I'm adding 1 or 2 bricks, and I'm going to pass it on to someone else.
Yeah.
Think about what this man said. I mean, I was instantly in love with this man.
Yeah.
And it made no difference if he made cheese or made furniture. He had a perspective of what his role was, a perspective of what his task was, and his mission was, to protect, to preserve, and to enhance what he was handed. He was not in the business of quickly selling it and making money and doing things. They do make a great deal of money, but they do make money as a result of making great products.
Yeah.
So how many people in the world can I find that I can buy 2, 3, 4, 5% of their business that think like that? Because that way I can sleep very well at night, and I can assure you the capital that I command and is deployed is going to be around 50 years from now.
Correct. But you know, we touched on it earlier, but this comes back to people. This is, you can find a company that looks good, might come out of that screening you did when you got 78,000 companies down to 150. It then comes down to the people. It comes down, because let's face it, every intergenerational company, I guess the biggest potential pitfall is you get that one generation where the kid comes in and he decides he wants a Ferrari instead of a family business.
Sure, absolutely.
Yeah, that's an unquantifiable risk.
This is in fact the norm more than an exception.
Right.
Now, you probably, you were a fund manager as well for a while, didn't you? Did you go visit and talk to people? I mean, this is not
as many as you, and not the same kind of people as you, because these were big companies.
Oh yeah, you're right. You asked them for their forward estimates.
Yeah, there you go. There you go. Something along those lines. A lot of our stuff was private.
No, this has happened to me twice. Once happened in the United States, and in the case I told you, it happened, in here in Europe, where I'm visiting briefly with the man who runs the business, who is a member of the family who owns a large stake, and many times they are really involved in the production of things. They're really not. They don't drive a Rolls Royce or a Series 6 BMW. Right. And so he says, "How many shares you own?" From. I said, X. I don't remember what it was. He's, by the way, what's our stock price nowadays? Nowadays.
Yeah, nowadays. Yeah.
And he was genuinely curious, because, I mean, he could have found out, but it didn't occur to him that it was necessary for him to know what the current price was.
Sure.
And so oftentimes you see, for example, let me just give you, I sometimes think about this. Yesterday, we have one holding in which someone sold 14 shares.
Right.
The prior closing price was €505. Yes?
Yep.
The new bid was 480, asking 550, 540. Ask 540, bid 480. Somebody sold 14 shares at 540. The last price came down 2.5%. And I calculated that for the family that owns the company, that was translates to something like 400 million euro worth of change.
Right.
Now imagine they were watching it.
Yeah.
It is immaterial. For us, it was something like 600,000 some dollars or
Right.
euros, or I don't know what. But the fact is that the more frequently you look at something, the more frequently you second guess why you own it and what else you could own
Completely.
instead. It's important to know that you work for people that are like-minded with you. You know, I'm not doing this to become famous and rich.
No.
And so, if we have 117 shareholders in the firm, I want to make sure, I want to know that at least the majority of them
Right.
Understand what we do, appreciate what we do, and then I feel confident in working for them. I mean, I really feel a sense of pleasure in doing whatever we do for people who, if they were strangers and if there were people who were going somewhere else or wanted something else or wanted excitement in life. I mean, we've been told many times, why don't you leverage the portfolio, borrow money?
Yeah.
I've never done this.
Yeah.
Why don't you sell something short? I've never done this before. I don't even know how to do it.
Right.
Why don't you buy this, or why don't you take your reserves and buy treasury bills in I don't know, Zimbabwe? The interest rate is higher. We don't do any of these things. If you're not happy, listen. There's just so many people that will be happy to
Right.
play with your money. I mean,
Right.
this is not a competition.
But it comes down once again to people. You have to make a judgment on the investors when they come in. They have to make an adjustment.
This is so rare.
No, but they have to make an assessment of you, and then you have to make an assessment of every management that you. And okay, you've got 28 investments. That's 28 managements you have to evaluate.
Our shareholder turnover is much lower than our portfolio turnover.
Well, which itself is
which itself
I'm
is
sure
extremely low.
Yeah. But there's a reason for that, and it comes down to people. It's because the people you invest in and the people who invest in you make judgments that turn out to be, in the most part, correct about those people.
Right.
So how do you, as that judgment of people is such an important component in both directions of what you do, it's also the hardest quantification to make successfully because they're people. Who really knows?
Yes, it's also important that, for example, in my case, I have a wonderful team, and I want to be able to pass on to another generation the ideas that are most valuable. I mean, they have their own personality and they have their own temperament and all that. But so you want to pass on ideas that matter. And one of those ideas is the ability to judge other men.
Yeah.
And you can only do this with practice. And you can only do this by observing things. We have been known to make a completely reversal on an investment we hold on the basis of a single sentence that was uttered by a CEO or CFO that betrayed something that I would not want to have. So imagine you own the whole company and your president of your company or the financial officer comes and gives you a report. And in that report, he says something that you'd want to fire him on the spot, right?
Right.
And you would, and you should. In my case, I only own 1%. You don't sit there and rationalize and say, well, that's not what he meant, and it's the P ratio is good, and the EBITDA is good, and the prospects are great, so hold it. No. You get out. I can tell you an incredible story. I don't mind telling you the name. Well, actually, maybe I should. It's a company that at one time in Brazil was the largest processor of chickens in the world. The company was called Sadia. And I went to visit them in Sao Paulo because this company not only they produced chicken for the local market, but they also sold the vast majority of the breasts and other good components of the chicken to markets in the Middle East, in Russia and elsewhere. They generated a great deal of foreign income, foreign exchange. They had their own, they grew their own wheat to feed they made their own chicken feed. They were exceptional, and there was the third generation, the second generation. And one day I went to visit, and we owned a stake in it. And I visited with the CFO. The patriarch in the family was absent. He was not there, and it was sad because I wanted to meet him. The CFO said, he says, if we had the ability to have access to the banking system so that we can hedge our receivables from various countries, and we can, this was 2000 something, we can make more money by being able to foresee, because we can foresee foreign exchange rates. Only if we could work with an institution that would work with us in the forward market. And the CFO insisted on telling me, spending 15 minutes telling me about this thing that had nothing to do with chickens.
Right.
So I noted it. 2 years later, as in the news, Sadia buys a 60% stake in a bank in Brazil. Within 30 minutes, our entire stake was sold.
Right.
Just on that announcement alone.
Yep.
Within 2 years, the company was insolvent, out of business. So look it up.
Why is it, I wonder, that stories such as that of Sadia's demise seem so unsurprising today, and yet Tony's response to that one announcement about the company buying a stake in a bank catches one completely by surprise? Tony's logic is simple. His action in selling his whole stake in the company completely justifiable, and yet it seems like a bold move instead of a prudent fiduciary action. This intense focus on the people responsible for the stewardship of a company in which he has an investment is central to the way in which Tony identifies potential places in which to deploy his irreplaceable capital. But sometimes, even with this level of attention to detail, drastic and painful action can be required.
How would you act if you owned the entire thing? You walk into a business and you meet the head of the business or the head of development or the head of anything. Ask yourself, if I owned this entire thing, would I hire this guy to run it?
Right. Yeah, that's a great question.
Now, where is the formula to tell you that?
You're absolutely right. But you have to, it's your nose. You
And
have
if
to
the
look them in
answer
the
is
eye.
no, why would you want to own 1,000 shares?
But what, I don't disagree, but how do you make that judgment without going to meet the man and talking to the man and him, maybe on another day, you may have had a completely different conversation
Sometimes you don't have to meet them. Sometimes what you can do is you can look at their actions over 20, 30, 40 years, 50 years, and be absolutely certain that in the right time they made the right decision for the right reason in the right way. And they've done this all their lives.
Yep.
You don't need to meet them. We have a fairly large investment in France, and I have never met, actually two, I've never met the people involved. But I am extremely assured, as much as I've done everything else, that they are the right people doing the right thing in the right way.
Yeah.
I mean, assured. On the other hand, I must tell you about an unbelievable error in judgment we made, because we bought a large stake in a company that by all standards had enormous value in it. And the people who run it said all the right words. Blah, blah. And it was not until a year or two later that, through sleuthing really, we came to conclude that what they said and what they did and how they acted were completely different. And so no matter how valuable the company was, we exited.
Yeah.
And it was actually quite painful, mostly to my own ego.
Of course. Yeah. Oh, of course.
Because I had invested a lot into understanding this. Today, you're suffering from a culture of inaccountability.
Yeah.
Look, how many times you've heard recently the word transparency. Everybody says this, huh? When I was a young man, no one really knew the word transparency. When a company is owned by an owner, there's no need for transparency.
Yeah.
Right?
Yeah.
When a company is owned by someone who's responsible to the owner, That's all we need is responsibility.
Yes.
We used to have this word. Huh? Now we have manufactured all this bureaucracy and this to satisfy our nominal need that things are being reported, etc., etc. Every fraud in the world had an audited financial
Yep.
accounts.
Yeah.
Everyone.
Yep.
So that doesn't mean anything either, does
Nope.
it?
No, it doesn't. It doesn't.
This is an old business in making barrels for wines and spirits, and the Francois family in France had controlled it for years, but the son was a bit more ambitious, and he saw opportunities in an industry that was being consolidated, principally on account of incompetence, particularly cooperages in Scotland, because it may sound a simple thing, making a barrel, but it actually isn't.
Yeah.
It takes a lot of work, and you need to know what to do with the wood, the components. You need to teach people. It's really difficult. But they're very traditional. For example, this company relied mostly for most of its life on demand for barrels in the Bordeaux and Burgundy regions in France. And in fact, they have, I think, all the market there for that. But they've grown. Now they have operations in Australia, in California, in Scotland, in South Africa, Chile, I think. I'm not on top of all these details. But the point is that they have grown to be really the largest company of its kind in the world, even though they are only, I don't know, 250 million in size. Yeah. And this is in a business that people will consider boring.
Right.
I mean, there's nothing sexy or exciting about making barrels. But I tell you, they'll be making the same barrels 50 years from now, and they will be the very best at it, and they will be 3, 4, 5 times the size they are today.
But that's durability. That's endurance that you talk about. Finding these businesses that people think are boring because they don't leverage up the balance sheet, they don't chase growth, they don't do all these things. Talking about durability and permanence, so I have to bring up the subject of gold.
Why do you have to?
Well, because I feel like it's a permanent asset. It's a durable asset.
Why?
Well, I'm going on 6,000 years of history. Maybe in one day it doesn't become permanent. Maybe one day it doesn't become durable. All the evidence so far points to it being that way.
Why are you asking me? You know far more about it than I do.
I'm curious as to your views on it, because I know you have owned gold. I suspect you probably still own some gold, but I'm curious as to how you think about it within the framework that we've been discussing today. Because it's not a company. It's not. There isn't a man whose eye you can look into.
It has no PE.
Has no PE. It has no PE.
It has a P, but not an E.
Right. Right.
And the fact is that the P is in money, which itself has no. We don't know what it's worth.
Yeah.
Well, I have had a fairly long history with gold, starting in 1998, and I've owned gold bullion for many years. I think at one time I saw it as being incredibly mispriced, and I saw it as an anomaly, thinking that somehow the market has occasionally the market misprices certain assets.
So what was it that made you think it was mispriced?
I had a curiosity about gold for the right reasons. For a long time, I used to be an owner in Franco, Nevada since 1996 or thereabouts. But I've never owned bullion, and Franco was in the business of royalties, and it was an extraordinary business managed by incredibly good people. But in 2001, I had a fortune to be a guest of Goldfields in Johannesburg, and as part of this thing, they gave us a tour of several facilities, and I don't really know what mine we went to, but I know at some point the man looked at us and he says, "Do you see this field over there? There are 10,000 people that work 2.5 miles down."
Right.
And I stopped for a moment to consider the logistics of providing air, food, water, or whatever, living conditions for so many people down there. And immediately I think of the capital that it takes to do that. I mean, this is not a small matter. And then they took us in this shaft, this elevator shaft, and that moves actually quite fast. And they took us all the way to the bottom of this pit, and they gave us a tour of the rock faces and all that. And I remember I had this unbelievable feeling as I was coming up the elevator some hour later that either the price of gold was mispriced, it was selling at the time at $250 somewhere, give or take $10, or all of this capital that had been sunk here had to be written off completely and forgotten. And it was either, I thought of the idea that it was either one or the other. There could not have been any rational solution in the middle.
Right, it's either worth nothing or a lot more than 250
That's
bucks.
correct.
Yeah.
And what I did is that I felt compelled that this was the time to buy it. And I did not buy gold, I bought shares in Goldfields.
Right.
At the time they were selling for $2 or something, or less. But a year or two later, after the initial rebound had taken place and Goldfields was selling at 18 or 19, I decided that I would own gold, the physical metal, for different reasons. I would own it, so I sold equities and I bought shares in GLD, which I subsequently sold because shares in GLD for me did not represent ownership in gold. They represented a security that perhaps reflected its price. I wanted to own the real thing. Same way a farmer down here doesn't own cattle futures. He owns the real cattle.
Yes, counts, yeah, right.
So, so over the years, the component in gold in portfolio, of course, the price went up from 250 to whatever, 1600, etc., back down to 1200. Today, it represents gold about 35% of our capital, physical metal.
Yeah.
But I should tell you, I mean, I don't own it with the idea that the price will go up. So don't ask me where the price is going or when or when or
I would never
why.
do that because you're right. It's
I
unimportant.
own it because had I not owned gold today, I would own treasury bills. I would own short-term commercial paper. I would own cash deposits and other such things to provide me liquidity.
Yeah.
Because I think that roughly about 60% of our capital is permanently invested. Roughly about 40, of which 35% is gold, is in liquid. I want it liquid so I can exchange it for participations like the one we have in the future at some point. And I think any good investment operation, particularly if it involves irreplaceable capital, must be embedded in it a source of continuity and substance and reserves. So, 10 years ago, I would not hesitate to buy treasury bills, commercial paper, short-term bonds, term deposits. I have come to believe that virtually all of the things I just mentioned are actually debt.
Right.
When you deposit money in the bank doesn't actually
liability.
hold it in a vault there. It's a liability of the bank. When you deposit, when you buy a treasury bill, you're buying somebody's debt and you call it an asset. When you're buying a bond, it's actually a debt. You call it an asset because it's got a QSIP number or an ISIN number on it. So I decided that I want my liquidity not to be somebody else's liability. I want it to be an asset.
No, okay, that's
gold gives me what? Scarcity.
Yep.
It gives me permanence.
Yep.
And it gives me independence from the financial system.
Yep.
It gives me all those things.
All the things you're looking
in these
for.
three things.
Well, look at it. Let's do a present day hypothetical. I mean, it is hypothetical, but still, let's give it a try. But if you decided today, what would make you exchange your gold for something today?
Look, I mean, I hate to say this to you today because I don't want anyone to sort of quote me on it, but today the nominal price of gold is in fact cheaper than it was when I first bought it in 2001. Now, if you buy it for the sake of profiting from a price rise, there's really nothing wrong with this, and I'm sure there are many people in your organization who you've talked to who know far more about it than I do. My sentiment about gold is very simple. It's something that I understand.
Yeah.
Something that I hold in a vault that I can see. Something that I can be sold to anybody anywhere in the world at a moment's notice. Something no one actually owes me.
Yeah.
It's not a claim on anything. It's not a promise for anything. And there's a sense of peace that I possess by having financial strength that even central banks don't do. We own 3 tons of gold, and at one time is more gold than virtually most central banks in the world own.
Right.
Canada owns nothing, I think, or
Right.
something. Yeah.
I'm willing to bet a substantial size of my assets that you don't own any Bitcoin, nor will you ever own any Bitcoin.
Point is, I don't know what it is.
Right.
I don't know where it is. I don't know what it looks like. I mean, they have still pictures of gold coins with a
yep.
B on it. And they talk about mining it. And so they've used all the elements of, superficial elements of that having some sort of tangible, I don't know what Bitcoin is. Where do we find one? Can I misplace it? Do I lose it? Where is it held? And so I don't want to own things I don't understand. I don't care if it's going up. It makes no difference.
From everything we talked about, I knew gold must have had a place in Tony's portfolio, but even I was a little taken aback at just how large a part it played. Upon reflection, however, and given the exceedingly small universe of companies which meet his stringent investment criteria, it made more and more sense to me that gold would be the perfect place to keep his liquid assets. A world away from gold, Tony's search for long-term investable opportunities requires an understanding not just of an overall industry or even an individual business, but also of the various component parts that come together to create that which the world sees at face value. So I want to talk to you about something that is a common thread in some of the conversations we've had, and that's the idea of the structure of production. Because this is something that occurs time and time again, and I'm interested in it because today people think one step down the line. If an idea happens, they think, who's the beneficiary? And once you get a sense of this structure of production and some of the examples that you have of companies that you found that are 3, 4, 5, 6, 7 steps down the production line, just talk a little bit about that concept and how you use that to identify companies.
I don't think that we purposefully look for such a standing. It's just a natural outcome of perhaps valuing the idea of scarcity a bit more than others. For example, a lot of people could perhaps like to enjoy having a whiskey, but a lot of people do make whiskey. A lot of people make the glass and the bottle, but how many people make the machine that makes the bottle? Right. Only one. And you end up having a view that there's scarcity and oligopoly in certain areas that have come as a result of some events or some reasons that are economic positions that are impossible to compete with for a number of reasons. Mm-hmm. So to the extent that these economic agents are wise and they can use their position to do well, that idea of scarcity in technical expertise or position adds to the enduring value of a company. I would not want to participate in the securities of a company that does some commodity item, like even if it may have a label on it or some mm-hmm. kind of a brand, because the barriers to entry are fairly low in most cases, or the general acceptance of such product is subject to the seasonal whims of the public, of the buyers. By the same token, I'm not interested in acquiring a stake in a company that provides aircraft transport or train transport or truck, because they have no operating leverage. They're subject to inputs and costs that are beyond their control. They're subject to government regulation, and they don't represent the substance that I want to have. Now, they may be fine for other people, but just not for me. On the other hand, we spoke earlier about an investment we have in EMS in Switzerland. here's a company that produces polymers. I mean, a lot of people can probably do the same things they do. Nonetheless, here's a chemical company that has operating margins that are unheard of in the chemical industry. But only in the sense that they take these polymers, polyamides in this particular case, to create products that solve problems that no one has ever thought of. Among the many products, in fact, they make the little exciter that goes into every airbag in the world. We're not looking for this, for the place they are in the structure of production as much as we're looking for this uniqueness, this ability to have natural barriers to entry that are based on a number of factors that are difficult to compete with. That's just an advantage. It's not always permanent. You have to cultivate it and you have to adapt to it. Nothing is permanent.
Right. But the further up the structure you go, the more chance you have of identifying an input that is, for now, unique.
Yeah, but you don't want to manufacture a product or to be part of. I don't want an investment in a participation in a company that makes something or the nature of which is so large as a component of something, so as to be subject to the seasonal demand, or subject to external risks, either through government intervention or regulation or competition. I want an element of independence, and oftentimes, for example, this exciter I was telling you about, only as an example, is an infinitesimal part of an automobile.
Yeah.
Yet an automobile cannot do without that, as a matter of, and we can talk about many other such examples. So you need to gauge and understand the strength of what you own within a competitive economy in which we operate.
But this exciter idea is an interesting one, because it's a component, a tiny component that costs a handful of Swiss francs, but it's in every single car that's made today.
Sure.
And as the number of airbags increases and safety standards increase, the number of these units required also increases. So something like finding a company like that, which is up there hiding in plain sight, but people tend not to think. They think about car sales, Ford, GM, Volvo, Saab, wherever. They don't think about component parts, certainly not down to that one tiny component. That's the extra work required if you really want to understand a process and find a point in that process that is defensible and profitable and will help a company make money for a long period.
Yeah. Correct.
So when you find a company like that, just kind of, if you can, walk us through the process from finding that idea. Okay, how do you then go from, here's an idea, here's a potential investment. How do you turn that into an investment?
I'm not sure that there is a checklist that one would normally think it's there. You need, first of all, you need to ask yourself that, do I like this business?
Yep.
You can't just merely say, I'm making an investment because I'm going to make money with it. First of all, do I like this business? Do I understand it? Do I want to be in this business? Why? What is the history of this firm? What are the competitive advantages? What is the larger environment in which we operate? Both from the issue of demand, where does the demand for the products come from? Does it come as a result of government policy or subsidies or regulation, or does it come as a result of choice on the part of the consumers or of the customers, etc.? What are the components that go into this business, and how are they regulated, and how they what risks are they subject to in and of themselves? What is the market for this company's products? Not this, the supply of components, the market for these components. How honest are their revenues? How permanent are they? What are the factors that influence their, say, operating margins or unit growth? How have they deployed their earnings in the past years? How have they grown? I have never met a company that has grown from acquisitions, subject to just acquisitions. Acquisitions are when you look at something that depends on acquisitions or financial engineering, you're looking at an accident waiting to happen. What is the ownership structure of this company? Who owns it? How long have they owned it? What have they done with it? Who are the people involved? How long they've been here? So the fact is that as you begin looking at it, at any one moment you come across something that says, no, I'm not interested. Something significant.
Yeah.
It's only at the very end when you say, here's something that is substantive, valuable, something enduring, something scarce, something extraordinary, something beautiful, that you ask yourself, well, what is it worth? We all know what something sells for, right? Particularly in listed securities, you can look it up and immediately see what it sells for. But what is it worth? How do you approach the idea of value in this particular case? What are the components that add to value? What risks are inherent in the business that you would want to take haircuts against? How do other people think it's worth? Under what circumstances over the period of time? Is it something that's neglected? Is it something that's followed by every mutual fund and ETF in the world? If it is, I'm not interested. Look, it's not a science.
No, absolutely not.
And I think it would be a mistake to suggest that you have a checklist and you go through and you...
Oh, no, I'm not suggesting that. I'm interested in some of the inputs.
It's a subjective process that sometimes you come to a very quick conclusion as to the attractiveness of something. Sometimes it's sort of like you meet a girl, some people just know immediately. I've met someone says, immediately when I saw this girl, I fell in love with it. I knew she was going to be my wife. That does happen. Other times you get to know someone, you get to grow with them, talk to them, take them to dinner, etc. And then you begin to appreciate the value that is in this person. The same thing with this. The last thing I do really as a person is look at the price and say, well, oftentimes, of course, in the last 10 years, more often than not, things that I would like to own are priced at such a level where I think it's just not suitable for me to acquire it, to invest at that price. Price is an important thing, but what others think about what the potential earnings are is not of consequence to me, because I know they're all... I've never met anyone who can predict this sort of things accurately, consistently, so I don't rely on any of them. We have a wonderful team that does a lot of work answering some of the basic questions, but I ask myself 2 or 3 questions oftentimes. One is that if I own this whole company, would I want the same people to run it?
Yeah.
This is, I guess, very subjective. Another question I ask myself, would I want to own the entire thing? Is it something I would want in my collection of assets? If I wouldn't want the entire thing, why would I want to buy just a little bit so that I can... I ask myself, is this business likely to be around 20 years from now? And I know this is a difficult question, and I know that you probably say to yourself, well, how would you know? Well, if it has been around for 200 years or 150 years, chances are it will be around for 20 years. But you generally know when you look at the decisions that are being made over a period of years. Looking at decisions, you understand the motivation of those who own this firm. And you understand whether or not they're sowing seeds for the next year or for the next 10 years. I used to own a stake many years ago at Safra's Bank in Luxembourg, Safra National Bank. You remember this bank?
Even Safra, yeah.
And I think we owned it for 7 or 8 years, and the price never changed. It was 50, 51, 52, 49 for 7 years. The business was doing very well.
Yeah.
No one was following it. Unbelievably, so the dividend yield at the time was 12%.
Right.
Current yield.
Yeah.
Anyway, I remember distinctly someone saying to me, why do you own this? The price is not going anywhere. I said, it's a great business. You know, Edmund Safra was a banker's banker. I mean, he's one of my heroes.
Yeah.
And then one day, HSBC paid me $195 a share when he sold the bank. After 7, 8, 9 years, I'm not sure how.
And you've been paid 12% a year to hold that for 7 years.
And I was paid 12% a year. the point I'm trying to make is we make a lot of judgments by looking at the price of something on a daily or weekly basis without having a clue as to the seeds that are being sown today, good and bad, that are likely to bear fruit a year, 2 or 3 or 4 years down the road.
Do you start trying to find reasons not to do something? Or do you start, once you have an idea, do you start?
Sometimes, yeah. Sometimes something looks very nice.
Yeah.
And you say there has got to be something wrong here.
Right. So you seek out to find the reason not to buy something.
Yeah, or not to add something to an existing holding, or I'm a doubting Tom.
Right.
Thomas. Right.
Yeah. Doubting Thomas. Yeah.
Now there comes a point in time, though. There are people that I know, people who run some investments in companies in which we have a participation, that I would trust completely. I mean, completely. Because they have demonstrated faithfulness to their families, to their companies, to their shareholders over many, many years. And I would never second guess them. Never. There are others that I would second guess, but I will write a little letter maybe, a very nice little letter. But if there's a series of error or actions that I'm not sure are in the best interest of the company long term, I will quietly leave. I mean, that's the only thing I can do, being a minority shareholder.
Sure. But these relationships, I mean, this comes back to time preference again, because you don't get to develop that kind of a relationship with management, that kind of trust in management, unless you are a stakeholder, unless you keep mentioning this.
I love this word,
participation.
Stakeholder.
Yeah, but you mentioned this word. You have a participation in things, you have ownership in things. And these are different terms to the way most investors think of things. And it's funny, it's just words, but they convey a different sense of what these investments mean, both to you, to your holding company, and to your shareholders. And you don't get to develop that without holding these shares for a period of time. And people don't. People buy a share, and it's, some families pass on shares in Exxon or IBM to the kids. But it's such a big company, everything is out there. No one really knows the CEO of IBM. But these companies you find, these small...
You remember years ago when we were younger, they called it the gambling business. Now they call it the gaming business.
Right.
This is not by accident. They want to infer to you that there's an element of fun in giving money to the house when all the odds are against you.
Right.
This is quite similar to, I guess, the typical investment process that most people do. But you don't have to participate.
No, you don't.
You don't have to go to the casino.
But so how do you go about generating ideas? Do they fall into your lap because of happenstance, something you say that will trigger a thought and you'll just go off and investigate that? Or when you're sitting down with this time thinking, whether you're up in the woods or whether you're out on a boat, how do you find an idea? How do you find a company? I know it's a very broad question, but people do it different ways. Some people say, I read the news and a story will happen and I'll follow it through to its logical conclusion, cui bono.
No, yeah, I've never had any investment ideas come through reading the news.
No, right.
Forget that. Generally, it will come from knowing other firms who are in the same business, in the same industry, or curiosity. You find a nice... I don't know, it comes from all kinds of sources. It's not important to be looking for opportunities. We don't do that. What is important is to acquire an understanding so you can recognize the opportunities when you see them.
Right.
You understand? Because if there is an opportunity, it comes across for everyone to see, but very few people perhaps recognize it, right?
Yeah.
So the people who recognize it are prepared to recognize it. So what are the tools you need to recognize something that appears? Well, you need understanding of a business, understanding of a sector, understanding of a market need. You need perhaps to have a third, fourth sense of something. I have conversations with a lot of people, particularly email correspondence with We say some industries that we have, some companies we have. We have a team in the office of younger than me who are eager, enthusiastic, and perhaps even more curious than I am. And so altogether, generally speaking, you will come across in the course of a year 50 or 60 situations that require that you take another look. And out of these 50 or 60, if you're very lucky, you'll find one that fits.
Right.
Yeah. But you have to invest a lot of time and effort. In the meantime, you learn something about the process.
Yeah.
Yeah. So,
But is
there's
that
no formula.
Is that time ever wasted?
No. No, it's not wasted at all. What happens is that if you spend 3, 4, 5 days understanding how oil is extracted and say in Canada and how it's refined and how it goes here and there and the cost components and the capital structures of companies, you acquire something. You may do nothing about it, but it's filed here.
Mm-hmm.
So next time the situation comes, you have tools with which to think. And I think that what's missing in our world is this ability to have tools with which to think about the economic value of a business endeavor rather than its financial value. It's easy to say this company sells for X number of dollars or euros or francs. What is difficult to say, what is this company worth and why? Right?
Yeah, absolutely.
Now, what has this, but there's been, part of the reason is there are also a lot of distortions. This private equity business has come in. Private equity is nothing other than regular equity that's leveraged.
Yeah.
And because of their ability to borrow unlimited sums to buy unlimited things and their ability to turn them over, they're able to pay prices in the marketplace for businesses that are perhaps higher than the owners think they're worth. But their business is to extract substance out of such companies and get rid of them. Their business is to make money from the security.
Sure.
But this has distorted the market, the market's ability to find, to discover true value in terms of price. The price discovery is really distorted immensely on account of both monetary experimentation as well as the moral consequences of such policies among economic actors. So it is difficult, but you don't have to do a lot. You don't have to do many things. You don't have to have expertise in every possible area. You have to do whatever you do, you have to do it very well, though.
Well,
and think about it. If you do it well, if you can say, if it were my own money, my own savings, would I do anything differently? And I can tell you, I wouldn't do anything differently at all.
So why is it that, to me, that seems like an extraordinary statement today? Why do I feel as though that's not?
I don't know. Ask yourself.
No. It seems as though
to me, it's elementary.
I completely agree.
Yeah.
I think it's the way it should be, but I don't hear that very often. I don't hear that as an ethos very often. I manage money as if it was my own savings. And what would I just don't hear that, because I think it's focused on returns, and returns are essentially a price.
Look, this is what people want. Grant.
Right.
The market provides what the market demands. People want to have, I heard somebody the other day, they don't make great movies anymore. Remember the great movies of the 50s, the 60s, the 70s? Why? That's what people want. So in a capitalist system which we have, you have the freedom to produce the kind of product that people want to buy. So there's always a limited demand for something that is a bit more rare or different. There's nothing wrong with it. I find it completely acceptable. You will never, it is very unlikely that you will find a very large demand for something that is not very popular.
Right. But it's self-evident, I guess, but it makes sense. I just find that this this business was built on your kind of philosophy, this careful stewardship of savings. That was the foundation of the investment business. And yet today, I find you to be the outlier. I find your investment style to be the outlier. But to me, it harkens back to a different time, a time when everybody thought the way you did. And I just, it feels as though the industry has lost its way. It's lost, if not its soul, then perhaps its center. And
look, Grant, you may be right, but I see it from a different, I know a number of people who do what I do more or less the same way, and perhaps a few variants, but their philosophy is the same. What I can tell you about all of them, you will not find them on Twitter or on Facebook. You will not, no one will promote their shares or themselves. They're not on television, and they will all make fun of me of the fact that I'm talking to you. I will get some phone calls about this.
I'm sure.
Yeah. But he who shall search will find, they say. It's in the Bible, I think.
Yes.
If you want to find very good tasting tomatoes, it is unlikely you will find them in your local grocery store. If you want good quality fish, meat, cheese, it is unlikely you will find it at some large supermarket. But if you are seeking it, you will find it. It's there.
Somehow it feels appropriate that those seeking a manager like Tony should have to work just a little harder to find him. What he does and how he does it, despite his protestations to the contrary, is unusual today. Not only is it unusual, but to Tony's point about why something might be rare, it's not necessarily something that most people are looking for. However, for those whose time preference matches Tony's and who are looking for a true steward for irreplaceable savings, hearing this kind of wisdom will seem like water in the desert.
How do people find people like you? Because to your point, you're not on Twitter, you don't do interviews, you don't do media. People have found you, and you know other people that think similarly to you and invest in a similar way to you, but I don't. And I talk to a lot of people in this business, and I spend time with great professionals that do a fantastic job, but you are different. You think differently, you act differently, you invest differently, and that requires you to have a different type of investor. We've talked about this alignment, this time preference. There are people, I guarantee, watching this who have been trying to find someone that thinks the way you do and invests the way you do. You're very difficult to find. How do people do that? How do they seek you out? Because they wouldn't have the first clue where to start.
But eventually, when we list our shares on the stock exchange, they can go buy a few shares.
Well, actually, talk about that percent, because that seems at odds. The reasons for doing that, I understand, but it's worth talking about, because that seems at odds for you to list on the stock exchange. It would seem an odd thing to do.
Well, the listing on the stock exchange is a way of finding freedom in an unfree world, believe it or not. It allows anyone anywhere in the world who is a shareholder to buy 5 shares or sell them without having to produce a serum sample and a copy of this and a copy of the other. Today, we are more or less a rich man's club. But we can acquire more permanence to our capital by listing, and a listed company has certain freedoms that privately held companies don't have. One of the best ways to hide from the world is not in the desert, but in the middle of New York City, perhaps, sometimes. And listing may give us that longer-term substance that is difficult to find. We haven't concluded yet that we're going to do that, but it's in the works. It's an option that we are considering.
So when you look at this, at the industry from where you sit, and you are detached from it, you've created your own niche. in that business and your own way of doing things, do you pay attention to what goes on in other parts of the industry, or are you in other parts of the investment industry, or are you just laser focused on your little part in it and the rest of it really doesn't?
Oh, I'm interested in the fertilizer business,
right?
The salmon farming business,
Yeah.
and lots of other little areas. I have no interest in financial world. None. I mean, none. Zero.
So this is the last thing I want to talk about, because people, I'm sure, think, well, how can you be an investor and pay no attention to the finance world?
I'm thinking of a friend I have in England who manages a very large public fund, and with a fairly large visible standing, that he will often do things because it's necessary, because of the position he's in, rather than because that's what he wants. And he would readily admit, among others, that there's no value in reading the financial press. I mean, there really isn't. First of all, the news is not news. It is true, it's all fake, but it's always been fake. It's nothing new. A lot of what posts for news are poorly disguised promotions, or written by people who have no clue. I was once called by a reporter. I don't know how they found me, and they asked me if they could use a quote from me, that the reasons for the increase in something was because of this and that, if they could quote me. And I said, you can quote me, yes, the price of this increased, but not because of the reasons you've suggested, but I'm happy to give you my view. He said, no, I just want to quote you that it went up because of these reasons. I said, you cannot quote me with that. He said, okay, thanks, and hang up the phone. I recently met a farmer in Greece who has, 25,000 orange trees. It's a wonderful business. And I was discussing with him the economic viability of adding value to his production instead of selling the apples directly into the market, because he has thousands of tons. And he says, I haven't thought about it because I'm so busy with the trees and their care that I have no time to think about some of these matters.
Right.
And I said, well, how does government policy and subsidies and other things impact you? He says, I don't know. I said, don't you have a local press, that industry that follows it? He said, I don't read that stuff. They don't know what they're saying.
Right.
What they're saying.
Right.
People who are involved in a real economic endeavor don't have the time. I mean, of the people who have friends who are fund managers, none of them tweets. No one has the time to do that. Besides that, what can you say in 40 characters, whatever it is? So I'm not suggesting Twitter is not a good thing, by no means, but there's just no time to do these things. Just don't have the time. I think part of looking at the press constantly and seeing what other people do, because people's decisions are largely based on other people's opinions, other people's temperament, other people's worldview, and they seek to create a framework, an investment framework of their own based on ideas that come from others. And the way to find them is reading the press, or watching CNBC, or whatever people do in the English-speaking world. If you stand back and say, I'm really not interested, anyone else does, I have inherited this small fortune and I want to deploy it in a manner that makes a great deal of sense, I'm going to sit down and figure out for myself what is the right thing to do, then you are uninterested in what other people do, because you don't know their motivation, right?
Yeah.
A year and a half ago, they asked me to speak in New York, I told you, in this forum. And they told me, he says, look, you have to say whatever you say, but then you give us 2 good investment ideas. People are used to this sort of thing and they want them.
Sure.
So I said to the organizer, I said, imagine you ask a doctor, can you give me the names of 2 good drugs? It's the same question.
Yeah.
First of all, an investment idea is worthless unless you understand whether it's suitable to someone, appropriate. Right?
Yeah.
So the fact that you take a particular medicine and it's useful for you, you don't say, Tony, you need to take that too
Try
because
this
it's
stuff.
good
It's
for
great.
me.
Yeah, right.
Well, maybe I don't need it.
Yeah, but that comes back to this point about a good investment idea has become a synonym for something that's price is going to go up, and the two are completely different.
Yeah, I don't have investment ideas.
Right.
You're right.
But that's the problem. That's the quick fix. Give me something that's going to, it's the instant gratification. This delayed gratification of investing in a business, taking a participation in a business, in a family, in an intergenerational means of preserving capital and growing capital over time, has been substituted for tell me the name of something that's going to go up tomorrow.
Oh.
And that's, to me, that's a shame. And talking to you this last couple of days makes me realize what a real shame that is, because it does take us back to this casino mentality. You give me an idea that's going to go up tomorrow. If it doesn't go up tomorrow, you're an idiot or you were wrong. Whereas he may have, quite out of the blue, plucked out one of your companies that you've spent all these months researching and know the family, and to you it's a great long-term investment. Another guy gives the same stock as a tip, it goes down tomorrow, and I sell it because it didn't go up.
I'm completely uninterested in what anybody else does. In fact, I'm happy if they sell it because I can buy more shares.
Right. Tony, look, we've spent 2 days talking, you and I. It's been wonderful opportunity to get inside that brain of yours. That people watching this will never have had that opportunity, and they may never have it again if I've scared you off of doing anything like this. But I can't thank you enough for doing this, because I know it's the last thing you want to do. For being so generous with your insight, I can't thank you enough. So thank you for doing this with me. I really appreciate it.
I'm glad to talk to you. Enjoy it.
The hours I spent talking with Tony seemed to be gone before they'd begun, and when the cameras finally stopped rolling, I found myself with almost 4 hours of footage, which I knew would be nothing short of heartbreaking to try and distill into what you've just watched. Despite his protestations that what he does is unexceptional, I find Tony to be one of the wisest investors it's ever been my pleasure to talk to, and a man who is both true to his principles and rigorous in their application. Tony looks at the world through a simple lens that harkens back to a different time, and he invests with a thoroughness and a discipline which speaks to me in what I found to be a truly profound way. To listen to Tony talk about how he invests in the people who run the companies in his portfolio, and how he seeks scarcity and endurance in a transitory, profit-obsessed world, was a revelation, a strategy light years removed from that which many of today's managers pursue. As I left the fresh mountain air of Switzerland, I knew that the lessons I'd learned from my time with Tony would have the same kind of permanence in my mind as his various participations did in his portfolio, and that I'd been exposed to skills that I would try to incorporate into my own investment process for many years to come. I'd been to the mountaintop, and I certainly didn't mind.
Of hearings investigating competition in the digital markets, this one on innovation and entrepreneurship. I now recognize myself for an opening statement. 30 years ago, the first software for the World Wide Web was released into the public domain to create a global communications network. Within a few years, search and browsing services were built onto this software to give people tools to communicate, share, and explore information through a decentralized platform that was designed to be open and non-discriminatory. Vint Cerf, an internet pioneer and co-designer of the internet's early architecture, testified in 2006 on behalf of Google that the overarching principle of the open internet was that no central gatekeeper should exert control over the internet. As he noted, this open and competitive environment meant that entrepreneurs with new ideas for applications need not worry about getting permission for their inventions to reach end users. Over the following decades, the meteoric growth of our open and competitive internet revolutionized our lives, our work, businesses, and our entire world. Millions of new good-paying jobs were created, and greater access to information promised a renewal of our democracy and social progress. This environment also fostered the growth and dynamism of 4 companies that will testify at today's hearing: Google, Amazon, Facebook, and Apple. Each of these American companies have contributed immense technological breakthroughs and economic value to our country. They were started on shoestring budgets, in dorm rooms and garages, and are a testament to our core values as a country. But in an effort to promote and continue this new economy, Congress and antitrust enforcers allow these firms to regulate themselves with little oversight. As a result, the internet has become increasingly concentrated, less open, and growingly hostile to innovation and entrepreneurship. Megan Del Rahim, the Associate Attorney General of the Antitrust Division, recently noted, and I quote, "There are only one or two significant players in important digital spaces, including internet search, social networks, mobile and desktop operating systems, and electronic book sales," end quote. Google controls nearly all of the search market in the United States, and over 90% of all internet searches are conducted via Google platforms. Amazon controls nearly half of all online commerce in the United States. Despite statements from the company that it only captures a small percentage of retail in the United States, the reality is that half of American families have an Amazon Prime account, up from only 35% just 3 years ago, and Amazon's closest competitor, eBay, controls less than 6% of the market for online commerce. Facebook controls over 58% of the U.S. social media market, and it has approximately 2.7 billion monthly active users across its platforms. Notwithstanding the growing popularity of TikTok, a Chinese video sharing app, Facebook captures over 80% of global social media revenue. And as Facebook co-founder Chris Hughes has recently observed, no major social networking company has been founded in the United States since the fall of 2011. And finally, Apple is under increasing scrutiny for abusing its role as both a player and a referee in the App Store through prices that may be higher than a competitive market would allow and policies that may favor Apple's own products and services. As the Supreme Court recently noted in Apple versus Pepper, regardless of price, and I quote, "Apple pockets a 30% commission on every app sale," end quote, in addition to developer membership fees and a 30% commission on in-app purchases. A former Apple executive who oversaw App Store approvals for 7 years has also described Apple as having, and I quote, "complete and unprecedented power over their customers' devices and using this power as a weapon against competitors," end quote. Although Apple has made a series of laudable commitments to protect consumers' privacy online, as the New York Times editorial board recently noted, its management of the App Store is, and I quote, "dangerously reminiscent of the anti-competitive behavior that triggered United States versus Microsoft, a landmark antitrust case that changed the landscape of the tech industry," end quote. Several reports by leading economists and competition experts also suggest that the dominance of these firms is unlikely to be challenged by new rivals due to certain features that characterize digital markets. As these reports have found, the combination of high network effects, high switching costs, and the self-reinforcing advantages of data can result in a winner-take-all market that shield dominant firms from competitive threats. At the same time, there's growing consensus among venture capitalists and startups that there's a kill zone around Google, Amazon, Facebook, and Apple that prevents new startups from entering the market with innovative products and services to challenge these incumbents. And in recent years, the number of technology startup financings has dropped significantly, from above 10,000 startup financings in 2015 to just above 6,000 in 2018, while the number of venture capital deals for investment beneath $1 million have also declined significantly. And even when tech startups escape the investment kill zone, they remain extremely reliant on these platforms in other ways. According to a recent report in Bloomberg, 17 out of 22 initial public offerings by significant technology companies such as Lyft and Pinterest cited online platforms as competitors or risks to their business. As this report noted, and I quote, "the tech giants have the power to change their services at any time, generating havoc downstream," end quote, on smaller firms. And while the explosion of the early internet connected local businesses to broader markets, there's growing concern that anti-competitive practices and the gatekeeper role of online platforms is now imperiling small business in our communities. As Stacy Mitchell of the Institute for Local Self-Reliance will testify today, and I quote from her written testimony, "powerful online gatekeepers not only control market access, but also directly compete with the businesses that depend on them," end quote, undermining entrepreneurship and economic opportunity. As I've said before, this trend is not compatible with the open internet or its defining features that have allowed innovation and entrepreneurship to flourish. As Tim Wu will testify today, the United States is at risk of losing the best of our innovation culture and instead being a country of giant, lumbering concerns where incremental improvement is the norm, and where innovators dream of being bought, not of building something of their own, end quote. Most importantly, for purposes of today's hearing, this trend is not the inevitable consequence of technological progress. It is the result of policy choices we are making as a country. Over the past decade, the largest technology firms have acquired over 436 companies, many of which were actual or potential competitors. For example, according to the New York Times report by Tim Wu and Stuart Thompson, of the 270 companies Google has acquired, 171 involved actual or potential competitors, and of Facebook's 92 total acquisitions, 46 involved actual or potential competitors. But not a single one of these acquisitions was challenged by antitrust enforcers. In fact, only a handful of these were closely scrutinized. And in the 2 decades since the Justice Department filed its landmark monopolization case against Microsoft, there's not been a single complaint filed by either agency alleging anti-competitive conduct in this market. Together, these enforcement decisions have created a de facto immunity for online platforms. I hope that today's hearing provides an opportunity for a serious and sober discussion about these trends and possible paths forward to addressing them. As Tim Berners-Lee, the inventor of the World Wide Web, recently observed, unless we examine and address these trends, and I quote, we can expect the next 20 years to be far less innovative from the last, end quote. In other words, this hearing isn't just about the companies before us today. It's about ensuring that we have the conditions for the next Google, the next Amazon, the next Facebook, and the next Apple to grow and prosper. With that in mind, I thank both of our panels of expert witnesses for appearing before us today, and I now recognize the gentleman from Wisconsin for his opening statement, Mr. Sensenbrenner.
Thank you, Mr. Chairman. Innovation and entrepreneurship are the hallmarks of the American economy. This has been true in the past, and it remains true now in the digital age. Today's hearing will focus primarily on the impacts large online platforms have on innovation and entrepreneurship. This is a critical topic, and I want to stress that we must take a fair and balanced approach to it. There are some who advocate that the biggest platforms should just be broken up because they supposedly dominate too much of the market. That impulse seems misguided for several reasons. First, just because a business is big doesn't mean that it is bad. Antitrust laws focus on the conduct of companies and whether that conduct is anti-competitive. They do not exist to punish businesses just because they're big. Likewise, the antitrust laws do not exist to punish success. On the contrary, they exist to foster it. The most innovative, successful, and competitive companies are often become very big, not through anti-competitive conduct or violations of antitrust laws, but simply by providing a better service or product than the other companies in the marketplace. Second, as the written statements offered by some of our witnesses attest, big online platforms can present small companies in many sections with a better way to reach the most customers. Breaking up big businesses simply because they're large could end up hurting lots of small businesses throughout the country. Third, breaking up big platforms won't necessarily solve a problem associated with those platforms. For example, the privacy issues are prominent in today's discussions of what's going on wrong online. But breaking up the big platforms into smaller ones might actually compound the problems of protecting privacy. I raise these points not to dismiss the idea that there might be genuine issues of anti-competitive conduct in the online ecosystem. However, I want to offer a counterpoint to some of the more radical positions that are being articulated. We should take a serious look at allegations of wrongdoing. Perhaps we'll hear some of those today, but we should not rush to amend the antitrust laws or break up companies by congressional fiat based upon false notions that being big is inherently bad, or that everything a big company does should be presumed to be anti-competitive. And I yield back the balance of my time.
Thank you, Mr. Sensenbrenner. I want to just acknowledge that both the chairman of the full committee, Mr. Nadler, and the ranking member of the full committee, Mr. Collins, are on the floor right now. And when they come to committee, they'll be recognized, if it's okay with Mr. Sensenbrenner, for their opening statements. And at this time now, I would like to introduce our panel. We have two panels of witnesses today. It is now my pleasure to introduce today's first panel. Our first witness is Adam Cohen, the Director of Economic Policy at Google. Before joining Google, Mr. Cohen was an economic correspondent for Dow Jones and the Wall Street Journal, reporting out of both London and Brussels. Mr. Cohen received his AB from Harvard University and his MS from the London School of Economics. Our second witness, Matt Peralt, is Head of Global Policy Development at Facebook, leading the company's global public policy planning efforts on law enforcement and human rights issues. Mr. Peralt has also overseen public policy for WhatsApp, Oculus, and Facebook artificial intelligence research. Before joining Facebook, he was counsel at the Congressional Oversight Panel, as well as a consultant at the World Bank. Mr. Peralt received his bachelor's degree from Brown University, his MPP from Duke University Sanford School of Public Policy, and his JD from Harvard Law School. Our third witness is Nate Sutton, Associate General Counsel of Competition at Amazon, who oversees all competition-related litigation and regulatory matters for the company. Before joining Amazon, Mr. Sutton was a trial attorney with the Department of Justice Antitrust Division for 9 years, working on civil antitrust matters. He also worked at the law firms of William & Conley, LLP, from 2001 to 2007. Mr. Sutton received his BS in nuclear engineering from North Carolina State University and his JD from the University of Chicago Law School. The last witness on our panel is Kyle Ander, Vice President of Corporate Law at Apple. Prior to joining Apple, Mr. Ander spent 4 years as the Deputy Chief Trial Counsel with the Federal Trade Commission's Bureau of Competition, managing a trial staff of more than 25 attorneys and support staff. He also served as the Principal Competition Attorney, advisor to Commissioner J. Thomas Roche, as well as the DOJ's Antitrust Division. Mr. Ander received his BA from the University of Pennsylvania and his JD from the University of California, Berkeley School of Law. We welcome all of our distinguished guests on our first panel and thank them for participating in today's hearing. Now, if you would please rise, I'll begin by swearing you in. Please raise your right hand. Do you swear or affirm under penalty of perjury that the testimony you are about to give is true and correct to the best of your knowledge, information, and beliefs, so help you God? Let the record show the witnesses answered in the affirmative. Thank you. You may be seated. Please note that each of your written statements will be entered into the record in their entirety. Accordingly, I ask that you summarize your testimony in 5 minutes. To help you stay within that time, there's a timing light on your table. When the light switches from green to yellow, you have 1 minute to conclude your testimony. When the light turns red, it signals your 5 minutes have expired. Mr. Cohen, we'll begin with you.
Chairman Cicilline, Ranking Member Sensenbrenner, and distinguished members of the committee, thank you for the opportunity to appear before you today. My name is Adam Cohen, and I'm Director of Economic Policy at Google. In my role, I lead our public policy work on antitrust issues. Google was founded in 1998 by 2 students who had a big idea: organize the world's information and make it universally accessible and useful. In their earliest form, Google's search results were simply 10 blue links on a web page. 20 years later, we provide our users with much richer results, including direct answers to questions, pinpoints on a map when they search for an address, and direct links to flights, products, and a range of other information. As a responsible and successful company, we understand the importance of discussing how our business works and how we compete. We are proud of our record of continued innovation. We face constant pressure to improve our products and services, both sure signs of a competitive marketplace. In my testimony today, I will focus on the value Google and the wider technology sector are creating for the U.S. economy, our investments in new technologies, and our industry's competitive dynamics. For the U.S. economy, Google's products and services create significant value, generating an estimated $335 billion in economic activity in 2018. This has benefited a wide range of consumers and businesses across the country. Firms that once operated in a local or regional market now reach national and international customers using our tools. We've also made substantial direct investments in the U.S. economy. Last year, we hired more than 10,000 people and invested over $9 billion in data centers and offices across the country. In February, we announced plans to invest an additional $13 billion this year, with major expansions in 14 states. These new investments will give us the capacity to hire tens of thousands of additional employees and create more than 10,000 new construction jobs. Overall, the technology sector supports roughly 12 million American jobs, the equivalent of 7.6% of the total U.S. workforce. It is a vital source of new jobs. And for consumers, technology companies continue to provide innovation and better prices. Prices in the tech sector fell in 2018 compared to an increase in the rest of the private sector. When it comes to investing in innovation, technology companies are America's largest spenders on research and development. As an example, Google last year spent $21.4 billion on research, development, and related areas, 3 times more than in 2013. Our continuing investments spur innovation that improves our own products and services and also supports and accelerates innovation among other firms. We share many of the results of our research in new technologies, typically through open source software. This helps broad communities of developers to use our advances in their own applications and services. In terms of competition, our industry is highly dynamic and drives innovation that gives consumers better choices at lower prices. For example, when consumers search for information, they can choose among Amazon, Yelp, Microsoft, Travelocity, and many other companies like these that consistently report strong user growth. If you don't want to use Google, there are many other information providers available. We also face formidable competition around the world. Our success enables us to make the research and development investments necessary to compete in a global environment with other global players. New firms are competing too. We continue to see record-setting venture capital activity, with over 8,000 venture-backed companies raising more than $130 billion in financing last year, the highest amount in over a decade. The technology sector has had one of the highest rates of business formation and job creation in the country over the past 3 decades. In fact, in the first quarter of 2019, a record 147 American companies reached so-called unicorn status, with valuations exceeding $1 billion. These companies had a combined value of $582 billion in the first quarter of the year, the highest aggregate value ever recorded. That's a rate of new business success unrivaled elsewhere in the U.S. economy, creating new companies that compete with established companies across many areas. To conclude, even as progress and innovation expand, sound regulatory frameworks help ensure our societies and economies continue to benefit from new technologies. We look forward to continued work with the committee as it examines these issues. Thank you for your time, and I look forward to your questions.
Thank you, Mr. Cohen. Mr. Peralt is now recognized for 5 minutes.
Thank you, Chairman. Chairman Cicilline, Ranking Member Sensenbrenner, and distinguished members of the subcommittee, thank you for the opportunity to appear before you today. My name is Matt Peralt, and I'm a Director of Public Policy at Facebook. I've been at the company for 8 years, and I focus on competition and economic policy. It's an honor to be here to discuss these important issues. Facebook is an American success story. We were founded in a college dorm room 15 years ago, and since that time, we've helped transform the way people around the world communicate, connect, and share. We believe deeply in the values of competition and innovation, values that are fundamental to the success of the American economy. And it's precisely because of these shared values that Facebook has grown from a dorm room idea to a vibrant American company. New apps enabling people to connect, discover, communicate, and share are emerging all the time because barriers to entry for digital platforms are low. Launching a new mobile app or online service often requires minimal staff, capital, and infrastructure, and the rise of cloud computing and app stores enables these platforms to reach a global audience. Consumers move easily between different apps and services. If they don't enjoy a product or experience, they'll leave it and explore other options. We face intense competition for all of the products and services that we provide. To name a few examples, Twitter, Snapchat, iMessage, Skype, Telegram, Google, YouTube, and Amazon offer photo and video sharing, messaging, advertising, and other services that compete with Facebook. In fact, more than 92% of advertising happens off of Facebook, and less than a quarter of US online ad spend goes to Facebook. And our competition isn't just here in America. We compete with companies from all around the world. TikTok, for example, a Chinese app launched less than 3 years ago, has been downloaded more than 1 billion times and was the most downloaded iOS app in the world in 2018. Facebook was transformative and groundbreaking when it launched, and we worked hard to remain so today. That's why we push ourselves to evolve and experiment, to develop the next big technologies that will change how people connect and communicate in the future. I'd like to touch briefly on 4 of the ways that Facebook is investing in innovation. First, through developing new products and features. When Facebook was created, the site consisted mostly of text details about each user. Now users can message, read news, broadcast live video, connect with businesses, send and receive payments, and raise money for important causes, just to name a few options. And the Facebook family goes beyond software to hardware products like Portal and Oculus. We're proud of how much we've invented and innovated, and of how much our products and services have improved. Second, our investments in research and development have played an important role in fueling our innovation. We devoted nearly 20% of our revenue last year to investments in innovation, and we've made significant advancements in areas like artificial intelligence, virtual reality, and energy-efficient data centers. Third, our acquisitions have been a powerful force for innovation. Companies like Instagram and WhatsApp have had increased opportunities to innovate as part of the Facebook family. We are better together, and that's good for users. Fourth, Facebook has democratized advertising, helping millions of small and medium-sized businesses. Our advertising platform can accommodate almost every budget, and we help advertisers reach their target audience and maximize their impact. Our services have enabled small and medium-sized businesses to grow, create jobs, and more effectively compete with larger companies, leading to more choice and better products for consumers. We've heard countless examples of small entrepreneurs in Rhode Island, in Wisconsin, and across America who couldn't afford print or TV ads, but who have been able to succeed by using our services to reach a local, national, or even global audience. Facebook is constantly working to find new ways to help people connect, communicate, and share. Like many successful American companies before us, we've grown by taking risks, learning from our mistakes, and constantly striving to improve. We recognize that we're a work in progress, and we're committed to addressing the challenges we face as a company, but we're incredibly proud of what we've accomplished so far. I appreciate the opportunity to be here today, and I look forward to your questions.
Thank you, Mr. Peralt. I now recognize Mr. Sutton for 5 minutes.
Thank you, Chairman Cicilline, Ranking Member Sensenbrenner, and members of the subcommittee. In my brief remarks today, I will provide some background on Amazon's approach to business and on the industries in which we operate. I will discuss our relationship with third-party sellers that sell in our stores, and I will explain the positive effects we have on competition and the economy. Amazon's mission is to be Earth's most customer-centric company. Our corporate philosophy is firmly rooted in working backwards from what customers want. And we seek continually to innovate to provide customers the best experience. This principle is essential to understanding Amazon as we apply it to all areas of our business. Amazon operates a diverse range of businesses, from retail and entertainment to consumer electronics and technology services. In each of these areas, we face intense competition from well-established competitors. For example, retail, which remains by far our largest business, is as old as human commercial experience. It has long been and continues to be characterized by intense competition at every level. New technologies such as the internet have only made retail more competitive, reducing barriers to entry and expanding output. Studies show that retailers sell and customers shop in multiple stores, both offline and online. In fact, as Target and Best Buy recently announced, one of the fastest growing consumer practices is a mix of offline and online, whereby customers order products online that they later pick up in a physical store. And there are now dozens of online marketplaces in the US and around the world. The result in retail is an ever-broadening array of competitors, including many large and well-known companies like Walmart, eBay, Target, Safeway, Wayfair, and Kroger, not to mention large and growing global competitors such as Alibaba and Rakuten. Amazon's success in retail depends on our partnership with third-party sellers that sell their products right alongside our own products. We have invested heavily in these sellers, and they are growing twice as fast as Amazon's own retail and make up almost 60% of total unit sales in our stores. These businesses are primarily small and medium-sized firms, and last year, almost 200,000 of them sold more than $100,000 in our stores. Amazon supports these sellers because we have a strong incentive to do so. The broad selection and price competition these sellers bring to our stores are attractive to our customers. For example, our selling partners provide the vast majority of new products in our stores. We know sellers have other ways to reach customers, so we invest in them, support them, and make continuous efforts to improve their experience. We have dedicated teams assigned to supporting sellers, launch new tools to help them increase sales, and spend significant resources to root out bad actors and prevent fraud and abuse that harms both sellers and customers. If we did not make these efforts on behalf of our selling partners, they would sell fewer products in our stores and more through our competitors. Amazon's investments in retail have also benefited the economy more generally. We have invested tens of billions of dollars in infrastructure and technical services. We employ more than 275,000 people in the United States. We offer a $15 minimum wage and valuable benefits. We continue to invest in our employees through workforce training programs. For example, just days ago, we announced an initiative to invest $700 million to provide 100,000 of our employees new skills and training to help them move into more advanced jobs or find new careers. From our vantage point as a retailer in a highly competitive field, we offer two views for the committee's consideration. First, the technology used to provide a service is not the primary factor in a competitive analysis. Consumers benefit from all retail competition, regardless of the precise business model involved. In today's retail market, the notion that two products that are exactly the same do not compete with each other simply because one was ordered online and one was bought in a brick-and-mortar store makes little sense. Second, to avoid unintentionally tilting the competitive playing field, new rules should encompass all retailers, regardless of the supply models that they use. Thank you, and I look forward to answering any questions the committee may have.
Thank you, Mr. Sutton. The chair now recognizes Mr. Andier for 5 minutes.
Thank you. Mr. Chairman, members of the committee, thank you for inviting me to speak with you today. My name is Kyle Andier, and I am Apple's Chief Compliance Officer. And I spend a lot of time focusing on business ethics and competition legal issues. Apple is a proud American company with a 40-year history of innovation in very competitive markets. Our mission is to make the best products and services in the world in each of the markets where we compete. For us, it's never been about making the most. It's always about making the best. We design our technology to be easy to use and safe and secure for all customers. We see our customers' privacy as a fundamental human right, and we embed that value in everything we create. We go above and beyond to incorporate leading accessibility features to make sure everyone can get the most from their devices. And our products are made with our responsibility to the environment in mind. We're deeply proud of the role we play in democratizing coding and other high-tech skills all around the world. In discussing Apple's online platforms, we consider 5 distinct categories: iOS, macOS, watchOS, tvOS, and our soon-to-be-released iPadOS. Our products run and compete on these platforms. We are very proud of each of these and feel that they are the best in each of their categories. We only create great products, not commodity products, and as a result, we do not have a majority share in any one of these categories. For Apple, the competition is fierce. Our customers have an ever-growing number of choices when it comes to products and services. We compete against some of the largest companies in the world, both foreign and domestic. We work hard every day to retain and grow customer trust and to compete for their business. Each of our platforms depends on a thriving ecosystem, from the App Store to peripherals and accessories to partners such as service providers and car makers. Our expertise in software enables experiences like moving seamlessly between Apple devices, finding your same messages in Safari bookmarks no matter which device you use, and taking advantage of features like CarPlay that integrates your iPhone into your daily commute. The benefits of this ecosystem and the innovation it makes possible are clear to our customers. It means, for example, world-class security and unparalleled ease of use. We are also proud to offer services where millions of artists and entrepreneurs can share their work and ideas, like Apple Music, hosting more than 50 million songs from artists around the world, podcasts, where hundreds of thousands of topics are discussed and shared, and the App Store, which has spawned new opportunities for everyone from the individual entrepreneur to the biggest companies in the world. Since its launch in 2008, the App Store has been vibrant, competitive, and ever-growing. It has transformed the experience and reduced the costs of software distribution. So anyone with a great idea can invent a new app and distribute it worldwide from home. We're proud that App Store entrepreneurs across this country have generated over 1.5 million US jobs across all 50 states. We designed the App Store to be both a safe and trusted place for customers to discover and download apps that interest them, and a great opportunity for developers to start businesses. In entering the App Store, every developer abides by the very same guidelines, from the student in their living room to some of the largest companies. We want every creator to have an equal opportunity to succeed. We work hard every day to compete for developers who want to join and stay in our ecosystem. We're proud that a good number of apps like Pinterest, Spotify, Lyft, and Uber have built successful businesses through the App Store with support from our team and the developer tools we offer. The App Store provides an enormous opportunity for developers to reach millions of users overnight, and the vast majority of apps, over 84%, share none of the revenue they make from our store with Apple. Only a very small number of the nearly 2 billion apps in the App Store are made by Apple, and in every category where our software competes, we face multiple strong competitors. Apple believes users expect that their devices should provide a great experience out of the box. So our products include certain functionality like email, phone, and a music player as a baseline. But users have various needs, and they are free to discover and use any alternatives they might prefer. For instance, if a customer wants to use iCloud, doesn't want to use iCloud, they can use Box, Dropbox, or any number of other options. At the end of the day, our only objective is to provide our customers the very best products and ecosystem in the world. It means a phone they love, the choice of accessories that enhance their experience, and millions of applications and services at their fingertips. And when it all comes together, it means a tremendous market opportunity for everyone: entrepreneurs, artists, carriers, car makers, accessory makers, and developers. We are committed to carrying this legacy forward, believing at our core that a single great idea can unlock opportunities once unimaginable. That's what defines Apple, and it always will. Apple welcomes this subcommittee's efforts to promote American innovation and entrepreneurship, and we look forward to working with you.
Thank you, Mr. Andier. We'll now proceed under the 5-minute rule with questions. I'll begin by recognizing the gentlelady from Pennsylvania, Ms. Scanlon. We're doing a little out of order because due to the time change, a couple of our committee members have other commitments, so I want to begin with Ms. Scanlon. You're recognized for 5 minutes.
Thank you very much, Mr. Chairman, and thank you for hosting this event, this hearing. We've certainly heard a lot about the various ways in which your platforms have really developed a whole new sector of our economy, but we wanted to dig into a little bit of the anti-competitive aspects. And I wanted to focus on the issue of digital piracy and what that does in the creative community. So Creative Futures is a coalition representing 555 organizations ranging from MGM to one of our local Philadelphia theater groups. And it represents 250,000 people in the creative rights community. They've raised concerns about the impact on the competitive process of copyright theft on the Facebook and Google platforms. And specifically, they noted in a submission, unfair methods of competition can be facilitated or sometimes practiced on these massive internet platforms, and it results in less creative content than otherwise would exist, fewer new voices, and harm to legitimate non-pirated sources of distribution. So, Mr. Cohen, can you address these concerns of people in the creative rights community, particularly about how YouTube doesn't really have an economic incentive to combat widespread copyright theft, and this may have distorted the market for online streaming of movies and television?
Congressman, thank you for the question. YouTube has a very strong set of tools to prevent copyright infringing material from appearing. We developed a technology called Content ID that can remove copyrighted material before it's ever seen by anybody using the platform. We take this matter very seriously, and we provide via YouTube and other products means for consumers to find and access quality, licensed, legitimate content.
So is that the process that you use when, in fact, pirated content is uploaded, but then there's a takedown notice? Or are you talking about something else?
Congresswoman, we use a combination of automated tools. We can recognize copyrighted material that creators upload and instantaneously discover it and keep it from being seen in our platforms.
I guess an additional concern that has been raised around this issue is that if I were to Google an original show produced by the YouTube Premium, maybe something like Cobra Kai or Weird City, if I try to find pirated versions of the YouTube shows, nothing comes up. But if I go search for a pirated version of a show like Game of Thrones or Netflix's Russian Doll or HBO's Barry, torrented versions, a lot of different pirated versions pop up. So there's a suggestion that there's a discrepancy in how these tools are working because the YouTube Google shows those pirated versions are taken down, but some of the other companies' versions aren't taken down. Can you address how that discrepancy might be occurring?
Congresswoman, I have not seen any evidence of a discrepancy. We take great steps to protect copyrighted material and to show and to provide our customers legitimate means of reaching legitimate licensed content.
Well, if you do come up with any data regarding discrepancies between the various platforms, can you provide that to the committee, please?
I would be happy to.
Thank you. I'll yield back.
Now recognize the ranking member of the subcommittee, Mr. Sensenbrenner, for 5 minutes.
Thank you very much. First question is to Mr. Perot. There was a time when Facebook was a pledging operation, and people thought that others like MySpace were the future of social media. What competitive features of the social media marketplace made it possible for Facebook to overtake and vanquish MySpace and others like it?
Thank you very much, Congressman, for the question. We have rolled out many innovations over the course of the history of our product. We had a real name policy at the time that we were founded. That was important in ensuring that there were authentic interactions on our platform and provided users with a better experience. We've since rolled out many additional features, such as Newsfeed and the like button, and we continue to innovate today.
So MySpace didn't have any of those features? Is that why people went to Facebook and abandoned MySpace?
Congressman, I believe they did not have all of those features. We competed aggressively with MySpace, and we believe that that aggressive competition is in part responsible for our success today.
Well, I think what we're looking at is anti-competitive action. Did MySpace complain about what you were doing being anti-competitive, or did they just watch their ship slowly sink under the waves?
Congressman, I am not aware of anti-competitive complaints from MySpace.
Okay. Thank you. To Mr. Cohn, your written statement says that Google helped reduce prices and expand choice for consumers and merchants in the U.S. and around the world. That sounds nice, but what facts, figures, and sources can you point to us to prove that it's true?
Congressman, I saw a recent study from the Progressive Policy Institute that showed that for every $3 of advertising spent online, a business would have to spend an equivalent of $5 offline to get equal prominence. That cost savings that efficiency in those businesses goes to reinvestment. It goes to lower prices for consumers. That is a tremendous savings for the U.S. economy.
Okay. The print news media has come out of hard times. There are a whole lot of reasons for that, and Google might be one of them, but I don't think it's the exclusive reason for the print media falling on hard times. Um, you know, if I buy a copy of the Washington Post and there's an ad in there, and the Washington Post, you know, only circulates at least extensively in the Washington metropolitan area, and the same company puts an ad on Google, what do you think the exposure is between the print ad and the online ad in terms of numbers?
It can vary, Congressman. There's a lot of variety and control given to the advertiser in how they interact with online platforms, how they advertise with online platforms. One of the key things is that in newspaper advertising, you would spend a certain amount of money. When I was last a journalist, it was quite expensive to place advertisements in print media. You didn't know what your return on that investment was. It was hard to measure. In digital formats, it's easy to know when an ad is clicked on. In fact, for our services, often you only pay when an ad is clicked on, and you can then measure the effectiveness of that advertising campaign. You can have these ads reach as broad an audience as you like, or you can use them narrowly, focusing on local markets if you prefer.
What do you think about the persuasive ability? Now look toward my own campaigns. I don't think we've put ads in newspapers either daily or weekly for over 25 years because the surveys that we did showed that the people who read political ads in newspapers were either seeing what their favorite candidate was doing and mentally cheering, or seeing what the opposition was doing and saying boo. But with an online ad, and we've used those for the last couple of cycles, do you think there is at least the purpose of advertising is to educate someone toward a vote or buying a product or something like that? Have you done any marketing surveys to show that that's effective?
Well, Congressman, I'm not an expert in political advertising, but what I would say is that I think you've identified an issue that affects the newspaper industry. There are different ways of reaching customers in different settings, and the newspaper business model has come under pressure, even before the internet, from competing services like cable news, and with the advent of the internet from, newspapers used to make a lot of money from classified advertising, and a lot of that has shifted to services like Craigslist, Auto Trader for automotive ads. There are a range of competitive pressures, and I think that's probably true for political advertising as well.
Thank you very much. My time has expired.
The chair now recognizes the gentlelady from Washington, Ms. Jayapal, for 5 minutes.
Thank you, Mr. Chairman, and thank you all for being here. My district has the great honor of long being a place for innovation, a place where many small companies became large giants, including Amazon. And it is also a place where, in the past, innovation has had to be protected by the federal government. And specifically, I call your attention to, in 2001, the Department of Justice sued Microsoft, accusing the company of violating the Sherman Antitrust Act by using a monopoly to adversely affect the web browser market. And the case later settled after Microsoft agreed to make it easier for Microsoft's competitors to integrate their software with the Windows operating system. And there are many scholars out there who believe that this case is actually the one that opened up tremendous space for real innovation that wouldn't have otherwise existed and allowed a whole new wave of tech companies to spring up. And some of the companies represented here today actually flourished after that court ruling. Mr. Peralt, let me start with you. You're the head of global policy development at Facebook. Does Facebook devote any resources to identifying promising tech startups or innovative non-Facebook platforms and apps?
Not to my knowledge, no, Congresswoman.
None at all?
We certainly devote resources to understanding the competitive landscape in which we operate, but no, I believe the answer to your question is no, not to my knowledge.
So you don't acquire promising tech startups or innovative non-Facebook-owned platforms or apps?
Congresswoman, we certainly look to innovate with our products, and the focus of our acquisition strategy is focused on acquiring companies that enable us to offer a better service to the people who use our products. So we do look to acquire services that will enable us to innovate more effectively.
And they might actually be competing with you, and that might be something that you think would integrate well into your existing platform.
Thank you, Congresswoman. The focus of our acquisition strategy is on companies that will enable us to innovate more effectively and bring value to the people who use our services. For instance, at the time that we acquired Oculus, a virtual reality company, it didn't yet have a product in the market. As a result of our investment in Oculus, it now has a virtual reality product in the market.
And what about when you acquired the positivity-focused polling startup TBH 2 years ago, and then the company shut down the app after only 8 months? It also bought the app Moves and then later shut it down. How would you consider those acquisitions and terminations, if you will, of those smaller companies?
Congresswoman, it is certainly the case that some acquisitions don't work. When they don't work, we may discontinue a product because of legitimate business judgment.
I would just draw your attention to I would look at the pharmaceutical industry. According to a 2018 Yale study, some pharmaceutical companies seem to engage in what they called killer acquisitions, where they would buy smaller firms and then shut down potentially competing projects. And researchers actually found that when that happened, it was more likely that the acquired company's competing drug would be discontinued. So I'm not saying it's directly parallel, but it is one of the concerns I have. Mr. Sutton, you're Associate General Counsel at Amazon. Does Amazon devote any resources to identifying the most popular brands and products sold using the Amazon interface? So, for example, do you track the most popular non-Amazon brands that are sold in houseware divisions, or the brand of size 14 pants that's sold most often, or any other product like that?
Thank you for your question. Amazon's proud to be a company of builders and have built our company from within, not through acquisitions. With respect to data such as you identified, we do not use any seller data to compete with them. Last year was our smallest year of acquisitions, and we've only had one multi-billion-dollar acquisition, and that was Whole Foods.
I'm sorry, that was slightly different than the question I asked, which was, when people sell products on your site, do you track which products are most successful? And then do you sometimes create a product to compete with that product? Because massive trove of data, right? People that are buying products on your platform. And so you're able to see which are the ones that are doing really, really well, like that size 14 pant or that houseware that's being sold. Do you track that, and then do you create products that directly compete with those most popular brands that are out there?
Thank you. Let me answer that question. That data on popularity of products, like much retail data, is actually public data for each of our products. You can see where it's ranked. You can see how popular it is. We do not use any of that specific seller data in creating our own private brand products. And private brands is an area where, quite frankly, we lag behind many of our retail competitors who have 20 to 80% of their products as private brands, where we're only in the low single digits. We do offer private brands on occasion because we think it offers high value and low-cost items for customers, and because customers demand that, and we want to provide that opportunity for customers.
Thank you. I know my time has expired, Mr. Chairman. I just wanted to quickly say that my office recently met with a small business located in my district, and they pay a living wage. They create a high-quality product that they sell online and in a storefront, and they did have concerns, and so I know my office has reached out directly. We are right in the same place, and we're looking forward to that conversation with you to see how Amazon can make sure that it's helping some of these small businesses. Thank you.
Thank you. I now recognize the gentleman from North Dakota, Mr. Armstrong, for 5 minutes.
Thank you, Mr. Chair. And I'm glad that privacy's come up already, piracy's come up, I know censorship's come up. We've talked about newspaper advertising, and I think that's where we get into this. And everybody sitting at that table up there has a role in some of those issues. We all have different interests in that. But I think that's when and I know everybody at this table witnesses are antitrust experts, but I think one of the problems, and I think we have to recognize this, is that antitrust is very company specific and it's very fact specific. So while we may want to talk to one of you about piracy, we may want to talk to another one of you about privacy. Piracy and privacy, I should probably pick two different words. So as we do that, but I think one thing that is consistent is everybody sitting there in the companies you work for are capable of dealing with regulation. We have witnessed this before as we continue to move forward. whether it's Dodd-Frank, whether it's healthcare legislation or regulation, where we deal with this, whenever we work as a body to attempt to capture big bad actors, I would argue that oftentimes what we do is we make it more difficult for startups, whether that was our intent or not.
Would the gentleman pull his mic closer, please?
Sure. Thanks. Yeah, so I mean, and it's just a caution, and it's not that we shouldn't have these conversations, because I'm glad we're having these conversations. But I just want to say that at the beginning, that whatever concerns anybody may have with a particular company aren't necessarily the same for the other one. But as you all, as for-profit companies with a fiduciary duty to shareholders, I understand the fierce, particularly in this field, to stay on the cutting edge of innovation. I mean, and 20 years ago, GE was the most valuable company in the world, and sorry to pick on Apple, but you guys were almost bankrupt. And even through that space, and even now, even a handful of unicorn companies, even with the vast resources of other companies, can show that we miss valuable innovations, particularly in the tech field. All this just simply demonstrates how hard it is to predict what consumers will want in the future. So I guess we'll just go down, and I don't think this applies to Apple so much, but to what extent do your companies use venture capital funding to invest in startups? And I'll start with Mr. Sutton.
Thank you. Amazon is a company of builders, and we primarily build from within. I'm not sure of the exact details to the extent we use venture capital funding to start. I'd be happy to follow up with more details.
Sure. Mr. Perot?
Thank you very much, Congressman. My understanding is that we do not engage in that practice, but I'd be happy to follow up with specifics.
And Mr. Cohen?
Thank you, Congressman. We do have a venture capital arm. I'm not familiar with the size or the scope of their investments. What I can tell you is that we acquire some small businesses in order to accelerate innovation. We actually are a great incubator for technology talent as well. And somebody mentioned the number of acquisitions Google has made. We have probably spawned 10 times as many companies from former Google employees who've left the company and started companies like Twitter and Pinterest and Instagram.
And then I just go back to Mr. Peralt for a second. Your written testimony highlights the new products and features Facebook has introduced, but how many of those has Facebook developed in-house as opposed to buying? That's a really broad and long question. I understand that.
Thank you, Congressman. We have developed many in-house. For instance, we developed Newsfeed, which is now used broadly by many of our competitors. We developed the like button. We developed photo tagging. We developed a portal. We have also invested in companies that we've acquired, like Instagram, Oculus, and WhatsApp.
And what features in the current social media market, if any, could make it possible for a new fledgling competitor to take on Facebook?
Congressman, I think there are probably many different answers to that question. My understanding, for instance, is that TikTok has focused on public sharing, for instance. That may be one feature that companies like ours might be interested in the future.
And then my last question for Mr. Cohen is more of a personal question, not a congressional question, but can you explain to me why a 9-year-old would rather watch somebody play Fortnite on YouTube than actually play Fortnite? Because I don't understand.
Congressman, I am completely mystified. I have no idea.
Thank you. And with that, I'll yield back, Mr. Chairman.
Thank the gentleman. I now recognize myself for 5 minutes. I want to focus on how the state of competition online is affecting real people in the communities we represent. I think we see a tremendous concentration of economic power that is fundamentally shaping markets in a way that are often unfair, unbalanced, and not competitive, resulting in less choice and worse quality of products and services for working people. We want to make sure, as part of this investigation, that we're doing everything we can to make sure our competition system is working for the entire economy, including small and local businesses in our community. For more than half of online commerce, retailers and manufacturers of consumer goods are reliant on Amazon as a commerce platform. But as we know, and as Ms. Jaipal's question revealed, Amazon also offers its own products on the platform. So, Mr. Sutton, initially I want to say, doesn't that create a conflict of interest?
Thank you for the question. Respectfully, we disagree. partner very closely with our third-party sellers. We rely on them to provide broad selection and prices to our customers, and we've been very proud of our investments to help them grow to be a majority of our store and growing twice as fast.
That's a different question. What I'm saying is you are selling your own products on a platform that you control, and they're competing with products in the marketplace from retail, from other sellers. Right?
Thank you. I thank you for the question. That practice, I think, has been common in the retail industry for decades. Most retailers offer their own products in their store as well as third-party products.
But Mr. Sutton, the difference is Amazon is a trillion-dollar company that runs an online platform with real-time data on millions of purchases and billions in commerce and can manipulate algorithms on its platform in favor of its own product. That is not the same as a local retailer who might have a CVS brand and a national brand. I mean, it's quite different. So I want to drill down a little bit on the question that Ms. Jayapal asked you. You said we do not use seller data to compete with other sellers online. You do collect enormous data about what products are popular, what's selling, where they're selling. You're saying you don't use that in any way to promote Amazon products?
Let me answer.
And I remind you, sir, you're under oath.
Yes, thank you for your question. We use data to serve our customers, and to clarify my question, we don't use individual seller data to directly compete with them. And again, similarly, with respect to some of the most...
do you use consumer data to favor Amazon products? Because before you answer that, analysts estimate that between 80 and 90% of sales go to the Amazon buy box. So you collect all this data about the most popular products, where they're selling, and you're saying you don't use that in any way to change an algorithm to support the sale of Amazon-branded products?
Our algorithms, such as the buy box, is aimed to predict what customers want to buy, and
Sir,
we apply the same criteria whether you're a third-party seller or Amazon to that, because we want customers to make the right purchase regardless of whether it's a seller or Amazon.
But the best purchase to you is an Amazon product.
No, that's not true.
So you're telling us, sir, under oath, Amazon does not use any of that data collected with respect to what is selling, where it's selling, what products, to inform the decisions you make or to change algorithms to direct people to Amazon products and prioritize Amazon and deprioritize competitors.
The algorithms are optimized to predict what customers want to buy regardless of the seller. Okay. We apply the same criteria. And with respect to popularity, that's public data. On each product page, we provide the ranking of each product.
Okay, I just want to give you an example of an entrepreneur in Rhode Island who creates a better set of headphones. She sells her product on Amazon on the marketplace, sales soar, which is great for her, great for Amazon, because more people will become Amazon Prime customers to buy this great Rhode Island product. But instead of seeing the fruits of her success, the next thing that happens is that this hardworking Rhode Island discovers that Amazon has rolled out a direct replica of her product. And because Amazon controls the platform, Amazon gives itself top billing and demotes the entrepreneur to page 3 of the results, which most people will never see. So how would anyone, in light of that kind of sequence of events, how would any entrepreneur invest in this kind of environment where that can happen, where there's no assurance it won't?
Our incentive is to help the seller succeed because we rely on them. If we did that, we know they'd go elsewhere. They have many options. So we apply the same criteria to both, and we do not use their individual data when we're making decisions to launch private brands.
Thank you, Mr. I'm now turning to Google, to the Google search for a moment, Mr. Cohen. Similar to results in Amazon, every day people think they're getting the best, most accurate results for searches for the products or services they're looking for. But instead, what is happening is people are seeing results for Google's own services. In 2004, Google's co-founder Larry Page said the purpose of Google is to have people come to Google, quickly find out what you want, and to get you out of Google and get to the right place as fast as possible. Would you agree that Google still claims that that's your principal, guiding principle?
Congressman, our goal is to provide users information as quickly and efficiently as possible.
So I want to direct your attention to 2 studies. The first is a study that's recently produced by Rand Fishkin, a leading expert on search engine optimization. His study primarily reviewed desktops and found that a majority of traffic to Google no longer goes out to the broader web, but instead stays on Google products. The second is a research by CAFRA Consulting, which also finds that Google is increasingly keeping both a majority and a growing share of traffic within Google's ecosystem, sort of walled garden. Do you agree that these studies show that Google is no longer showing people the best products or best results, but instead is giving them results to keep them on Google's products and on Google's platform?
Thank you for the question, Congressman. I'm not familiar with either of those studies, but what I can say is that we send a lot of clicks, a lot of traffic to competitors. In our own services, we have aimed to connect merchants, airlines, a range of other services directly with consumers, making the consumer experience better and making the experience for advertisers and merchants better.
Well, I regret my time has expired, but I would just ask you to review these studies, because if innovators and entrepreneurs don't have traffic to their websites because the Google search is rigged in favor of Google's own services by keeping them inside Google's walled garden, then the internet as we know it ceases to be an engine of economic opportunity. So I would really ask you and welcome your comments after you have an opportunity to study those. And my time has long expired. I now recognize Mr. Stubbe, the gentleman from Florida.
Thank you, Mr. Chair. I've got a very important question for Apple that I believe is on the minds of all Americans. Why do you keep getting that alert for the iCloud and for the 99 cents on the iCloud all the time and constantly until you pay the 99 cents for iCloud, and then you're paying the 99 cents for iCloud, but you're not using it?
Thank you, Congressman. I'm afraid I'm not aware of the details around what you're talking about. I'd be happy to get back to you with any information on that, but I'm honestly not familiar with that.
Okay, yeah, if you can give me some information on that, because I've seen it, a lot of people have asked me about the fact that they constantly keep getting these alerts to use iCloud and you don't want to use it, but the alerts won't go away until you actually pay the 99 cents to use iCloud, but you're not using it. So if you have some information on that, I'd love to get it. I'd like to go to Amazon for a second and kind of piggyback on the chair's questions. What's the current market share of Amazon in total U.S. domestic retail sales?
Amazon is 1% of the global retail market and 4% of the U.S. retail market, approximately.
So only 1% of the domestic retail sales. So who's above Amazon in total U.S. retail market share?
In the U.S., Walmart is 2 to 3 times larger than we are.
Are there others or just Walmart?
I don't know everyone who's potentially larger. There are thousands of competitors across the retail landscape.
So who is the current market share of Amazon total U.S. domestic online retail sales?
Online is not a separate market. It's just another channel. We know customers shop both online and offline, and the evidence shows that prices have converged between online and offline. With respect to online, Amazon is one of the leading retailers. But there are many other retailers, including Walmart and every other major retailer who has a large online presence, as well as just online players such as eBay.
So you're like 1%, you stated, is that correct?
1% of the global retail market and 4% of the U.S. retail market.
Let's just focus on U.S. So 4% of the U.S. market, what's the largest market share of any retailer in the total U.S. retail market?
Amazon focuses on our customers, and so I'm not sure of exact market shares of all of our competitors because that's not what we focus on as a company. I do know, again, that Walmart is many times our size in the United States.
Okay. In Amazon sales online, U.S. retail share is growing at a faster rate of all companies or along the same level as other companies. So I know Walmart's put a lot of investment into their online platform. How do you compare to a Walmart or to other retail stores online?
Thank you for your question. The third-party reports I've seen report Walmart growing at a faster rate than we are online.
Okay. Your written statement suggests that Amazon competes directly with other sellers, serves competing sellers as a distributor, and serves other sellers simply as an online marketplace platform through which they can reach their customers, which you had testified before. Explain to me how that does or doesn't translate into whether Amazon is leveraging allegedly dominant retail market power into anti-competitive behavior against those other sellers.
I think the clearest answer to that question is from the evidence showing how much we've invested to help those third-party sellers since we invited them into our store grow. They're now the majority of our sales, and they're growing twice as fast. We think that's great for these small and medium-sized businesses, and it's great for our customers.
Are you aware of any facts or figures that show that consumer choices among outlets in the U.S. retail market is declining, or that competition in the U.S. retail market is failing to keep consumer retail prices down?
I'm only aware of data showing increasing choices for consumers today.
Oh, man, we're going to get back to iCloud. What is Amazon's share of the storage market for the online cloud, for your cloud?
We offer AWS for enterprises, which is different than a personal online storage.
Okay. Any other comment on that?
With respect to enterprises, the vast majority of that space is still operating on-premise servers, and cloud is a new and developing space. We are one of the innovators, so we are a leader, but the competition primarily exists with long-standing on-premise IT competitors.
When did Amazon get into the cloud services market?
A number of years ago. I don't remember the exact year.
And how fast has its market share grown on the cloud?
Amazon innovated in creating cloud options for both storage and compute for enterprises. So as one of the early innovators, we had a lead, but competitors, major competitors have entered and are closing that gap, such as Microsoft, IBM, Google, and many others. Although, again, cloud is still in its very early days, and primarily IT is still serviced through on-premise servers.
All right, thank you. My time's expired.
Thank you. The chair now recognizes the gentleman from Georgia, Mr. Johnson, for 5 minutes.
Thank you, Mr. Chairman, and thank you for holding this very important and timely committee hearing. And also, I want to thank the witnesses for your appearance today. Is it Perot or Perrault, Mr. Perrault, or Mr. Perot?
Thank you, Congressman. It's Perrault.
Perrault. Well, thank you, sir. Mr. Perrault, when was the last time that Facebook changed its terms and conditions?
Thank you, Congressman.
You don't need to thank me.
We evaluate our terms and conditions on a regular basis.
When's the last time you changed them?
We are constantly changing our terms and conditions to ensure that people have the best experience on our product.
Certainly. So how many times over the last year have you changed the terms and conditions?
Congressman, I don't have the specific data on that. I'd be happy to get back to you.
10 times?
Congressman, I don't have the data.
20?
I don't have the data, but I do know that we certainly face significant concerns about various different aspects of our product, including privacy. That's one of the reasons that we've actually called for regulation in that area.
Okay, well, I just wanted to know approximately how many times terms and conditions have changed. A recent report from the Stigler Center observed, quote, one way in which digital platforms exploit their market share or their market power is by requiring consumers to agree to terms and conditions that are unclear, difficult to understand, and constantly changing. Do you agree with that assessment?
Congressman, we take privacy very seriously. It's important to us that we provide users with significant transparency and control.
I understand. I guess the point I'm trying to make is the users don't really have much buy-in to the situation. They either have to check the box, agreeing to the terms and conditions, oftentimes having not read it in order to get the service or maintain the service, or they just go without the service. So a user may sign up with one set of terms and conditions, invest valuable time in building a social network on Facebook, and then a month later be faced with a different set of terms and conditions. And because there is no real alternative to Facebook, the user has no choice but to accept those changes. Isn't that correct?
No, Congressman, that is not correct.
There is competition to Facebook?
Yes, Congressman, there is. We face fierce competition for all the products and services that we offer. People come to.
Who would be the competition, if I might?
So many of our competitors
are.
No,
that's secret.
Many of our competitors are sitting here at this table with me.
I think you're in a unique chair, in a unique position among those who are seated at the table. Each one of you occupy a unique and dominant position, but Facebook stands alone in terms of social media. Any other social media platform that could compete with Facebook?
Congressman, we certainly hope that in many ways that we are unique. There may not be an identical competitor to Facebook. We try to differentiate our services in an innovative tech industry in which we compete. But yes, there is significant competition in advertising.
Well, I'd like to, offline, I'd like to get a list from you so that I could do some shopping around myself. And that's not to disparage Facebook's offering. I just would like to know who your competition is. It's not readily apparent. Facebook's terms of service maintain that users, quote, own, end quote, their data, yet Facebook has repeatedly prevented users from transferring their data to certain rival platforms, including Twitter, Vine, Voxer, and MessageMe. How do you reconcile Facebook's stated policy that users own their data with Facebook's repeated refusal to allow users to transfer their data to rival platforms?
Congressman, we do offer a data portability product, and we've offered that product for a long period of time. It's called Download Your Information. We've improved that product in the wake of the GDPR in Europe. We're actually a member of the...
You can actually transfer the Facebook data to another platform?
Congressman, you are able to take your data out of Facebook to another platform, yes. We are also members of the Data Transfer Project, along with several other companies, to try to look for ways to facilitate better data portability. And our CEO, Mark Zuckerberg, has actually called for regulation in this area because of many of the difficult technical and privacy issues at stake. It's one that we're hoping to work with Congress on to improve the offerings for our users.
All right, thank you, sir, and I yield back.
Thank the gentleman. I now recognize the gentlelady from Florida, Ms. Demings, for 5 minutes.
Thank you so much, Mr. Chairman, and thank you to all of our witnesses for being with us today. Mr. Sutton, bear with us. In recent years, Amazon has started selling digital advertisement placements. Analysts estimate that digital ads brought in around $11 billion in business last year. Because businesses are increasingly dependent on Amazon, some of them are concerned that Amazon is using its ad business to squeeze more money. As a Bloomberg reporter recently wrote, Amazon's advertising is better understood as an additional tax the company imposes on the millions of businesses that sell through its vast digital mall. It's one more toll extracted from sellers, according to the reporter. Given how dependent businesses are on Amazon's platform for online sales, what, if anything, Mr. Sutton, prevents Amazon from using ads as another way to charging a toll for using its platforms?
Thank you for the question. We do offer advertising as a service to our sellers as an optional service that's not necessary, but that they can use to help get their products discovered. The large majority of products sold in our store are not sold through advertisements. Again, there are many ways in which sellers have many options. We provide that as an additional one. We know they have many other options online where customers shop as well as offline.
So what would your response be to the reporter's statement that Amazon's advertising is better understood as an additional tax the company imposes on the millions of businesses that sells through its vast digital mall?
Respectfully, I disagree. That statement's not correct. It is not a tax. It is like many services we offer that's optional. And again, there are many other ways that sellers can advertise. They can advertise through general purpose search, which still remains the most popular way for customers to find products online. And in fact, it's one of the reasons we're one of the largest customers of Google.
Did you say the number's correct, that you brought in about $11 billion in advertising last year? That sound about right?
I don't know that exact figure. I'm happy to follow up with it.
Okay. Mr. Sutton, who do you view as Amazon's competitors with regard to third-party sellers? And if you've already covered this, I do apologize, but who do you view as Amazon's competitors as it pertains to third-party sellers?
Thank you for the question. Third-party sellers have a wide variety of ways to sell. They can sell directly through brick-and-mortar retail stores, through their own website, and there are dozens of online marketplaces available for them as well, from Walmart to eBay.
So let's just say if I'm a third-party seller, what other platforms can I list my products on that would allow them to be seen by a competing number of buyers?
Thank you. Again, they could list on Walmart, they could list on eBay. Target now has launched a marketplace. There are other marketplaces, including also the ones from Chinese companies such as Alibaba, Rakuten. They're increasing the numbers. In fact, there are so many marketplaces that there's $1 billion industry that has grown up to provide services to sellers so that they can use them to list across all marketplaces at the same time.
And you believe that those other platforms are competitive, allow for competitive services?
Yes, absolutely.
Okay. Mr. Chairman, I yield back. Thank you.
I thank the gentleman. I now recognize the gentleman from Colorado, Mr. Neguse, for 5 minutes.
Thank you, Mr. Chair, and thank you to the witnesses for appearing today and for your testimony. I agree with my distinguished colleague from North Dakota. Antitrust analysis is obviously very fact-specific, case-specific, and industry-specific, and so forth. I want to talk a little bit today about Facebook. So, Mr. Peralt, following up on a question from the gentleman from Georgia, I think what he was getting at is this. Is Facebook, in your view, a monopoly?
No, Congressman, it is not.
Okay, so I assume the reason is because, in your view, Facebook has a number of competitors, as you said, and a number of products that the company offers. That be a fair characterization of your view?
Yes, Congressman, that's correct.
What is the largest social media network platform company by active users in the world? Do you know?
Congressman, I don't. I do know that we have 2.7 billion users.
I can tell you that it's Facebook is number one. Do you know the third largest company is WhatsApp? Who owns WhatsApp, or what company owns WhatsApp?
Congressman, we do.
Facebook, correct?
Yes, Congressman.
Okay. And the fourth largest social media networking platform in the world by active users is Facebook Messenger. I won't make you answer the question. Suffice to say that that company is also, that service, also owned by Facebook. The sixth largest is Instagram. What company owns Instagram?
Congressman, Facebook does.
Okay. So you can understand the skepticism because when a company owns 4 of the largest 6 entities measured by active users in the world, in that industry, we have a word for that, and that's monopoly, or at least monopoly power. Now, you know, with respect to my colleague, the distinguished gentleman from Wisconsin, he is right that under the Sherman Antitrust Act, a measure of whether or not a company is engaged in monopolistic activities is whether or not there's anti-competitive conduct at play. But, you know, I suspect you and I may have some disagreements on that front, and just to give you a sense of the way in which I think a number of us are evaluating the facts before us, if you could turn Exhibit 1.5, if the committee staff would just put that up on the screen. This is a document. My understanding is there are a number of documents that were published about 8 months ago as a result of a parliamentary inquiry conducted by the UK Parliament with respect to Facebook and various activities of the company. This is a platform policy number 4, and you'll see under there highlighted subparagraph 1, the language, add something unique to the community, don't replicate core functionality that Facebook already provides. This was a policy maintained by Facebook, is that correct?
That is correct, although unfortunately I'm having trouble seeing the exhibit. As I've gotten older, my eyes have gotten worse.
Mine as well. It's behind you as well,
Mr.
but
Peralt.
we'll be sure to provide you a copy. This is no longer a policy maintained by Facebook, is that correct?
Congressman, that's correct.
Okay. And I presume that is because this policy, facially, could be construed as an anti-competitive one. Correct?
Congressman, we thank you very much. The Facebook platform was designed to enable third parties to engage in complementary innovation that would benefit the people who use our services. When we launched the Facebook platform, we did have rules of the road. We continue to have rules of the road that balance a variety of considerations, including protecting the user experience, protecting privacy, and protecting our investment in our products. We have reevaluated those policies over time and have changed them to fit the evolving nature of the industry in which we exist.
Well, I appreciate that, and I understand that industries change, industries evolve, and that your business has to evolve to comport with that. I would say, from my vantage point, my understanding is Facebook did have a policy early in its tenure, which it's Exhibit 1, in which the company welcomed developers with competing applications, including developers whose applications might compete with Facebook-built applications. That was a policy that was then repealed in favor of Policy 4.1, the prior document that I just showed. So this notion that Facebook has been open to competition, as you described in your opening testimony, this notion that it's a core value of the company, is not borne out by the documentary evidence that we've seen. And I think that's in part why we're having this important hearing today. I see that my time has expired. I yield back.
I thank the gentleman. I now recognize the gentlelady from Georgia, Ms. McBath.
Thank you, Mr. Chairman. Thank you, gentlemen, for your testimony today. I am truly deeply concerned about the success of businesses in my district. I represent Georgia's 6th Congressional District, and small locally owned businesses are the economic lifeblood of our communities, and they should have access to markets and consumers without facing anti-competitive constraints. I also believe that Congress and agencies have a serious responsibility to make sure that there's real competition in the market so that startups, small businesses, and local retailers are able to compete on the merits and give people the best options they can find. Mr. Sutton, this morning I met with sellers that have had a very positive experience growing their business through Amazon. But some sellers have had a completely different kind of experience. Some sellers report that Amazon uses a variety of tactics to funnel merchants into using fulfillment by Amazon. International antitrust authorities are investigating whether Amazon privileges third-party vendors that use fulfillment by Amazon. Now, does Amazon privilege vendors who use Amazon's fulfillment services over those who choose not to?
Thank you for the question. Amazon's very proud of all we've done to invest and help sellers succeed, and one of those ways is we built a very successful operation and delivery system, and we opened that up and made that available for sellers to use, fulfillment by Amazon. It's an optional service that sellers can use if they want to. We continue to invest and provide tools for them to ship directly as well. We apply the same. We do not favor products that use FBA over others. Obviously, FBA is one way to provide quick delivery amongst many, and we know that our customers do appreciate quick delivery. That's why we gave that as an option to our sellers to use amongst the various shipping options they have.
On the second panel that we have today, Ms. Mitchell, in her written testimony, she highlights how Amazon abruptly and arbitrarily suspends merchants' accounts, freezing their funds and shutting down their Amazon pages. According to her statement, Amazon frequently makes these decisions without explanation, leaving merchants to navigate a black box while their livelihoods are hanging in the balance. According to another report in The Verge, quote, sellers are more worried about a case being opened on Amazon than in actual court, end quote. So, Mr. Sutton, how many employees does Amazon have that are dedicated to addressing these kinds of concerns?
Thank you. Amazon, again, partners with sellers, and we're very proud of our success in helping them grow and now be growing twice as fast as Amazon. We reluctantly take action.
How many do you have, sir, that are?
We have thousands of employees dedicated to helping and address concerns from third-party sellers. We absolutely do not take arbitrary action, but we do have to take action on occasion. When necessary, there are a dedicated group of bad actors that attempt to sell fraudulent products or counterfeit products or even dangerous products, and we have to take swift and immediate action to protect customers and to protect the legitimate sellers. We try to do that through a transparent process, and we always provide an opportunity for sellers to appeal or to provide additional information if they think we got it wrong. In the vast number of situations, they do not take advantage of those opportunities.
So how do you respond to the concern from merchants who have been abruptly suspended by Amazon, who they say have no way of ever reaching an Amazon employee to make their case? And so what recourse do they actually have?
We provide a variety of ways for them to reach out.
Such as?
I don't know the full way. I know we have a dedicated customer team. We provide a tool, a dashboard tool, so that they can see the status of their account. We have a dedicated team that will affirmatively follow up in the more serious cases. We may communicate via email and allow them to respond and provide details via email. There's a variety of ways in which we try to always communicate and to receive communications from our sellers. I'd be happy to follow up and provide the full examples and details of that for you as well.
If you could, I'd appreciate it. It's also important to me that we keep good-paying jobs in our communities. Too often we hear that retailers, manufacturers, and suppliers have an uphill battle due to anti-competitive prices online. And Mr. Sutton, again, numerous reports have identified instances when online platforms price goods significantly below cost over the long term, threatening mainstream businesses and other retailers who can't compete on those terms. In a letter that I'm going to ask be placed in the record for today, Mr. Chairman.
Without objection.
Thank you. The Retail Industry Leaders Association notes that although intense competition is a hallmark of America's retail industry, the absence of competition elsewhere in the retail ecosystem stifles the benefits that have historically resulted from the intense competition. Through this intense competition, Mr. Sutton, once again, how do you respond to concerns that Amazon has the ability to absorb losses in any market that it chooses?
Thank you. Amazon faces fierce retail competition across many, including from many members of RILA, who are amongst our biggest competitors, such as Walmart. Amazon has run a profitable retail business for many years. The retail business, because of the competition, is very thin margins, but our retail business in the United States has been profitable.
Thank you. And Mr. Cohen, given the extraordinary
power...
power...
Lady's time has expired, but if you have...
Thank you.
Oh, thank you.
Okay, thank you.
The chair recognizes the gentleman from Maryland, Mr. Raskin.
Mr. Chairman, thank you very much. I have a question for Mr. Cohen. According to data produced by Rand Fishkin, Google controls over 90% of the search engine market in the United States. So congratulations on that. Although this seems to fit the classical definition of monopoly, Google has argued that the company's monopoly in the search market is nothing to worry about because competition is just a click away. I just want to make sure I've got Google's position right. Is that essentially the argument against viewing it as a monopoly?
Thank you for the question, Congressman. I would say that that definition of the market is quite narrow, and that when consumers are searching for information online, there are a range of different services that they use. For example, when people are searching for products, the majority of Americans start their product searches on Amazon. When they're searching for places to travel, hotels and airlines, they start with dedicated specialist competitors. So I think the market is much broader than that.
Well, let me follow up then. I understand that Google paid Apple $9 billion in 2018 and $12 billion in 2019 for the right to be the default search engine on Safari. Is that right?
Congressman, I'm not familiar with those numbers.
Okay. Billion's a big number, so it's big numbers. Would Google pay these sums if there were really an effective competitive market in place?
Congressman, I'm not familiar with those numbers. We do reach syndication agreements with a range of different partners.
Are you familiar with the deal that was made?
I'm not close to the terms of the deal. I think that, if anything, the prices probably reflect the control or the decisions made by platforms rather than somebody seeking to syndicate their services on those platforms.
Okay. I mean, my sense is that if these numbers are correct, that spending over $20 billion in 2 years to essentially secure its place as the default search engine suggests that Google recognizes that defaults matter and that switching costs for users are high. But I appreciate your thoughts on that. Let me come to Mr. Ndier. You are here. Thank you. Apple's CEO, Mr. Cook, has argued that unlike your peers who run ad-based businesses, Apple's a company that fundamentally is privacy-oriented. Do you believe that Apple is a privacy-oriented business?
Yes, absolutely. We believe privacy is a fundamental human right.
Well, then why has Apple allowed Google to be the default search engine on Safari?
Apple has, with all of its products, focused on what is the best consumer experience. And so when it comes to search, we conducted an open competition to see what did we think would be the best for our consumers. And consumers have always gone to Google. And so we ultimately selected Google, but we also make a number of options available to them. So it's very easy to change the default on your iPhone to any number of choices, including DuckDuckGo and other search engines that perhaps have more privacy protections.
Apple charges app developers a 30% tax on in-app purchases in the first year and then 15% every year thereafter. In a statement submitted for the record, Spotify argues that by charging a 30% tax on in-app purchases, Apple forces app providers to make an impossible choice, either pass the costs on to consumers or refuse to pay the commission and face a litany of technical hurdles imposed by Apple. These complaints have been echoed by other app developers, as you may know. Mr. Andier, how did Apple arrive at the amount of a 30% fee, and could Apple charge a 35 or 45 or 50% fee for in-app purchases?
So thank you for the question. 84% of the apps, over 2 million apps available on the App Store, pay nothing to Apple. It's only a very small percentage that pay a commission. When it comes to Spotify, they're one of our most successful developers, but yet they pay a commission on less than 1% of their subscribers to Apple. And so they've been able to build a very successful business thanks to the App Store, and we're proud of their success. We continue to invest in tools and other resources to make it very easy for developers to create great applications. You asked about how we came to the 30%. 10 years ago, and it's easy to forget, most software is distributed through physical distribution like CompUSA or Best Buy. Typically, a developer would share up to 60, 70% of the retail price with the distribution channel. So we set a very aggressive price of 30%, only applying to digital content in an effort to compete for those developers' mindshare, and it's been very successful.
Okay. Do I have time, Mr. Chairman, for one more question? Okay, just a quick question for Mr. Perot. Facebook announced in January that it would be integrating WhatsApp, Instagram, and Messenger, an announcement that coincided with growing calls in different places to break up Facebook, specifically by undoing the buy-up of WhatsApp and Instagram. Facebook says the integration will let it protect users by providing end-to-end encryption. Is Facebook's integration ploy an attempt to thwart or preempt these efforts to break up Facebook?
Thank you, Congressman. No, it is not. We face fierce competition for the products and services that we offer. It's our understanding that there are many services in the market that offer more and more privacy protective services, and so our pivot toward privacy with respect to interoperating our services was because of the competition that we face in the market.
Okay, Mr. Chairman, I yield back. Thank you.
I thank the gentleman, and the ranking member has agreed to do a second round of questions, so I appreciate that indulgence. Mr. Sutton, I want to just turn to you for a moment. In your testimony, you have repeatedly emphasized
This was the 54th annual shareholder meeting for Berkshire Hathaway. And while shareholder meetings are known for being lightly attended, staid, and downright boring, this was anything but. More than 40,000 people attended here, including business leaders like Activision Blizzard CEO Bobby Kotick, Quicken Loans founder Dan Gilbert, and Spanx founder Sarah Blakely. And for the first time, Apple CEO Tim Cook was in attendance. Apple is now Berkshire's largest equity holding, and Berkshire is Apple's third largest shareholder. We caught up with Cook this weekend and asked him what he thought about it all.
I think it's incredible. I've never been to an annual meeting like this before. You know, I thought ours was lively, but there's 40,000+ people here. And I love the fact that Warren and Charlie take every question, and of course, through all of it, not just the wisdom that they exude, but you can feel the integrity and the humility coming out. And I think it's a great learning experience for me and for everybody in the audience, I'm sure.
Joining us now is Berkshire's chairman and CEO, Warren Buffett. And Warren, what's it mean to you to have gone through this weekend?
It's a lot of fun. I mean, you see who you're working for, and they see you, and you interact with them, and they come in sort of a Mardi Gras spirit. I would say in the last 10 years, with now maybe 40, well, from out of town, not 40,000, but a great many from around the world. I just never get a letter of complaint. I mean, I know that somebody misses planes or has a car rental that isn't available or a hotel room, but they just come in the spirit of enjoying it, and the people in Omaha welcome them that way. So people go around with smiles on their faces. I mean, we have 600 of our own people that come in from our various subsidiaries, and they really work for a couple of days, and I've never seen anything but smiles on their faces.
Well, unfortunately, we're not going to allow you to rest on your laurels this week because we have some major news that's breaking this morning. You see the markets already down by almost 500 points, the futures here for the Dow. What do you think about the potential for trade tariffs coming back on and what that might mean for the trade talks?
Well, I can't gauge how both sides will play the game, and they're always, some people negotiate different ways, if we actually have a trade war, it will be bad for the whole world, and could be very bad depending on the extent of the war. But there's times in negotiations when you talk tough. The one thing you can't do, though, is you can't shake your fist first and then shake your finger later on. I mean, that is not a technique that works well. So when you do push ahead, you don't know exactly what the outcome's going to be.
Well, you can't shake your fist first and then shake which finger later? What are you talking about?
Well, you're more advanced on this than I am, actually. But that's what you're worried about, is you get the other finger back, and you have to mean it after a while. Otherwise, it doesn't mean anything, obviously, when you do that. And you're gauging a response from someone else that also has their own calculus and has their own internal political considerations and so on. So it's a dangerous game. Doesn't mean it's a game that shouldn't be engaged in, but it's a dangerous game.
You negotiate a lot of deals too. Would this be your tactic?
Well, it isn't mine at all, but you know, we can talk about the Occidental deal later on, the illustrator, but I've had a consistent way of negotiating, and that has its advantages. Probably has its disadvantages too. But I just say what I'll do, and I don't do anything else. So people really know that's what I mean, and they can decide whether what I've said is acceptable or not. But they know that I don't go through a game. Now, there's lots of people in acquisitions that really like to play games, and they're used to it in their own business, and it's their way of doing it, and that's fine, but it doesn't work with me. And I don't want to, I can't afford to spend the time on it. I mean, you know, you don't know whether you're ever going to get there, and you spend weeks and months, and it's just, it would be a huge time waster if we did it.
You know, I don't know that this is bluster coming from President Trump, though. He's already put the tariffs on. And I don't know that I would take this lightly and think that we're not going to be seeing 25% tariffs on Friday.
You can't, but if you're playing the game, you have to sound that way. I mean, if with some people in negotiations, the best technique is to act half crazy. I mean, you know, with your kids, you can see how it works. You know, I mean, you're negotiating things with your children all the time. You know, I'm going to count to 3, and if you don't do this and that, you know, but they know you're not going to shoot them in the end. So they've really got the edge, and that goes on all the time. And it's interesting, kind of, with the reputation of the industry. We bought a very large auto dealership operation a few years ago, and we did make more or less our kind of deal. We named the price, and probably 20 times since then, people come out and they say we want to do something, and they just we've never found one that we could do the same way. I mean, they just it's just part of their lives to negotiate. It's part of my life not to negotiate. So
you mean to come in with a high offer and
sure.
expect that you're going to negotiate?
Yeah, anything
them down.
you say, and I understand that. I mean, that's the way a lot of things take place. But probably a majority of transactions, but it's nice to have a reputation for not doing it because it makes it a lot easier. You save a lot of time.
Well, let's talk about what it would mean if tariffs on Chinese goods rose to 25% from 10% on that $200 billion worth of goods at the end of the week. How significant is that? What would it mean for Berkshire's businesses?
Well, it would mean a lot to the world. It isn't just the countries involved because, they take the dollars they receive from us net and they buy goods in other places. I mean, their trade surplus is considerably less overall than their trade surplus with us. So everything intersects in the world, and it depends who gets retaliatory with us or with them, and it's easier to start it than it is to stop it, and the effects would be huge if conducted on a major scale over time. Just imagine, Becky, that our Constitution was set up differently, and that states could erect tariffs, and Michigan would put a tariff in on cars, or we would have one on corn, and that. The degree to which trade would contract in this country, the mislocated plants, the migration of workers, I mean, it would be, well, it sounds ridiculous to talk about it because it is ridiculous, but you've got countries where you would have similar effects if you get country after country after country, because you can't just have it between two countries. It will spread. Now, the very fact that it's sort of a nuclear threat is what brings people to the table. So I mean, that's the way that many play the game. But you don't want to have too many nuclear threats out there, because someday somebody may feel they have to fulfill one.
Right. Obviously, that's why the global markets are under pressure.
Sure.
It's not just Chinese markets that are down. You saw the Korea Kospi was down by about 3%. Markets down just about everywhere at this point.
It affects everything.
So that's you're saying the market's reaction is the right one. It's not an overreaction.
It's rational, and then we'll see what happens next. But obviously, if you went to bed a week ago and you thought there was a 1% chance of a trade war, and then subsequent events makes you think there's a 10% chance, markets reflect that very quickly.
What would you put in terms of, I mean, you're an actuarial mind in terms of these things. What kind of odds would you put on it?
When you talk about two leaders of the two major economic powers in the world, that's not the sort of thing I can lay odds on. I mean, you were talking about two personalities who are very much used to getting their way in politics, and you're talking about how they will be perceived in their own country in terms of their behavior, and it gets very complicated. There's no way I know how to predict that.
Although you've written insurance contracts on weirder things than this,
yeah.
What would it take for you to ensure that there was a deal done at the end of this?
It would take a big premium. Yeah, this would not be the kind of thing I would look to insure, frankly.
Because it's so unknowable?
Yeah, and you'd have a hard time finding the risk precisely, because if they lasted for a month, and then so you get into the duration of how long it was, you'd have a lot of trouble writing the contract. But it is the sort of thing, not precisely identical, but it's that we do take on unusual risks. But this is a big one.
What will it mean for Berkshire businesses specifically? And I just think on Friday we spoke with Jim Weber, who's the head of Brooks Running. They've already relocated and moved a lot of their operations to Vietnam because of this concern. They've been in the process of doing that since these trade talks first kind of appeared.
Well, we've seen it in our rail carload, intermodal, the stuff that arrives on the West Coast. I mean, everybody stocks up ahead of time, and it distorts things just thinking about it. You can imagine the distortion if you get into it, and you really can't predict the speed or the degree of effect because it spreads. You can't do something between U.S. and China in a big way without it affecting all the major markets as they go around. And you're starting a game that you don't know the ending of, but you know it isn't a good game.
You say
but like you say, it may be necessary to play another game to avoid that sort of thing. I mean, that's what mutually assured destruction was. I mean, you felt as long as you had mutually assured destruction, nobody would actually launch a missile. And this is can be a similar type game, a little bit of chicken in it.
You say that intermodal rail loadings were affected by it, meaning that you saw an increase in rail car loadings because months ago because people were trying to stock up.
Yeah, people loaded up on inventory that they thought might. I mean, if you thought there was going to be a 25%, I mean, if I thought there was going to be a 25% tax on Coca-Cola next week, I would have my house filled with Coca-Cola. It would look very good. Sales would look terrific, and guys that transported my house would be doing great and everything, and boom, it'd all end.
Well, that's a big concern. I mean, if we've been looking at this great economy and thinking things are wonderful, but it was really just pulling things forward, and then you get into a situation where it stops down, does that concern you just about
economic growth? Well, it pulls things forward, and I think actually in the GDP figures there was a big inventory adjustment, no, if you think the flow of something is going to either stop or get more expensive, and you need it, you're going to load up ahead of time.
Will this change your behavior in any way when it comes to purchasing securities or making deals?
No, we will buy the same stocks today we were buying last week. It's just I won't tell you their names.
But would you buy more if you get them down 500 points?
The cheaper they get, the more I buy.
But it doesn't mean that you don't think the markets could go down further.
No, I'm not buying them because I think they're going to go up the next day or the next week.
Yeah. So it's something you're watching very closely?
Yeah. Yeah, but we watch the prices of things we do more than current events. Mm-hmm. Because in the end, we aren't buying them because what's going to happen next month or next quarter. You know, we're really buying them because we think they'll be good businesses 10 years from now. If somebody came to us with a good business today, we'd buy it. And we'd buy it regardless of what's going on in the tariff situation. We might have, this won't be the case, but we're more likely perhaps to get something when other people are fearful. And you see that in a big way instantly in a market, in the market for businesses. But it's still there with people's minds.
Welcome back, everybody. We are here and news is breaking. There's just an SEC filing that came out from Kraft Heinz. That's obviously a big Berkshire Hathaway holding. Kraft Heinz says that it will restate earnings for 2016 and 2017 due to misstatements in the original filings. It does not, however, believe that the misstatements are what they call quantitatively material to any individual reporting period. It says that the impact on adjusted earnings is expected to be less than 2% for each year. Kraft Heinz says that it has now completed an investigation that shows several employees in its procurement operation engaged in misconduct, but none of those were members of senior management. Our guest today, again, is Warren Buffett. He's the chairman of Berkshire Hathaway, which owns a major portion of Kraft Heinz. And Warren, what do you think of this news just hitting while we're sitting here?
Well, that's more or less what I've heard. I'm not on the board anymore, but Greg Abel and Tracy Britt-Cool are on, and so I've heard from them. This is an update that I heard last night and they can't issue the first quarter reports until the 10K is filed, and they can't file the 10K till Price Waterhouse signs off on it, and that apparently is going to require a restatement of a few years, and we could not report any earnings from Kraft Heinz in the first quarter because if we get a dividend from Bank of America, that dividend goes into earnings. But because we have over 20% of Kraft Heinz, we don't report the dividends, we report the earnings. So we received a dividend of about $130 million in the first quarter, but that we don't report that. And we expected to get the earnings before we issued our own report. But when the time came to issue our report and we didn't have anything, we put a zero in there and explained it in our release last Saturday. And this is just a further indication of the facts as they stand now. At some point, Price Waterhouse will need to be happy with the figures they're reporting, and that evidently involves a restatement. And at that time, my guess is the quarterly figures become quite current, and that we keep picking up our share of the earnings.
I mean, this has been a long standoff period between PwC and the company. If they've missed all of the deadline to get the numbers to you at that point, what happened?
We didn't expect it. And, I thought that we would have the earnings on time. And Kraft announced their earnings for last year, but they had not been signed off on by their auditors. So while they released them publicly, they couldn't file the 10K with the SEC subsequently. That's not unusual for companies to announce the earnings before they've actually got the sign off. But in any event, it's just, we thought we were going to get them this week or next week, whatever it might be. And then last Saturday came, and that's our time for releasing quarterly earnings. We did not have them, so we stuck nothing in there, and then had a footnote, and we put in our press release as well that we just didn't have the figures.
If they're restating their earnings, does that mean Berkshire Hathaway will also have to restate its earnings?
No, it would be so immaterial by the time you take just our share, and we're a much larger company. So I don't know exactly what we do when we get. If it gets into the second quarter, I don't know whether we pick up 2 quarters in 1 quarter or exactly how that works.
They said that they've wrapped up this investigation. Are you satisfied with what you've heard from that part of the investigation, or do you know the details?
I don't know about that. I do know that because I've been kept abreast of some of the things. I don't listen in on directors' calls or anything like that, but Greg tells me what's the high points of what, or the low points of what's happened. And we have a terrific head of the audit committee, Jack Pope. He's an independent director. He knows this sort of thing, and he's put in the hours on it. And so I feel very good about the fact that Jack he's really in charge of things from the standpoint of the directors.
Does the company have your confidence?
The company has my confidence.
You had talked about it over the weekend, where you said that what you paid for Kraft was too much in hindsight.
Exactly.
Not what you paid for Heinz.
That's correct. If we just bought Heinz, it'd be a better investment. And we'd own 50 odd, just over 50% of it, of a business that would be doing fine in relation to what we paid for it.
In a situation where you've determined that you've now paid too much, what do you do?
I paid too much for stocks. I paid too much for a lot of things. Time usually works it out, but it means that capital could have been better deployed in other areas. You can always pay too much for a business, and I've done it with stocks many times. I've done it with businesses. We've got at Berkshire, we have at least a half a dozen businesses. And I can't even use a we there. I got to say I paid too much. So, and if we make the next 10 deals we make, there will be a couple where it'll turn out that I paid too much.
Warren, there was other news that crossed the wires just last night in another deal that you're involved in. That would be backing up Occidental in its bid to try and take over Anadarko, which is also engaged in talks with Chevron, who's also got a bid out there. Last night, Occidental put out its own statement and said that it's going to be revising its proposal. It's now talking about a deal, still $76 a share offer, but 78% cash and 22% stock. By increasing that cash portion, it allows what they call significant immediate value, greater closing certainty, enhanced accretion, because with this, they no longer have to ask their shareholders for permission on this. What are your thoughts about where the deal stands and what this latest update says?
Yeah, I got a call yesterday evening. First time I talked to Occidental, actually since a week ago yesterday, Sunday, and they told me that they were going in this direction, which I like, but I have nothing to do with it. I mean, we committed $10 billion, and it had nothing to do with how they framed their offer, how much they offered, or anything else. That all they knew was that they were sure they could get $10 billion from us if they complete the deal with Anadarko.
One of the pieces of the letter that Vicki Hollub, the president and CEO of Occidental, put out in its letter back to Anadarko surprised me a little bit with just how it still seems like this is a hostile bid. There's not good faith talks that seem to be taking place between them. Based on her letter, she said this: "We remain perplexed at your apparent resistance to obtaining far more value for Anadarko shareholders, which has been expressed clearly through our interactions over the last week." Sounds to me like that is still kind of a hostile bid.
Well, it's my understanding, and bear in mind, the first thing I heard about this was a week ago Friday when Brian Moynihan called and said the people at Occidental would like to talk to you, and I talked to them on Sunday, a week ago yesterday. My understanding is Anadarko and Occidental had talked much earlier, well before the Chevron bid, and we're talking about a transaction, and then Chevron made an offer which Anadarko accepted, but Anadarko was for sale. I mean, and so it held talks about selling itself to Occidental. This is my understanding, so they were talking. Maybe they were talking to more than two parties, for that matter. I wouldn't know that, but they decided that they were willing to sell. I'm sure subject to price, obviously, and they accepted an offer, and Occidental felt they had a better offer, and that's apparently where things still stand, but I don't know all the details.
Part of the idea behind it had been that, well, would Occidental be able to get approval from its shareholders because its stock was under pressure? Some of the shareholders obviously didn't like the deal. By using your cash instead of issuing as much stock as they had anticipated originally, that will keep them from having to go to their shareholders to ask permission for this. And as they're saying in their own letter, that certainly increases the certainty of this deal taking place and removes some of that uncertainty.
Yeah. I would also think that the shareholders, if you own Occidental, you're bullish on oil over the years, and you're probably bullish on the Permian Basin because they have such a significant portion of their assets there. So the idea that they will use less stock and more cash as part of the deal, although they're getting the cash from us, but I would think net, if I'd been a holder of Occidental over time, I probably would like that kind of a deal. At Berkshire, I hate to issue stock. So generally speaking, if any company we own is buying something, we like it better when they buy it for cash than they use stock because we like their stock. So we'll see what the reaction is to this, but I would just imagine it had been an all-stock offer to begin with. I would think people would net their shareholders, but the shareholders will be speaking out, but I would think that the shareholders would like the shift.
Andrew's got a question from back in studio, too. Andrew?
Sure. Hey, Warren, I was just curious whether you were surprised that Anadarko hadn't engaged with Occidental on this at this price, and also if there was a price at which you would think that that Occidental shouldn't pay, meaning if Chevron were to come back and they're 5 times the size of Occidental, they could just write a check and this could be over with if they wanted to. But if the price were to go up, I know you get preferred shares ultimately. Is there a price at which you wouldn't look at this favorably?
Well, we've committed the $10 billion 100%. We do not have any control, nor did we want any control over what Occidental did with our $10 billion in the terms of everything. There's nothing in our deal that provides that they have to come back to us and request permission really to do anything. It's a remarkable deal, but that's the way we do them. And in that respect. And so they get our $10 billion if and when they close a deal with Anadarko, and they don't have to consult us. They certainly don't need our vote. They don't. It was a matter of courtesy. I got the call yesterday, but it was not a matter of necessity on their part. And that's one of the advantages of dealing with Berkshire. I mean, we can do things that other people don't like to do or their lawyers don't like them to do. And this is not a deal that our lawyers would have written.
Is this deal a bet on the Permian Basin and on oil prices, or is this just a bet on, hey, it's great to have an 8% preferred?
Well, not great to have an 8% preferred if there isn't any oil there. No, it's a bet on oil prices over the long term more than anything else. It's also a bet on the fact that the Permian Basin is what it's cracked up to be and all of that sort of thing. But oil prices will determine whether almost any oil stock is a good investment over time, whether it's Exxon or some wildcat driller. I mean, if oil goes way down, you don't solve that by hardly anything. And if it goes way up, you make a lot of money. And it's not what it does next week or next month or next year. You're buying reserves that go far out into the future. So you have to have a view on oil over time. And Charlie and I have got some views on that, not too specific because they're not that well informed, but they are. We feel good about doing the financing.
Why don't you just buy it yourself? It's only a $35 billion deal, and you've got $110 billion in cash sitting around.
Well, that might have happened if Anadarko had come to us, but we wouldn't jump into some other deal that we just heard about through somebody coming to us and seeking financing. We wouldn't. No, we hope people come to us on businesses, but I had no idea that this transaction was going to happen. I mean, a week ago Friday when I got the call from Brian Moynihan, well, I'd read in the paper about the deal, but I've never had any contact with Anadarko of any sort.
David Faber reported last week that you had said you would offer up to $20 billion, double the $10 billion that you did do on this deal. Is that the case?
If they needed it. But I think they have an arrangement, obviously, with the Bank of America, who called us. I don't know anything about that deal. I just know that the B of A has arranged that debt financing. If there were a different sort of thing. But what I meant to some extent with that is I'd be also very happy if somebody calls tomorrow and needs $20 billion. Occidental just needed the $10 billion.
Okay, but you like doing these deals at bigger sizes, not smaller sizes?
Exactly.
Okay. Back to Andrew's point, this is there for forever. It doesn't matter if the bids go up. Doesn't matter what happens along the way. Your $10 billion is in this deal for whatever happens.
Yeah, there is. The lawyers don't write deals like this, but we tell them to. There's no material adverse change. There's no. If the stock market closes, but this deal closes, we're there. We're there under all circumstances, and we have not written any outs into it, and but that's part of the attraction of doing business with Berkshire. And besides that, we do it all ourselves, so it isn't something that's parceled out among 10 parties, and each one comes in and has to get their permission to make changes and all that. When they came to my office at 10 o'clock on Sunday, a week ago Sunday, they knew that if we agreed, which we did by 11 o'clock, they knew Berkshire was 100% in. Now, they had their own board of directors meeting the following evening, but they could say to their board, you're going to get $10 billion from Berkshire. when this closes, and you don't need to give a thought to it.
Obviously, many stocks are under some pressure from what they were seeing from these Chinese trade talks, what the implications are from all of that. One stock that is under pressure today, shares of Apple. If you want to take a look at the chart, closed on Friday at 211.75. This morning, the bid's at 204.91. The ask is at 205.10. And that's because China has been such a huge component for Apple. Tim Cook talked in the last earnings last week about how things seem to be really improving there. Tim Cook also traveled to Omaha this weekend. He was here for the Berkshire Hathaway annual meeting. It's his first time coming here. But for Berkshire, Apple is now the biggest investment that they have in their equity portfolio. It's also Berkshire is also the third largest investor in shares of Apple. So when we sat down with Tim Cook this weekend, I got the chance to ask him what he thought and how he found out that Berkshire was first buying into shares of Apple. Listen in.
I found out probably like you did, which is the 13F gets filed and somebody tells me about it, and I thought, oh, this is really cool. Warren Buffett is investing in Apple. You know, we welcome all shareholders, but we run the company for the long term. And so the fact that we've got the ultimate long-term investor in the stock is incredible because our interests are aligned. And then I knew Warren before then, but we had no idea they were looking at the company. They do all that obviously secretly and have their own method of doing that. And it's been a privilege, and I'm super happy they've been accumulating.
What happened when you found out? Was there talk around the office? Were there any high fives, or was it a, oh boy, now what?
It seemed like recognition in a way, like an honor. And a privilege, and I don't mean that in a light-hearted kind of way. I mean, wow, it's Warren Buffett is investing in the company, and yeah, and so it felt great. And I think for the whole company, because we knew that he didn't. He's been very clear he didn't invest in technology companies and companies he didn't understand. He's been totally clear with that, and so he obviously views Apple as a consumer company. Yeah. And in a different kind of way. I think that's really special.
Warren, what did you think hearing this? Because when I told you we were going to tell you how he found out, you said, "Oh, good. I'd like to hear the story." You've never talked to him about that?
I didn't. Not about that specifically. No. I've known Tim a little over the years. I see him maybe at least once a year, and maybe twice a year. And I've talked to him on the phone a few times. And sent him a letter. I sent him a Martin Luther King speech some years ago that was kind of lost to history, that was terrific, and I thought he'd enjoy. But no, I didn't call him up while we were buying. I try to keep as quiet as I can when we're buying anything.
China, though, is a huge issue for Apple. It's why the stock had been under pressure earlier this year, or at the end of last year. Last week on the earnings call, it certainly sounded like they thought China, the situation there was improving. What does this news today mean for you?
Well, the important thing is really what the relationship is with China 3 years, 5 years, 10 years, 20 years from now. This all enters in, and certainly it's hard for me to imagine that the two most important countries in the world would do dumb things over a long period of time, but they could. I mean, the possibility always exists that you get miscalculations or egos or national pride or whatever it may be, and that things do escalate. I don't think that'll happen. Well, I know it shouldn't happen. I think it's a low probability, but that would be bad. Be bad for everything Berkshire owns. It isn't a question of Apple, or it have a very negative effect on our economy, other world economies, and there's a chain reaction of sorts, type of thing. So I don't think it'll happen, but I don't think it's zero, the probability.
You say it would be bad for virtually all the businesses that Berkshire owns, but Apple's in a pretty unique position because it is so front and center, because it's already come up as a potential target for some of these things. Do you think Apple runs a special risk or not?
Well, it would have, I mean, obviously in terms of our electric utility in Iowa, would have a very minor effect relative to other types of businesses. But the ripple effect, if you get a recession, and it hits everything almost eventually. So I think it's very unwise. It's kind of like having if you have a nuclear war, you don't want to say ha ha ha, you know, if you're in Canada because they're only attacking the United States or something. It's impossible to contain it if you have two superpowers in trade involved, and you can't predict exactly how it spreads.
Apple shares are down 3% this morning, just looking at the chart.
Yeah.
That's good. Why?
Well, because they're repurchasing shares, and when they repurchase shares, our interest goes up and we don't lay out a dime. I love it, you know, and obviously it's better to buy it at X than 2X.
They've said they'll purchase, they've reauthorized up to $75 billion in additional shares. You're behind that? You're in favor of that, I should say.
Wildly in favor of it.
We're going to talk a little bit more about share repurchases, not just with Apple, but more broadly, because it is a question that came up pretty frequently this weekend at the annual meeting, too.
Repurchases can be the dumbest thing in the world or the smartest thing in the world. And I've seen both. But they're just, repurchases by the company are just like purchases by us. They're dumb at one price and they're smart at another price. And I like it when companies, we're invested in companies where they understand that. Many companies just repurchase, and you know, it's the thing to do, and they're encouraged to by some shareholders and by their brokers. And repurchases can be dumb, they can be smart. At Apple, they've been smart.
We did talk at the top of the last hour about what the China tariffs potentially mean for business and what they mean for Berkshire, but you're looking at the markets down almost 500 points this morning. And for people who are just waking up and just kind of trying to figure out what this means for them, for their portfolios, for their businesses today, I'm sure they've got some questions. What can you tell them? What do you say when you look at the markets, I guess, down 460 points right now for the Dow?
Well, I'm saying, if you own a farm and you're worried about selling your farm because you read the newspaper this morning, or if you own a perfectly decent business in your town and you're worried about you think you should worry about selling your business today because then you should worry about thinking about selling stocks. But if you look at stocks as businesses that you own little pieces of, why in the world should you sell it based on headlines of any sort? I mean, if you expect a farm to be a good investment over 10 years, if you expect an apartment house to be a good investment over 10 years, and if you own a marketable security, which is an interest in a business, and you expect that business to be a good business over 10 years, it's nonsense to get feeling good or bad about what stock prices do in a day unless you have extra money and they go down, and then you feel better because you can buy more of them cheaper. Just like if you could buy the farm right next to you cheaper, you'd love that if you were a farmer.
You know, usually that's an analogy that I understand and agree with, but this time around, a farm in particular, I would be pretty worried if I was a farmer trying to figure out if I should be planting soybeans or if I think I'm going to be able to make enough money to get things back this time around. Yeah. Tariffs have hit the farmers particularly hard, and a lot of them have said they're behind the president. They want to see us get to a better situation, but many of them are also in a position where, look, they've already been asked to give a lot. They thought we were about to reach a deal, and they're hoping that when they're making decisions for this planting season, they have some clarity.
Well, it is true that business generally has improved, markets improved, and everything, and the farmer has not participated in that. So this has been a very good economy for a long time. I mean, we've been coming back for 8 or 9 years, and businesses kept getting better. Interest rates have been low for business. Stocks have gone up, and the farmer has not participated the same way. So maybe I shouldn't have used that example, but if you have a decent business, I mean, you buy into a business. You don't buy a stock that wiggles around, you know, and people understand that, but then they behave as if it's bad news when the price goes down. If you had a half interest in a wonderful business, and the person that owned the other half came in and they were depressed by these headlines today, and they said, I'll sell to you my share of the business a lot cheaper than yesterday because I think this whole thing is going to just end the world. You just say, here, I wish you weren't so depressed, but, but if you're selling it to me cheaper, the business is going to be here 5 years from now and 10 years from now. And all headlines, you don't know what the world's going to look like in 3 years or 5 years or 10 years. What you do know is that the United States is going to grow over time and that businesses are going to generally do well. And if you own decent businesses, you'll make money.
That's a great long-term perspective, but for the shorter term, not just for stock prices, even for companies that are trying to think about their quarterly earnings or trying to figure out how they're going to be able to pay for some items or figuring out how the relationship with the supplier is going to work at this point. It could be an impact that's fairly
well, you have
large
to run
in the short to medium term.
Our own subsidiaries, obviously, where they thought that tariffs could be increased, they've loaded up more on inventory. I mean, no, you make business decisions, but you don't make a decision about whether to buy or sell the business if you've got a good business. You've got to, if you're going to own a business for 10 years, you're going to see a lot of terrible headlines.
Mm-hmm.
I bought into my first business in 1942, and they didn't notice that I did. But just imagine all those headlines at that time, and the world, the Philippines were falling. I mean, we were losing the war, and but the United States is going, your kids are going to live better than you did, and your grandchildren are going to live better than they do. And generally speaking, productive assets are going to be worth more in this country. And if you own a diversified group of productive assets, you'll do fine as long as you don't read the papers.
Although you did say an hour ago that the sell-off when the Dow was down by about 500 points was not an undue sell-off, was not overdone at that point if we actually get into raising tariffs by 25%.
Well, it may not be undue. I mean, in the day or the week, but you shouldn't be. I don't have the faintest idea how to buy and sell stocks for a day or a week or a month. I know how to buy businesses for a long period of time. I'll be wrong on some of them. You won't be wrong on America.
In terms of that, when you look at the markets today, if you see cheaper prices, would that mean that you would buy more of a stock that you might have bought last week?
Yeah, some of them will hit levels that I might have been below. I will always react well to declining prices. If I like to buy a business, if I could buy this hotel we're in and they drop the price, is that good news or bad news for me? I mean, if I like to buy hotels. So, but the fundamental point, and some people get it and some don't, but when you are buying a stock, you're not buying something that wiggles around or is on a chart or has a target price. You're buying part of a business. If you're right about the business, you don't pay a crazy price. You can be right about the stock as long as you don't do dumb things yourself.
Over the weekend, a lot of questions came up about share buybacks.
Yeah.
People were asking specifically about Berkshire. Why don't you buy back more shares of Berkshire, especially when you have $110 billion in cash on hand? What's your answer to that?
Well, we will only buy Berkshire if we think that the shareholder the next day is, or that same day, is wealthier after we've bought the stock. In other words, we bought it for a shade less, or maybe a lot less, but at least a shade less than it's actually worth. And we don't set out to buy any given amount. We set out to buy stock at prices below intrinsic value per share. Now, intrinsic value per share is not something that is precise to the penny or anything. It's probably a band of 10% or something like that. And my partner, Charlie Munger, if you asked us to give you a slip of paper with intrinsic value per share on it, it would not be the same figure, but it'd be close. And we both would have a band or something of the sort. If you're buying it below that figure, if we've each got $1 and you'll sell me, and we put it on the table and you can't reach it for a while, you say, well, I can't reach it, so I'll sell you my share for 95 cents. I'll give you 95 cents. If you say $1 too, so no dice. So it's not complicated. It may be beyond my ability to figure out the intrinsic value of certain kinds of businesses, but with Berkshire, I've got a reasonable idea, and I try to give the shareholders the same information that I regard as important in calculating that. Now, it can change. Presumably, you want it to change upward over time because we retain earnings and we should be building more value. But that's the equation. First of all, you have to have the cash you need to run the business. I mean, Steve Jobs called me one time. I mean, he called me, I don't know how many years ago, And he was thinking about repurchasing shares. And I said, Steve, there's just two questions. I said, you know, A, you have all the business, all the money that you need to develop the kind of business that you've got in your head for the next 5 or 10 years. And, oh, he says, we got plenty of money. And then I said, then the second question is your stock selling for less than it's worth? And he said, it's selling for a lot less than it's worth. And I said, well, you've answered your own question. But if he'd answered, we need the money we've got here actually to fully develop our business, and we've got opportunities to do it, I'd say forget about it. You know, build the new plants and do that, and maybe the cash will come in later where you can buy stock. And secondly, if he said the stock isn't really cheap, what's the reason for buying it in?
Did he buy back shares after that?
He didn't like buying back shares. I think he was hoping I was going to give him a different answer. He didn't argue with the logic of it, but I think maybe I think he was hoping for a different answer.
It's interesting that you say that because Tim Cook, the current CEO of Apple, was here this weekend, and we got the chance to ask him about share buybacks too, because share buybacks have been such a big deal for Apple. They've deployed so much cash doing that, and just announced last week at the earnings that they'd be buying back an additional $75 billion worth of Apple shares, or at least they've authorized the repurchase of that much. Again, we sat down with Tim Cook this weekend, and here's what he had to say about that too. Listen in, Warren.
This is a funny story a bit. Is back in 2012, I'd been in the CEO spot maybe a year or so. We had a growing amount of cash. I think we had crossed the 100 billion kind of mark, if my memory is correct. And I was getting lots of input from a lot of different people, as you can guess. And when I don't have experience in something, I always make a list of the people that I think are the smartest people that I can contact to talk to them and get advice. And Warren was on the top of the list. As you can imagine, I'd never met Warren before. And so I get his number, I call out to Omaha, and I'm thinking, I wasn't sure he'd take the call. You know, I'm sort of calling out of the blue. He doesn't know me from Adam. And, but he took the call. And I had a great conversation with him, and that was the first time that I'd met Warren, and he was very clear to me. I still remember he goes, let me just cut through it. If you believe your stock is undervalued, you should buy your stock. And I thought that was just the simplest way of looking at it. So here's what we do, is we first and foremost take care of our people, and we take care of the company and the future of the company. And we've been investing a ton in both this country and some others. We're going to spend $350 billion in the United States in building new sites, and we just announced a new expansion in Austin and so forth. So all of that is number one, right? And then if we have money left over, we look to see what else we do.
Part of what else they do, he said, is to make acquisitions. And what I didn't realize is he said they're making an acquisition every week or two.
Yeah, they make a lot of small acquisitions.
He said they've made 20 to 30 acquisitions over the last 6 months, small acquisitions that they don't really talk about and don't tell people things about.
Yeah.
You knew that?
If you look at the 10Q, and you know, you can see, but they make a lot of acquisitions. Yeah. And I hope Berkshire makes a lot of acquisitions. And I'd rather buy an attractive business than buy our own stock at its intrinsic business value. If our stock gets well below that, I've still got this strong, and I can do both, fortunately. But why? How an executive can say we're going to spend $10 billion buying stock and then not pay any attention to the price at which they buy it? They wouldn't buy any other business that way. And so we're price sensitive on it. On the other hand, when the price is right, there's no easier way to make money for your shareholders.
You say you like Apple buying back shares, so you think the price is right there.
Well, they've done a terrific job of it. They've done a terrific job. They've made their shareholders a lot wealthier because Tim has done that aggressively when the price was right.
I mean, how do you know in hindsight, do you know How can you tell when a company's doing a bad job repurchasing? You have to be able to figure out how to value the business properly. It's easier than you're making it sound.
Yeah. The truth is, if you look back, and I was director of the company, but Coca-Cola kept repurchasing their shares at a time when it didn't make sense. If you look at it in the years earlier, they had a terrifically good idea of repurchasing when the company only had a market value of in less than $10 billion, and they bought a lot of stock and they were aggressive about it. But they fell in love with the idea, and I was a director at the time, but they're one of many. I mean, the same thing happened at Gillette to a degree. It's interesting. Sometimes it's difficult for CEOs to be objective about their own stock price, and they think the higher it sells, the better. And it's a fine way to feel, except if you're repurchasing it and you repurchase it at prices up to the sky.
When Coca-Cola was buying back shares and it turned out it was at too high of a price and you were a director, did you know that at the time?
I had a pretty good idea.
Why didn't you say something?
Well, I may have made some comments, but the management had done a sensational job. I mean, that's one of the reasons it got so high. They'd done a terrific job. They made me a ton of money. If you belch too often at the dinner table, you don't get invited to parties anymore.
Which is the difficulty, I think, with probably any board.
You don't get to be a director if you're, unless maybe you're an activist or something, but people don't like it if you speak. And some CEOs like it a whole lot less than others. Some CEOs actually encourage a fair amount of dialogue, and others, make sure that all the important stuff comes up at 5 of 12 when you have to leave at 12 to catch your plane. And the next plane is 6 hours later.
That's interesting.
Boards are managed in different ways.
Have you known every board you've been on which has been managed well and which is not?
Well, some are managed well in some respects, and they can be dumb financially. I mean, you have some managements that really have a money sense, and then you've got others that they're very good managers, but they're not good at. I always love it when I hear a management, and I ask the guy what he's doing with his own money, and he says, "Oh, I couldn't possibly, evaluate stocks and everything. I turn that over to somebody else," and then he goes out and makes it. $5 billion acquisition is something he doesn't really know anything about. We're just buying a whole lot of stock. Some are good at it, some aren't. That's true of our managers. We have terrific managers. Some of them are good at bolt-on acquisitions, and some of them would be terrible.
Do you let the ones who would be terrible at it go ahead and make a bolt-on acquisitions?
Not very often. Yeah, some of them don't have. They have great operational sense. They don't have a money sense exactly. A lot of you talk to a lot of managers, CEOs, and they don't want to run their own stock portfolio. Well, those are decisions, and those are capital allocation decisions, and they know a lot about businesses, and they know how to value things. You'd think they'd be good investors, but I had one fellow who was a big partner, and back when I was running a partnership a long, long time ago, and he had stock options at his places, and he would regularly exercise and take the money and buy Berkshire. Well, he actually wasn't so dumb, but it wasn't exactly what the options were supposed to incent.
But that's unique to have somebody who understands both operations and the money side of things.
Some really do, and
I'm thinking.
I would say Tim Cook, for example, does. Mm-hmm. He has a real grasp of. I mean, he has a operational mind, and he has a money mind as well.
What about Greg Abel and Ajit Jain?
I don't want to get going through the alphabet on this.
No, I ask it because Berkshire's in a unique position, and you have people who are doing all kinds of things. Some who are managing money, some who are managing operations.
Yeah.
Can somebody do all of it?
Both of those guys happen to have extreme money sense, but I don't want to get started going through the list.
Understood. Can't help but try.
Yeah, well, you got the answer for the two important ones.
Welcome back to Squawk Box. President Trump tweeting just minutes ago, the United States has been losing for many years, $600 to $800 billion a year on trade. With China, we lose $500 billion. Sorry, we're not going to be doing that anymore. Take a quick look at the futures. Continue to be down close to 500 points, 471 for 72. NASDAQ down 161. S&P down 50. I guess, Becky, if I were to pose a question to Warren, it would just be that those trade deficit numbers, we get bogged down in talking about whether they're good or bad or how to fix them. And it's a symptom of really it's a symptom more than a cause of what happens with China. I was just wondering, Warren, you've done great over the years with the status quo, with how the United States has approached China and China trade. Berkshire's done great. We've all done great. Everything's fine. Do you wish that Trump hadn't confronted China at all, and we just aren't addressing any of these long-term problems with intellectual property or, take your pick of which issue we're trying to solve, but you just wish he had left it alone and just let Berkshire do its business the way it's been doing, or do you think there's some rationale to confronting China?
China and the United States, for the next 100 years, I can tell you two facts about it. They'll be the two superpowers of the world, right, and we'll always have some tensions with them. And it can well be about intellectual property. It certainly has over the last 20 years or thereabouts, 30 years. And it will be about trade. It will be about policies that they're carrying out, in terms of their neighbors or we're doing. There's no way you can have two countries so dominant in the world without them having conflicts. You just don't, there are going to be tensions, there are going to be negotiations, and sometimes we'll both come away thinking we lost, but it's inevitable. So and how you play the game if you're negotiating with some people that are tough negotiators on the other side. I mean, it's not, those are not easy decisions to make. I mean, if you're doing with the labor union, nobody really wants to strike. It's bad for both sides, but sometimes things develop to that point. So I think you should get very used to the fact that if you're a young person, that you're going to see a lot of different tensions over time. And it will depend on the individuals involved. It will depend on the specifics of the situation. But every time we sit down, it won't be like a garden party.
Warren, you mentioned that there are going to be times where both sides walk away and feel like they lose. Are there times that both sides could walk away and feel like they win? Because that's usually the sign of a successful negotiation. You want both sides to feel like they won at the end. And the idea of a negotiation is to take something that you have the other person needs and in a sense trade that for something that they have that you need, and it's going to be constant, and there's times when it's going to be tense. It's just the nature of things. I mean, you have that on a much different level when you're negotiating nuclear arms reductions or something of the sort. I mean, we know it's in the interest to get the nuclear stockpiles down and all of that, but that doesn't mean it's easy. And you try to come up with deals that are good for both sides, but that's not always easy. I mean, I try and think about that in this scenario, and it may be particularly difficult in this scenario because for a long time we've been dealing with China as if they were still not a superpower, as if they were still, so we've been giving them better sides of deals. It's really hard to all of a sudden say we're taking some of that back. What do they get out of this deal when we are trying to change a negotiation that we think has been unfair to this point? Well, it's difficult for us to accept the fact. It was difficult for us to accept the fact after World War II that the Soviet was a superpower in terms of military power. And there were, I mean, as you know, obviously, there are all kinds of tensions involved in that and negotiations. And it's still a worry that we have the two big nuclear stockpiles in the world. And you worry in terms of mistakes being made. I mean, it's a big game. And with China, it's overwhelmingly an economic game. And it's an economic game we didn't think we'd be in 40 or 50 years ago. I mean, the rise of their economy has been extraordinary. And they do some things we don't like in connection with that. And sometimes you have to get tough to make changes, and we do some things they don't like. But
But it's a reality now, and it's going to be a bigger reality as the years go by. And it's very easy for it to become a huge political issue. I mean, so you'll have people fanning the flames for their own personal interest in politics or their own interest in business, and it's not easy to navigate. But leadership that's the job of leadership, is to take on the tough problems.
Having said that, the economy has held up very well
Sure.
in the face of any tensions that we've seen to this point. Jobs report, incredibly strong on Friday. The last GDP report was very strong, too. So
You can't stop America. You can't stop China, though, either. But you can't stop America. I mean, we live as a country, you know, it's extraordinary what we have compared to 30 or 40 years ago. Even in agriculture, it makes it tough in agriculture because we get more productive all the time, and that tends to depress prices. But this country is going to move forward. I mean, there's no question about that. But China's going to move forward. And the way to try to do it is to do it that maximizes what both countries can do well, and more trade is better. But trade in specific industries can hurt specific industries here, and that's a huge problem. The heads of both countries have to be the educators in chief, and they have to explain why trade is good for the populace as a whole, and it can be terrible for people in certain industries. And then a rich country takes care of those people that become roadkill in the process of producing a better life for 330 million Americans.
Lots of people on Wall Street are not going to be as sanguine about this news today. I've been reading some reports last night. Goldman Sachs saying that this is not only rapidly increases the odds that we don't get a trade pact with China, but also increases the odds that you could see Trump announce that he's going to pull out of NAFTA, or that he's going to put auto tariffs on European imports. What do you think of that, and what would that mean?
It's the problem of escalation in anything. We have the problem of that with nuclear weapons. I mean, the escalation, and it gets more and more dangerous as people become feeling more and more threatened, and their own local political situation demands more and more action. I mean, that's the dynamic that you're facing anytime you get to these major problems between countries, and that requires the wisdom of the leaders, but to some extent it requires the wisdom of the people. I mean, and how the leaders convey it, people, and how they conduct themselves. But we will have this sort of thing happen. We've had it happen, obviously, and occasionally would turn into wars in the past. We can't do that anymore. In a nuclear world, you can't get